to see. If rates do move up, I don't think it's going to be because of the Fed. It's going to be because of the fiscal dysfunction in Washington. So even though the Fed's very powerful, it's not the only driver of rates, and fiscal policy is also a factor as well.
But do you think we're underestimating the impact of QT? Like, we focus so much on interest rates, and this could be the big one.
Well, you know, Jay Powell and the Fed's hope, Francine, is that QT operates in the background. In fact, I think Chair Yellen at one point said it's like watching paint dry. But as I learned when I was vice chair in the fall of 2018, it's in the background until it's not. And markets can suddenly start paying a lot of attention to QT. I don't think we're there yet, but it's obviously something the Fed will have to be attentive to.
So what do you think in this juncture in time? Is there something that markets are misunderstanding about what the Fed is trying to do or how the economy will evolve?
I think the markets are underappreciating that the Fed has to take into account not only the baseline view, but the balance of risk. And I think there is a scenario next year where the labor market continues to be hot, low unemployment, the progress on inflation stalls. And at that point, the Powell Fed has a tough choice. Inflation's running, in the threes next spring. They don't want inflation in the threes. They want it heading to 2. And so I think markets are underappreciating that if inflation remains sticky and stubborn, in certain scenarios, we may see more from the Fed.
So you don't think they'll live with a 3% at the margin for a while longer?
No, I've said before, and I'll repeat on air, I think the destination before they start considering cuts is 2 point something on inflation, and point something might be 0.8 or 0.9, but they definitely want inflation year over year under the core measures in the 2s before I think they start thinking about what's next.
Richard, do you think we're importing deflation from China?
Well, certainly a surprise to me, although not to my PIMCO colleagues, because we got the call right. Typically, when you have reopening or stimulus in China, you do see it putting upward pressure on global prices. This year, inflation's going in the opposite direction in China. So, but offsetting that, Francine, is the fact that we have a real push here for friendshoring, offshoring, de-risking, whatever the favorite term is. And that can only be moving in one direction. It's going to put upward pressure on prices as supply chains readjust.
All right, Rich, thank you so much. Richard Clarida, their global economic advisor at PIMCO, of course, stays with us, and we'll talk a little bit more about fiscal space or the lack of. This is Bloomberg. Welcome back, everyone. Now, still with us, Richard Clarida, global economic advisor at PIMCO and former vice chair of the U.S. Federal Reserve. Rich, thank you so much for staying with us. We talked a little bit about the Fed, bond yields, what you're expecting, maybe some of the pitfalls, and we're just getting started to talk about China.
Yeah.
What do we not understand well about the China economy that could actually hurt, I guess, even Europe a lot more? We know that no matter what political spectrum you're from in the U.S., you want to go after China. Does that translate economically?
Oh, it really does. I guess to answer the first part of your question, what do we not know about China? I think almost everything. It's an enormous economy, but it's opaque. It's hard to follow, I guess, sometimes even for folks in China. But clearly what we do know is that the reality of the 30 years before the pandemic, globalization, China supply chains driving global disinflation, that's definitely in the past. We're in a world where we're going to have more complex regional trade arrangements, more complex trading arrangements, obviously supply of minerals, including lithium for batteries in China. So a very complex, not only economic, but geopolitical relationship, which all of us in markets are navigating.
But Richard, from where we are now, right,
yeah.
which is deglobalization and
Yeah.
the onshoring of supply chains, how much more can that still go on? Are we really talking about a trend that can continue for years to come for deglobalization?
Well, I would say more re-global. I don't think we're deglobalizing, but we're re-globalizing, for example, with our relationships with NAFTA, with Mexico enhanced, and some production in China moving to other countries. And so, yes, at PIMCO, we think this is what we call a super secular trend, which means, a decade or more.
So what does this mean? Going back to the U.S., are you expecting a soft landing, or are the chances of a recession quite, 20%?
At PIMCO, we do think markets are a little bit over-optimistic on a really soft landing. I think I would characterize us as thinking of a softish landing, perhaps some modest rise in unemployment, perhaps a technical MBER recession, but not a deep, persistent a downturn. But we do think markets have gotten a little bit ahead of reality on the soft landing narrative.
Do you think there's a perception across all, actually, jurisdictions that we've now, won the fight against inflation, and that's premature, be it in Europe, UK, or US?
Well, yes, because for the following reason, I think central bankers in particular will be very reticent to either communicate or even think themselves about mission accomplished. That doesn't end well, as we've seen historically, and in particular, given that central banks, including the Fed, and I was a member of Team Transitory, it's important for them to be darn sure that when they say that inflation's on the way back to 2%, it is. And so I do think that they've underestimated probably the resolve to keep rates restrictive for longer.
Why did we get transitory so wrong? It feels like, we could actually argue that it's transitory, but over years.
Well, I'm open to that since, as I said, I was a charter member of Team Transitory. Look, in the spring of 2021, what we knew at the Fed, and I was vice chair then, was that the vaccines had arrived, reopening was occurring, and initially the inflation that we saw was really concentrated in just a small number of reopening categories, used cars, for example. So I think what central banks got wrong, what the Fed got wrong, is that we had multiple large, unprecedented shocks. The pandemic was a shock. Reopening was a shock. Russia's invasion of Ukraine was a shock. And adverse supply shocks complicate monetary policy because they push up inflation, which is bad, but they also tend to depress activity, which is bad. And so I think it took a while, but I think the Powell Fed and the Lagarde ECB and the Bailey Bank of England recognized what they needed to do, and they're doing it.
How much do we need to start talking about fiscal space, right,
well,
of countries?
I think we do need to talk about it.
But markets are not really looking at it.
Well, I think they will start to look at it at some point because if you just look at simple measures like the amount of government debt relative to GDP, in most countries 20 years ago that number was less than 50%. It's now around or north of 100%, including in the U.S., many countries in the Eurozone, not Germany. And I do think that fiscal space is going to be more limited going forward. Economists aren't very good at giving us the exact point at which you run out of it, but whatever your views were on fiscal space before the pandemic, there's less fiscal space available now.
And talking about fiscal space, we're almost at the one-year anniversary of that pretty disastrous mini-budget here in the UK.
Yes.
Are we over that? Is the UK feeling more solid?
I certainly, yes, I think, but I think that was a very important example of how quickly fiscal confidence can be eroded and how that can spill over into markets and require interventions. And so, yes, I don't want to necessarily invoke the canary in the coal mine analogy, but that may be the first of other episodes that we're going to see in the years ahead.
Could it happen elsewhere? I mean, could something like that even happen in the U.S.?
Well, we've had disruptions in the Treasury market. In September of 2019, we had the repocalypse when the repo markets in the U.S. Were disrupted. Now, the Fed acted promptly in that case. We also saw the Treasury market challenged in the spring of 2020. I think we do have an issue in global sovereign markets in that the infrastructure for clearing and trading Treasury securities, for example, it was designed 40 years ago, and the amount of intermediation that you have to do in markets today is vastly larger. And so I think there is always the risk of hiccups and dislocations that cannot be completely eliminated.
Richard, as always, thank you so much for coming on.
Look forward to the next time.
Me too. Richard Clarida, PIMCO's Global Economic Advisor and former Vice Chair of the Federal Reserve. Now, coming up, we'll bring you more on the year's biggest IPO. We're, of course, talking chip designer ARM. That's next, and this is Bloomberg.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
This is The Pulse. Welcome back. Now, we're getting some breaking news out of Italy. The Prime Minister of Italy, Ms. Meloni, is saying that the final tax on banks must net some 3 billion euros. So on the back of that, we're seeing a little bit of pressure across the board with, for example, Intesa Sanpaolo down 2%, Unicredit down 0.7%. Now, today is the day. ARM has priced its IPO at the top end of its range to raise $4.87 billion in what is the largest listing of the year. Now, Bloomberg previously reported that ARM's initial public offering was oversubscribed by more than 10 times. Trading begins on the NASDAQ at 2:30 p.m. UK time. Now, for more on all of this, we're joined by Bloomberg's Sweta Gopinath. Sweta, thank you for joining us. I mean, it's a pretty exciting day. Like, we thought this would be a flop, and every day we have more encouraging news. So tell us the details about the IPO and really what we know about the final valuation.
Yeah, the final value is now at $54.5 billion. They've priced at the top end, like you said, which is actually a victory, really, for SoftBank, managing to get away with top-end pricing in this market where we've had few IPOs. The IPO market has been pretty depressed for the last 18, 20 months. So this is the big deal that we've been watching out for. And if it trades well today, it could really open the floodgates in a way we could see a number of other tech listings follow through. So it's a key moment for the global equity capital market.
And how sad is it for London that actually went to New York? There was a little bit of indication saying, well, it's half the price of what they wanted, but now it's doing so well. Is it really bittersweet?
It is a very bittersweet moment for London. There's a lot of hand-wringing here. ARM is a UK company, after all, and to lose a tech giant like this to New York hits hard, especially because London has had so few listings this year. And we're not seeing the sort of pickup in activity we've seen overseas in the US. In the US, we've had a number of other filings already. We've had Instacart and Birkenstock file for IPOs, and we aren't seeing any of that activity here in London yet. So it's a sore loss for London, but a win for New York.
It certainly is, Sweta. Thank you so much for all of your extraordinary reporting, Sweta Gopinath. Now, coming up, my wide-ranging interview with the former UK Prime Minister Theresa May. We talk Brexit, China, Donald Trump, and the UK on a year on from Liz Truss. This is Bloomberg.
The U.S. growth story is still alive, but so too is inflation. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Bonnie Quinn, and we are counting you down to the closing bell right here in the United States. Well, it's all about capital markets activity today. We have the S&P and the NASDAQ 100 up The S&P obviously doesn't have ARM in it, but the Nasdaq certainly does. So you can see there's other things going on as well. Economic data, for example, data showing that the consumer is remaining resilient with retail sales up 0.6%, which was a little bit of a nice surprise. Also, those initial jobless claims came in a little bit lower than anticipated. So the labor market, whether we wanted to or not, is holding up. The 10-year yield and the 2-year yield obviously higher. 2-year yield above 5% right now. And I wanted to point out the dollar index because this is really a euro story today. We got the ECB hiking by 25 basis points and signaling that growth, if at all, is going to be very, very sluggish, and there will very, very likely be a pause next time round.
Yeah, starting to see maybe a little bit of a divergence in the U.S. and the European stories. Back here in the U.S., we did get the latest batch of economic data, a mixed bag to be sure, but it's still skewing towards the positive. Investor attention squarely on the retail sales numbers that dropped this morning. Retail sales numbers that show consumption still resilient, even in the face of a re-acceleration in consumer prices and, of course, those producer prices that we learned about this morning. A modest bid to equities this Thursday that actually has the S&P, believe it or not, poised to log its best day of September. Salita Marcelli, CIO of the Americas over at UBS Global Wealth, she actually says the data supports her view that the U.S. can maintain moderate growth and avoid a recession over the next 12 months, though she does caution that the still lingering uncertainty about Fed policy likely to keep the broader equity markets range-bound. So if they're range-bound, that means returns might be limited. Does that mean you go in and buy bonds? Ray Dalio says no. The Bridgewater Associates founder said he doesn't want to own bonds and prefers cash instead, highlighting a lot of the difficulties investors have right now as global central banks try to manage inflation and, more importantly, manage those expectations. Meanwhile, let's focus, I guess, on the positive, and we're going to start the big show today, Bonnie, with, I guess, the biggest IPO of the year. ARM Holdings actually making its debut, pricing at 51, opening at roughly about 56, and right now trading just below 60.
Exactly. A victory for Masayoshi Son and also for some of the AI players, right? Romain told you the basic details here. We have 90% still owned by SoftBank, so this is a boon for SoftBank. And we have shares trading intraday still up almost 17% at this point. We're talking about a market cap now that's more than $60 billion. And Masayoshi Son himself was the one who said, you know, don't go for too much. Don't be too greedy here. It's only going to cost maybe $100 billion at the most if we just go for it right underneath what he thought was the right price to go for. So right now, market cap of $61.3 billion. Employees and all of those who've been waiting right through the pandemic for this to go ahead, very happy right now.
Our very own Caroline Hyde, the co-host of Bloomberg Technology, was actually down at the NASDAQ for the big fireworks today. Caroline, you got to sit in as a fly on the wall for what is the biggest IPO of the year.
Had we forgotten how it was done?
I know, I forgot. I forgot, remember?
I mean, we all were like with bated breath, so exciting, and remembering actually that these things take a while to open. It took until about midday for actually us to start to get a price, and ultimately that's because from their position they have to ensure that they're aligning the buyers and the sellers. In this case, there weren't so many sellers. Remember, there's only less than 10% in a free float. They'd got lined up some really integral backers, the likes of their clients, like NVIDIA, of course, the likes of Intel, TSMC. Who was going to be selling out in this position? Well, when you're getting the offering of a 17% uptick in terms of the price, clearly there were some sellers to be had. But this is a company that's really had to sell a vision of artificial intelligence. And that's exactly what Rene Haas actually said to me. It's in everything. Just take a moment to listen to him.
Investors really wanted to understand the opportunity we had in front of us. And of course, AI, which you can't really talk about our industry without talking about AI. And I think helping them understand that you can't really run AI without ARM, without a CPU. And just pointing out to them that it's everywhere in every device that people touch was a big part of the process for us.
CEO of ARM, speaking daily to Masayoshi Son, of course, of SoftBank. And ultimately, this is someone who's having to spell a vision when actually revenue has been curtailed of late because, of course, they're so ubiquitous to smartphones. That's been a shrinking market.
And why it's so interesting right now is that we are having investors trying to find a valuation out there in the public markets. It may only be 10% of the shares, as you say, but they're trying to find what the correct valuation should be or where the bid and ask is. At what point will investors demand to see more from ARM?
Well, when they start having to publicly file and they get their quarterly results. The quarterly results have already been guided to the upside. Now, remember, this is a company that in the previous quarter had seen slowing revenue growth. They're actually saying, no, we're going to bring it back for you. We're going to see 11% maybe in the next quarter, then bring it up to 25% growth because of the necessity to have their CPUs, their times of chips, alongside GPUs within artificial intelligence that's become, the linchpin of the market at the moment, Romain.
I am curious. I mean, you sat down with the CEO, and let's face it, he's not a household name for a lot of folks.
No.
Of course, we know Jensen Huang has become a household name. A lot of other folks out there, Linda Su, a lot of other folks in this space, particularly in the AI space here. We talk about the salesmanship that is needed right now, at least at this stage of AI development. Does he have it? Does he have those chops?
He's, I have to say, very humble. He was saying, I've got people, my college friends, calling me saying, I had no idea, of course, because it's a B2B name.
Yeah.
It's not one that we realise is actually in all of our phones, ultimately, their technology. But he is saying now, this was the first roadshow he's ever been on. He's having to get out there as a CEO, sell his story, and from the pop in the stock, and the fact and the art and the science of pricing these things, he's managed to do it right. I think he will become a household name. ARM is ubiquitous to, well, everything that we use. AI, it's also going to be the metaverse, potentially also our Internet of Things.
All right, Caroline Hyde, who's been all over the big story of the day, the debut of ARM here in the public market. She was down at the NASDAQ market site a little bit earlier. We're going to continue our coverage of what's going on with the biggest IPO of the year, maybe breathing some life into the broader market longer term. Meanwhile, we do want to go back to the broader market, the economic data, and some of the macro wins that seem to be steering things as well. Kara Murphy, she's the CIO over at Kestra Investment Management, joining us right now here on the big program as we kick you off to the close. And let's start off with the economic data that we got this morning, Kara. There was a lot of talk yesterday when we got those CPI numbers that it didn't really give the market any real clarity as to how good the economy is and, more importantly, what the Fed might do next. Do you think that changed at all with the data we got this morning?
I think today's data thread this really sort of good story in terms of not too hot and not too cold. So it continues this idea that we're seeing decelerating level of inflation, moderating in the labor market. We're still not quite where the Fed wants us to be, but at the very least, it buys the Fed time to allow interest rates to hold steady with where they are right now and allow kind of like the economic story to unfold on its own. So I think this is about as good as the market could have hoped for today.
And then, of course, everyone is sort of trying to look around the corner. This idea of, is a recession coming? Even if it's not a recession, the idea that you might necessarily have some sort of downdraft, I guess, in the economy that could have a material impact on asset values.
So we still believe that there's going to be a landing at some point. We've characterized this as a delayed landing. There's certainly been a lot more momentum in the economy than we might have expected at the beginning of the year. But the fact is, interest rates have been extraordinarily higher than what we've seen over the last decade plus.
Yeah.
And I think, we talk about these long and variable lags in monetary policies, and this is the lag part. So it doesn't mean it's not going to eat into economic growth, but that it's taking some time to get there.
Kara, just going to have to pause this conversation for just 1 second here. Some breaking news. Shares of Disney spiking higher. We're learning based on Bloomberg reporting that Walt Disney is considering selling its ABC television network. This is according to a person familiar with the discussions that our Bloomberg reporters have spoken to. I will read this verbatim. Walt Disney has held exploratory talks about selling its ABC network and its TV stations to local broadcaster Nexstar Media Group. These talks are preliminary, and we should point out here that it's not actually clear if anything will get done. But our reporting says that Nexstar is interested at, quote, the right price. So once again here, Vonnie Quinn, the big story here, and this would be a big deal, it should have come to fruition here. Disney, the owner of the ABC network, has already held exploratory talks about selling off that network and its TV stations to local broadcaster Nexstar Media Group. Disney shares have spiked up about 1% here just off the back.
And let's not forget, Romain, they're down 25% year over year. Disney has not been doing well. And back at Sun Valley, when all the billionaires were gathered, the talk, the speculation was that there would be conversations perhaps between some of these executives, between some of these cable news executives. And what might Bob Iger do? Who might he want to talk to? portion of Disney's business might he want to go big on or get rid of? And ABC was among those assets. There was also the question of whether he might actually buy the rest of Hulu.
Yeah, there's been a lot of talk about those broadcasting cable channels. Of course, a lot of talk about ESPN and the structure of that, whether that gets spun off or even sold in some form or another. But I think what has been clear, at least based on what Disney has articulated publicly, is that the current structure of that company is going to look a lot different at some point in the near future. And at least based on the current reporting that we have here, Vani, we're learning that exploratory talks have already been held about getting rid of ABC.
And Romain, just think of what that might mean for the cultural and social landscape of America. I mean, ABC, the network broadcaster for
and it's hard. And it's hard to kind of not put the exclamation point on this, because I mean, you're old enough to remember when all these sort of networks kind of came together. Remember, everything was so disparate, and then you had sort of this golden age of sort of the conglomerates of media companies, and Disney was sort of out in the forefront of that. So obviously it had the ESPN channels, ABC channels, the parks business, and all this stuff, and it put all this thing under one umbrella that was supposed to be more efficient, both from a revenue perspective and a profit perspective. But we know the media business has changed dramatically over the last 10 years.
And we know that they brought back Bob Iger in order to try and sort this problem out, right? Disney did not do so well under its predecessor, who was there for just a couple of years before Iger had to come back. Then Iger actually extended the amount of time that he decided he was going to stay. And now there's a question mark over at what point he will go. But he certainly hasn't turned things around enough yet in order for him to feel comfortable to, quote unquote, retire or move on to his next chapter. And clearly, if this is being reported, Romain, you know that things have gone on beyond initial talks.
Right. When I hear that the talks have already been held, that means that this is more than just an idea.
Exactly.
That they're basically looking for the right buyer and the right price. Now, we should point out, you're looking at Disney shares there, up about 1% here. Almost all of those gains came on the back of this news. We should point out Nexstar, which was already up about 3 or 4% on the day, spiked higher by as much as 12%. Those shares have paired some of those gains, but still up about 4% here. So investors very in tune right now here to what this could mean for both companies and whether it could mean potentially, Vani, a net positive, right? Because typically in these types of scenarios, you typically see the acquirer shares go down and the seller shares go up. But in this case, both are going up on the prospect that this deal could potentially happen.
But it's really interesting that Nexstar would be the choice. I mean, according to this story, and of course this is all preliminary and this is not happening yet, it's just exploratory, but it's the largest U.S. owner of TV stations.
They've been very acquisitive, though.
Exactly.
Remember, they bought a lot of stuff from, was it Warner Brothers, right, if I remember correctly, and from Paramount as well. So they've been buying mainly local channels here, but nevertheless, they've been a big investor in this idea that linear television, at least from the perspective of local news and sports and things like that, there's a future there, and they've put a lot of money into it.
So are we talking about the future moving just somewhere else, or are we talking about linear TV going away and perhaps this becoming a whole, like, smaller universe?
I think it might have to do with more who wants the headache, right? If Nexstar thinks they have the management expertise to sort of navigate these waters, which you know are different, and Iger doesn't want that headache because he's got all these other trophy properties, then maybe, just maybe, this makes sense. I'm told we have Chris Palmieri, who helps lead our media coverage all out on the West Coast, joining us right now from our camera in Los Angeles. And Chris, I guess this is a surprise, and I guess it's not a surprise. We knew Iger was certainly kicking the tires of his own company, trying to figure out what might have value outside of it.
Yeah, rumors about a deal like this have been going on quite a while. But the difference is, we saw in July Bob Iger coming out and saying, hey, this is probably a business we don't want to be in long term, the legacy media networks. And so we know they've basically been up for sale. And, you saw the former president of Nexstar at a conference yesterday come out and sort of beat the bushes for a deal. He said, we could do this. Be minor divestitures we'd probably be required to do. There's some complications, such as, how you deal with sports that originates on ESPN, but also is simulcast on ABC. But he very clearly said we just like a little more guidance from Disney on what their plan is here, but definitely something they would be inclined to pursue.
What does it mean for the universe going forward? I mean, the broadcasting universe, Chris, because you have ABC, sort of the quintessential American broadcasting corporation, going to Nexstar, which already owns, as Romain said, several assets, including News Nation, for example, the cable channel. So potentially it could stay the size it is. It could keep the audience it has, potentially. But then do you have Disney doubling down on the streaming type services, the sports type services?
That's exactly the indication that Bob Iger has given, is that they want to focus on streaming. They don't want to get rid of ESPN. But the drag that is the sort of shrinking business of traditional TV is something that they don't necessarily need to be in. And Nexstar's obviously whole business is traditional TV, and they have been getting deeper, as you noted. They acquired the CW network last year. Yeah. They have News Nation, a cable news outlet that they're growing. And so this really fits. I mean, a lot of times companies do sort of stupid acquisitions that's outside of their core. Yeah. But for Nexstar, this is their core business. They employ tons of news reporters around the country. They have advertising sales staffs that sell local TV advertising. Yeah. So this really isn't that much of a stretch for them, and really could elevate and distinguish their product from others.
Chris Palmieri, our man out in Los Angeles, here with the big news of the day. Right now, Disney said to have held initial exploratory talks on the sale of ABC to Nexstar. Shares of both companies higher here in the cast session. Stick with us. A lot more coverage coming up after the break. This is Bloomberg.
Powering financial solutions that transform industries. Powering seamless execution in evolving markets. We deliver our entire global bank to power new possibilities for you. Barclays Corporate and Investment Bank. Powering possible.
The European Central Bank has raised interest rates for the 10th consecutive time. Earlier today, Christine Lagarde was asked if the ECB is done hiking for now.
Focus is probably going to move a bit more to the duration, but it is not to say, because we can't say that now, that we are at peak.
Joining us now for Insight is Ludovic Subran, who is Chief Economist at Allianz. Ludovic, is the ECB done?
We think they are, but the question, and I think President Lagarde is right, is now how long can they hold the rates high like that? Because 4% for Europe is quite high. We're in recession already. Germany's in recession. So I think the question now is the pivot next year, right? But I think for now they're done. Of course, the Fed is, in everybody's mind. If they skip and hike in November, maybe Europe will be pushed for another hike because we have still 2 points more of inflation, and we're still 1.5 point lower when it comes to rates.
How much does the next decision depend on the Fed? Because if the Fed starts to cut, that could also help Europe at some point, right? So can the ECB perhaps wait through a potential next hike?
I hope so. That's my hope, just because I believe now the risk of policy mistake is very high. So the ECB, we have very different economies right now. The US is still growing, expansion is strong in prices, in growth. I think we really have a different, trifecta of growth, margins and wages in Europe right now. So I hope we can see through. But again, how long are we hold tight? And the pass-through is visible for corporates, for housing sector. So yeah, we're not done, but we could be done. The question now is what happened in 24, because it's a very long year for everybody with elections here, election there. Can we hold still, and does it bear some form of recessionary risk?
But that's a big question, because everyone's talking about the peak rate already, right? They're basically saying that we're near there, right? Like 4%, I think, is kind of the consensus here. Do you buy into that consensus?
I think it's a lot for Europe here.
Yeah.
Again, we have zero growth for the past couple of quarters in most of the big countries.
Right.
So it is peak rates. The problem is the risk that markets mistake these peak rates being lower for Europe than the US as. Right. Confirming the stagflationary recession, because we still have too much inflation.
Well, but contrast that with what's happening here in the U.S., because when the Fed embarked on this rate hiking cycle, everyone assumed the economy was going to break. Now, here we are, 5.5 percentage points later. The economy is still holding up. It's certainly not as healthy as it was, but no one's really calling for a whole lot of gloom and doom just yet.
Well, again, the sources of inflation matter. We had 2/3 of the inflation coming from a supply shock that is far from being done. You see what's happening now on the barrel of oil, right? So I think the problem is it's not up to the Fed now. It's up to the fiscal policy to be able to withdraw slowly but surely without breaking the economy. And we've seen in Germany, for example, the recession happened the moment they started to consolidate a bit too fast on the fiscal side. And of course, all countries now also, debt servicing is high for every country. So they're all adjusting at the same time. So there is this risk that the economy doesn't hold as strong in Europe as in the US. We have a regional energy crisis that you guys don't have. And so the question is how we navigate that. Yeah.
And the engine of Europe, Germany, is really, really suffering, which is the frightening thing. Back in the US, today marks the 212th day that the curve is inverted. That's a record, going back to when records began on this kind of thing. What is it telling us?
I don't know, not much more, right? I mean, the problem with the curve is that it's been inverted for too long. The joke among economists is that it tells you there's going to be a recession. It never tells you when. I think if I were to look now at the US, I would look at jobless claims and I would look at credit spreads. These, for me, are going to indicate where we stand on the cycle. I'm very worried about 24. It's going to be an ultra-long year with the elections. It looks to me like a remix of 2016 when we had Clinton against Trump, and it was, this muddle through. And it reminds me somehow also of 2001, when the recession was only confirmed quarters after it actually happened. So stay put. I think the U.S. economy is slowing down. It's going to be borderline recessioning.
Clarify more what you mean because it's an election year. I mean, why does it matter that it's an election year?
Because, there's been recession avoidance syndrome everywhere through fiscal. This country is avoiding recession because of fiscal. There is very strong private sector consumption and investment, but when we look at the number, there is still a lot of fiscal stimulus. And so the question is that in an election year, everybody is calling now, very bipartisanly, by the way, for fiscal consolidation. So a lot of the investment decisions are going to stay on hold till they know what type of tax regime, what type of expenditure, if IRA is going to be repealed by the Republicans or if the Democrats can actually continue to disburse. All of these decisions are going to push, investment and by the firms and by households a bit forward.
All right, Ludwig, great to talk to you here. Ludwig Sobran is chief economist over at Allianz. A look at some of the broader macro conditions, particularly over there in Europe. Back here in the U.S., still some concerns about what's going on with the labor market. A deal between the United Auto Workers Union and Detroit's big three automakers appears to be nowhere in sight with less than 10 hours until that deadline. Detroit Bureau Chief David Welch joining us right now to talk a little bit more about what we know as we count down to midnight.
As we heard from UAW President Shawn Fain last night, he's getting his people prepared to strike, and as he said, strike like they've never been struck before. I'm paraphrasing a bit, but he's not only got a different strategy, but he is really prepared to go all out, possibly strike all three companies. And he had very fiery rhetoric. It doesn't sound necessarily like somebody who thinks they're close to a deal. That said, General Motors has a new offer on the table today. We may get details of that later today. And Ford has offered 20% pay raises. General Motors and Stellantis are pretty close to that. That's a pretty generous raise, 20% over 4 years. I think it's better than they've gotten in all the years I've been covering labor talks. The sticking issue here could be whether or not they're going to give pensions to workers who were hired after 2007. That's one of the concessions the UAW made a decade and a half ago. They want it back. The companies want nothing to do with pensions and retiree health care. They think that's what drove GM into bankruptcy in the first place. So that could be the big sticking point tonight.
David, does Shawn Fain have enough support to keep the workers from all of the plants and all of the car makers aligned? Because if one breaks, that's it, right?
Well, he has enough leverage to get workers to stay out. I think where it becomes a test for him and a test for the union is, right now, because he himself has been negotiating, putting out his demands in public, the companies have been putting out some of their counter proposals publicly, and they include some pretty nice raises. If the workers are out for weeks and they see that they could, go back to work and get a great raise and an offer that they like, do they start pressuring union leadership to end the strike and go back? It would take, I think, weeks for that to happen. There's a lot of anger among union workers to stay out, so it would take a while.
All right. Well, it'll be interesting to see what happens when we get to that deadline. David Welch, our man out in Detroit, keeping an eye on this with the deadline at midnight as the United Auto Workers preparing to hit all three of the major U.S. automakers with targeted walkouts at strategic locations. Another sign of the power that the labor movement feels that they have in this moment, Bonnie, a time where the labor market is strong. And it's not just in, I guess, the more private or, if you will, adult markets, if you will. Interesting story in the Bloomberg terminal about athletes at Dartmouth College basically saying that they want to unionize here. This is the men's basketball team at Dartmouth College. They've actually petitioned to unionize. Now, if it's successful, it would be the first Division I team in college athletics to actually have a union.
Well, and it's another way, another legal way for athletes to get recognized, right?
Yeah.
School and college athletes to get recognized, to get paid, because their whole day is basically dictated by what could be termed employers.
And this caught my attention, too, because several years ago, my alma mater, Northwestern, there were a group of football players that also tried to do something similar. And they were rejected by the National Labor Relations Board because they said, well, technically, you're not employees, so this doesn't apply to you. Now, we know since the Supreme Court ruling with regards to names, images, likeness, that sort of changed the definition of what these athletes are. So maybe the end result is different this time around.
You know, there's going to be a big fight because colleges could lose their 501(c)(3) status.
Oh, it will be a big fight, to say the least, Bonnie. We have a lot going on here today at the ARM IPO, news on Disney, and as well as just the general market movements. Stick with us. Romaine Bostick alongside Bonnie Quinn. This is The Close.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
This is the countdown to the close. Romaine Bostick here alongside Bonnie Quinn and I on the broader market. A relatively strong day in equities on the back of the latest retail sales numbers. Let's take a look at what's going on in the commodity space, though, right now. Abigail Doolittle standing by with our commodities close.
And so it is a bit of an unusual situation that we have today, Romaine, because the dollar is higher on the day. And it's very interesting because the DXY, with that heavy euro weighting, well, it's up 0.6%. The BBDXY, the Bloomberg Dollar Index, which is has less of a euro weighting, up 0.25%. But either way, a strong dollar should not have this kind of a rally for commodities. So this rally that we are seeing, this green on the screen, really confirms the risk-on tone that we have for stocks. New York crude, importantly, back above $90 a barrel for the first time, basically since June of 2022, joining Brent crude. And technically, it appears like this rally will continue. Gasoline also higher, and this is, of course, one of the inflation pressures we've been talking about this week. We also have some strength here for some of the industrial metals, nickel and aluminum. So that really speaks to the idea of this risk-on economy idea. Now, this is interesting. Here in the U.S., U.S. natural gas futures up a little bit. European natural gas, though, down 3.5%. They, of course, have been rallying on the Australian strikes that could take some supply off of the market. But now apparently there's a U.S. facility that's coming back on, bringing these European natural gas futures down. As for some of the grains, a bit of a mixed market here for the likes of coffee and sugar. We have some gains. Sugar, of course, as the India output fears are overshadowing the huge Brazilian crop. And then finally, Romaine, wheat, it still cannot get a bid. On the since its peak back in July, it's down 25%.
Wow. All right, Abigail Doolittle, a nice wrap up here of what's going on in the commodity space. Of course, one of the big headlines of the day surrounding oil prices, WTI firmly above $90 a barrel. Let's turn to the consumer product space right now in the highly competitive market for high quality headphones. Bose, of course, is at the center of that, just announcing the next generation of its popular noise canceling headphones and earbuds. The top models feature a new immersive audio technology that Bose developed to compete with spatial audio from other brands. Joining us right now, I'm pleased to say, is the CEO of Bose, Lila Snyder. Great to have you here in the studio.
Thanks for having me.
Absolutely. I think we're all familiar with your brands. Vonnie was just crowing about her noise-canceling headphones. But what I'm interested in is this new technology that is in this, because I feel like we've gone from a different iteration of noise canceling. I mean, I know spatial audio has become a thing. Yeah. Explain what the technology you're using now in the headphones.
Yeah, so Quiet Comfort headphones will give you everything you expect, right? Amazing noise cancellation, great quality audio. The new feature is immersive audio. And think of it as taking the sound from being inside your head. Usually when you're listening to headphones, you feel like that music is right inside, and bringing it out in front of you so that you feel like you're listening to two amazing speakers and you're sitting right in that sweet spot. Really creates a spaciousness that I personally love.
I am curious about just the competition in this space. I mean, for a while, Bose was kind of synonymous with, high quality audio. That was partly because of your innovation, but also because there weren't a whole lot of other players. I mean, you had some really high-end players out there like Harman Kardon and a few others, but now I feel like everybody's trying to get into this space here. How do you handle that?
I think what's so unique about Bose is we are focused only on audio. So for us, audio experiences is what we're obsessing about every day, and our customers are music lovers and our employees are music lovers. And so I think what makes us truly distinctive is we're focused on innovation to make those music lovers have the best possible experience with their headphones.
You're literally a PhD in mechanical engineering from MIT.
I am.
And you worked at Pitney Bowes before this, which is all about supply chains and getting things to places they need to be. How are you now at Bose thinking about China and this decoupling, this deglobalization and what's happening there? Because you have factories there too.
So I think everyone through the pandemic and what followed in terms of global supply chains is really thinking about agility and resiliency in their supply chain. And we're no different. We're thinking about how do we make sure that we can consistently get our great products in the hands of our customers.
But are there problems out there still, though?
So far, not really, right? We feel like the supply, the commodities have eased, freight has eased. So we're finding it a much more amenable supply chain now than what we had before. There are still some issues in spaces, but it's improved dramatically. And I think our ability to handle those tiny shocks when we have them has increased dramatically.
I am curious about, I understand that there's probably a customer that gravitates to Bose that is probably maybe a little bit more immune to economic conditions. But at the same time, I'm sure you have to be kind of tuned in to what's going on with the consumer, what their capacity is to spend here. What does the economic landscape look like to you?
We see sales are still really strong this year. It's continued throughout the year. We're growing. We see strength going into the holiday. And this is really a category that's a passion point for consumers. And they're willing to, they don't want to compromise when they think about premium audio. If they really love music, they want to make sure they're experiencing that in the best possible way. And we see the consumer really showing up very strongly in our categories.
I am curious about just your tenure. I think you've been at the helm for a couple of years now here.
3 years, yeah.
3 years, excuse me, at Bose. But one of the early things that you did, you established a marketing officer position, which was new to Bose at the time.
Yeah.
And I remember reading about him and I guess some of the challenges that he would have to take Bose from its former corporate culture to what it is now. How much has changed with regards to the outreach to the consumer and just the veneer of marketing that you're using right now?
What's great is the core hasn't changed, right? Really thinking about music and the joy that that brings to people. But what you can see in our brand and the way we're positioning it today is we're really trying to connect more emotionally with our customer. We've always been known for great technology and innovation, and that hasn't changed. But we want to help people see how these products make them feel, right? The music is so important to the memories and all of those special details in your life. Music is usually there, and helping our consumers make that emotional connection with Bose is really where we've been focused.
What's your favorite music?
I love all music. I get that question a lot. One of the most fun things to do is to try our products across genres. You can really see how different genres bring different aspects of our products to life.
Listen,
so I like to
hide
test
it. It's out there. You're a fan of country music. You're a fan of some classic rock. It's all
It's all out there. Yeah.
Little Taylor Swift in your household too, from what I...
Taylor Swift, I think in everyone's household this summer, no?
I think so.
Well, our congratulations to Lila Snyder, CEO of Bose, just on being the CEO of Bose, but also the Quiet Comfort Ultra headphones get launched today. So thanks for joining us.
Thank you so much.
Still ahead, investors are looking to Lennar's quarterly report to get a feel of the housing market. We'll preview what to expect when Lennar's results come out this afternoon. This is Bloomberg.
Dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
Let's get a view from the sell side with our top calls, big movers on the back of analyst recommendations. And we start off with Carnival, the cruise line company, getting a buy rating upgrade today over at Redburn Dubai, which says the sector, the cruise line sector, has now, quote, exited intensive care from the pandemic days. Debt is falling, profitability improving, and margin growth, according to the analysts, looking good as well. Shares looking good, having their best day in more than a month. Next up, First Solar to outperform over at BMO Capital. This comes amid the continued pullback in the shares over the last couple of weeks, but BMO says this makes the stock's risk reward much more attractive. Apparently some other folks think the same. Those shares having their best days since mid-August. And finally, let's take a look at Etsy, a rare upgrade for the company today to outperform from peer perform. This over at Wolf Research, which says despite the plethora of near-term uncertainties and the more than 45% year-to-date decline in the stock, there's still, quote, plenty of opportunities out there to improve margins if management gets its act together. Shares higher on the day by about 3%. And those are some of our top calls. We do want to stay in the sell side space and take a look at the home building sector. Lennar, to be specific, they're set to report earnings after the bell tonight. Let's get some insights out of our next guest. Jay McCann is joining us. He's Senior Vice President over at Wedbush Securities. Jay has an outperform rating on Lennar shares, and we're talking about a stock and, quite frankly, a whole home building sector, Jay, that has really been on fire despite all of the headwinds out there for the rest of the economy. Do you think that's going to continue based on what we learned tonight?
Yeah, we think so, and we're neutral rated on Lennar, but we are thinking that earnings tonight are going to come in about 20 cents or more ahead of consensus. We're at 373. We also think from a volume perspective that they're going to have more closings and more orders, which is kind of the initial sales contract that they sign. We think those are also going to beat consensus because what we've heard from the builders is that cycle times, which is the time from when you sign the contract to close a home, those have been coming down. And also we've heard that demand, even with these higher mortgage rates, has still held up. So we believe that's what we're going to see out of their results tonight.
I am curious, too, when we talk about, I guess, some of the longer term trends. I mean, we know that a lot of new home builders have really benefited from the tightness that we're seeing in the existing home sales space, the resale space, if you will, here. Do you see that persisting much longer term into the future?
It seems like it's going to stay that way. Mm-hmm. We continue to see existing home listings declining by mid 20%. And more pretty much the entire summer. Actual inventories of homes for sale have shown the same type of declines. I'm not a rate forecaster, but I think if mortgage rates stay at this level, mid sevens for an extended period, that's just a disincentive for people to sell their home unless they absolutely have to. The good news for the home builders is that it's giving them essentially more shots at the consumer. New home listings in the first 2 decades of the 2000s, we're running about 10% of national home listings. And over the last, call it 6 to 12 months, new homes have been as much as 40% of national home listings. So Lennar and all the other builders that have great web presence, this is giving them more shots at the consumer and an opportunity, we think, to gain market share. Temporarily, possibly, but at least in the near term, gain some market share versus existing homes.
Jay, how much is Lennar having to discount prices or indeed pay down sort of mortgage rates? I understand that's something that these home builders can do as well.
It is. They haven't given us an exact percentage on the discounting, but I would say that a majority of the homes, they're either having to do some level of incentive, whether that's the mortgage rate buy down, which a lot of builders are using now. That's been a very successful tool at helping affordability. But then also we've heard from some of the other builders that they are giving incentives in terms of extra options in the house, because if people can afford the rate, whether it's a 6%, 7% rate, sometimes they're getting a little extra into the house. So yeah, what we think we're going to hear from them is that they're being fluid on both price and incentive to maintain pace. That's what Lennar likes to do, is maintain a sales pace using that pricing lever and rate buy downs if they need to.
All right, Jay, great to catch up with you. Jay McCandless there, neutral on Lennar here as we head into that earnings report after the bell. Full coverage coming up as soon as we get those numbers. Meanwhile, here on the big program, a discussion about the IPO market arm and whether this is the shot in the arm for the broader market. Kristen Roth-Clark, she's the global head of tech investment banking over at Barclays. She's stopping by the program next for our Wall Street Week Daily segment. Stick with us. This is The Close on Bloomberg. Time now for our Wall Street Week Daily segment here on The Close. The host of Wall Street Week, David Weston, joining us as he does every day at this time. And of course, this is actually a pretty big day. We had an IPO today, biggest of the year. But more importantly than just that IPO, there's a big question here about whether this signals a pickup in deal activity.
Yeah, it's a bit of a dry patch, hasn't it, Romaine? And the question is this going to change the world for IPOs? Yeah. Unfortunately, we have somebody who knows about that. She is Kristen Roth-Clark, Global Head of Tech Investment Banking at Barclays. Kristen, thank you so much for being with us. I know Barclays played a significant role in this IPO. It limits how much specific you can say. But first of all, what do we know so far about that ARM IPO? What does it tell other people in the market about IPOs at this point?
Well, I think one thing I will say for sure is the IPO market right now, this is a really fun time for me personally and for people like me to take companies public because we have an investor universe that has to kind of look at everything because there has been such a dearth of IPO activity, but they don't have to buy everything. And so it really is a fundamental sale to the investors. And so you end up with these high quality orders coming in. It's not the FOMO world of, chasing momentum that we saw towards the end of, 2020, 2021. It is much more of a fundamental sale. And so what we get to do where we, connect buyers to these businesses, you're selling something that they're buying something for 2 or 3 years out, not just chasing momentum.
So what has changed, if anything, Kristen? I mean, we have higher rates still. Those haven't gone down. There's still some uncertainty in the marketplace. Is it just pent-up demand? But why do you think it might be turning around?
Yeah, I think there are a couple of things that are leading to the investor appetite today. Partially, it is the fact that a number of companies that financed in, let's say, 2020, 2021 at multiples that are significantly higher than what we've seen historically and certainly significantly higher than today have had the opportunity to really evolve their business models in a way to become, basically have some discipline around cost, get to profitability for a lot of these companies, and be in a position to where they are much more scaled and have cost bases that will allow them to continue to grow and be profitable. And so that's one thing that I think has changed. The other is I do think investors have more confidence in the levels that we're at from a valuation standpoint more broadly in technology, and are starting to see the competing tension in the public market of M&A from strategic take privates, for example, or from take privates or from strategic activity leading into the end of this year.
Well, that's what I'm interested in, Kristen, here is about, I guess, price discovery. And we know that investors, at least for ARM and a couple others, have sort of found some comfort level with the valuations that they're getting. What about the flip side of that? How comfortable are the companies themselves, these private companies that are looking to go public, with the idea that their valuation is most likely going to be lower than the last private round?
Yeah. And that's going to be the case probably for the next year and a half because of where companies raised capital in 2020 and 2021 and where those multiples were. There isn't a stigma associated with raising money at a lower valuation than your last private round. And so that's helpful. The other thing is a lot of these IPOs are small relative to the market cap of the company. So you're looking at very little dilution if you're selling any primary stock in the IPO. And it's more about where does this stock trade in the aftermarket? who are the investors that are buying it, and are they really committed for the next 2-3 years of the company's growth phase, and less about what is the absolute price on the day of IPO.
If we are sort of entering an era where we're going to see more deal activity, whether it's because of ARM or maybe just because of macro conditions and the Fed are now maybe a little bit more favorable, does that necessarily mean everybody can come through the door? Because, I mean, let's be honest. I mean, there was a stretch in 2020, 2021 where there was a lot of garbage coming to market. And now what you've seen coming to market are much more mature companies, companies that have much more of a track record of revenue growth and profitability. Is that going to end up being the landscape?
I think that the bulk of the companies that have been waiting in the backlog for a couple of years now that have really gotten, as you said, more scaled, they have a longer track record of growth at scale, and they have more discipline around profitability. I think the bulk of those companies are still probably going to go public next year, but they're gearing up now. And I think April is probably going to be a busy month, April-May timeframe, because that's really the inflection point of when companies can get credit pretty comfortably for the 2025 estimates. And so if you've waited this long to go public, getting credit for 2025 is certainly helpful. The conversations I'm having right now with companies and their boards about, do we wait till April, May type timeframe where we have full year financials for 23, we have recent developments for Q1 of 24, or do we hit this window? And the three things that investors, or that companies and boards, the three considerations for going earlier and pushing into this year are: one, you get investor focus. As I said before, investors have to see everything that comes to market right now. They don't have to participate, but they have to look at it. Two, you're building a shareholder base that is incredibly strong from a fundamental standpoint. So this isn't this, pile-on momentum type investor mentality. It's a really strong shareholder base to enter your life as a public company. Yeah. And the third reason is, as strategic M&A is increasing, having a public currency in which to participate in that is a positive. So those are the reasons that people are thinking about moving from next year, April, to pushing forward to something, in 2023.
Kristen, you're head of tech investment at Barclays, and this may be talking your book, but how much of this is tech specific? We've been talking about IPOs more generally. Obviously, ARM is a tech company. There are others that are talked about in terms of IPOs, but we also have things like Birkenstock that at least I don't think of as a tech company. How much of this is specific to tech at this point?
I think, the IPO investors tend to favor growth and profitability, or some combination of that. Historically, it was more growth. Today, it's more growth and profitability. You see a lot more companies come that are tech or tech-enabled, and consumer-facing businesses are probably, in the same way, have similar financial profiles. And so maybe it's a little bit more about financial profile and growth rate, confidence in growth rate, confidence in business, in unit economics that's fueling some of the interest from investors. But tech has, touches a lot of other verticals, and it's been disrupting a lot of other industries. And so I think there will be a pretty heavy calendar on the tech side, probably more so than any other sectors.
And Kristen, I'll put you on the spot here at the end. Do you want to make a prediction of some of the ones that might be up next? I mean, whether they're your clients or not. What do you think might be coming? We hear about Instacart, for example, some others.
So I can't comment on specific names necessarily, but I do think some of the financial profiles that I described, in terms of scaled, consistent revenue growth, in some cases accelerating revenue growth, and confidence around unit economics, and either profitable or very close to that.
I said I was putting you on the spot, and you handled it beautifully. Thank you so much, Kristen. It's Kristen Roth-Clark. She's global head of tech investment banking at Barclays.
It was a nice try, David.
I tried. I had to try. You had to make the effort. I wasn't sure I was going to get an answer. I sort of didn't, but I tried.
I think she's too experienced for that to fall for that. But.
And then tomorrow we've got a special guest, Raj Shah, who's head of Rockefeller, used to be head of USAID. He's coming on to make a very special announcement, actually, on behalf of Rockefeller. And then on Friday we're going to be hearing from Melissa Carney. She's University of Maryland professor, about the economic advantage of a two-parent household. Also hear from Ruth Simmons, former Brown University president, about the importance of college education. That's all coming up on Friday, 6 p.m. Eastern Time on Wall Street Week.
Be sure to tune in for that. And you can check out David Weston every day around this time right here on The Close for our Wall Street Week Daily segment. A very busy day in the markets today. Economic data to start the day, moving the markets. And then as the day went on, the debut of ARM in the public markets may be providing, a shot in the arm for future deals going forward. And learning just a little while ago, the latest news out of Disney, potential sale of its ABC networks, at least based on Bloomberg reporting. We have full coverage ahead as we round into the final hour of trading with stocks up across the board here on this Thursday afternoon. The VIX tamped down, the dollar once again starting to show some strength, and your yield space pretty much where it's been camped out, just a few days removed from the next big Fed meeting. Romaine Bostic here alongside Bonnie Quinn. This is The Close on Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
It's almost 3 p.m. here in New York City from our Bloomberg World headquarters. This is the countdown to the close. Let's give it a view from the top here. Romaine Bostic alongside Bonnie Quinn. Bonnie, interesting day here in the markets. An up day, to be sure, despite the fact the economic data we got that provided the catalyst a bit mixed.
A little bit mixed. We did get those retail sales coming in better than forecast, which was consoling when it comes to the consumer, because we're all worried about the consumer right now, right? But we also, of course, had initial jobless claims coming in at 220,000, and that PPI data as well made a bit of a difference today. The PPI ex-food and energy month over month coming in at 0.2%, and that was down from 0.3%. Business inventories stagnant. So a lot of economic data to parse, but there was also, of course, the ARM IPO, which sort of gave a boost to capital markets action today, and you can see it in at least the NASDAQ, if not the S&P 500, which is up for its own reasons.
Yeah, you can go ahead and flip it up. I mean, we talk about sort of what the ARM IPO could potentially mean for the broader market. Of course, it priced at $51. That was a little bit less than what they were marketing it at, but nevertheless, still pretty strong, coming in at the open at about $56 a share, and right now trading around 58. At one point, it was up around 62. So we knew there was going to be a lot of demand in the secondary market for this, and it'll probably take a few days before we get a much clearer picture as to how much people want to buy into this. But this is a sense here that a company, at least a good company, a company with a proven track record, can come to market and come to market in a big way.
Exactly. A British chips designer, and don't forget, Masayoshi Son gave up on SoftBank for a little while to just go and concentrate on this ARM IPO. He has been missing from SoftBank's leadership. He's been trying to get this done. It's something that's been taking years, really, because he tried to sell it several times and it hasn't happened. And finally now we are seeing an IPO, 10% of the outstanding stock, and it's going well.
All right. Well, that's certainly one of the big movers of the day, Vonnie. A few other stocks also getting a bid.
Exactly, yeah. And you mentioned the cruise lines earlier, Romaine, with the upgrade, and that's one of the stocks that's doing so well as well. Just apart from everything else, we have Norwegian Cruise Lines up 5.8%. On that upgrade, looking like the patient might be out of the hospital is really what I think.
Well, that's what the analyst said. Basically, that the intensive care phase of this for this industry that we kind of had during the pandemic, that's over. But we've joked a lot here about the idea that these cruise lines, they never really did poorly. I mean, obviously they had to shut down completely for a certain part of the pandemic. But anyone who has folks, I'm not a cruise person. I have people in my family who are cruise people, and they were never going anywhere. As soon as the cruise lines reopened, they were back on.
Exactly, and obviously Caribbean Cruises and all the cruise liners doing so well, and they've got it down to fine art, you know.
How are those cruises to Greenland going?
Not those ones so much. Not those 30-day
Did they ever get that
ones.
ship out? Is that,
I think it might be still stuck there, but they're having a good time. I mean,
are they?
From what I could see in the windows.
Well, they have a great view, that's for sure, where they are.
You know, there's a few stocks that are lower today, we should mention as well, and Netflix being one of them. And this isn't the first day of Netflix's decline. This is extending its decline, down 9% now over 3 days. The company not looking for dramatic growth in revenue. And HP on the decline too, Romaine, thanks to Warren Buffett selling a little more of his shares.
Yeah, Netflix shares are down once again here, one of the biggest decliners, at least on a point basis for the S&P 500, moving closer to that closing bell. Our cross-platform coverage, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Bonnie Quinn. We're joined right now by our colleagues Tim Stenovic and Simone Foxman. Simone filling in today for Carol Masser, our global simulcast here. As we keep an eye here on the broader markets, Tim, the big news, if you go through the Bloomberg terminal, the most read stories about Christine Lagarde and the ECB hiking rates for 10 straight times, about the latest data out of the Fed, about Disney, about Sam Bankman-Fried. What are you looking at, Tim?
I'm looking at the sky. I'm looking at UFOs.
UFOs.
Oh,
yeah.
They're not called that anymore, Tim.
I know, that's true. I have to make sure I get this
that's
right.
That's offensive, I think.
UAPs, unidentified anomalous phenomena. Romaine, do you believe in I'm not going to say it right, guys.
Yeah, be
UAPs.
careful.
Do you believe in UAPs?
You have to be sensitive. Haven't you take sensitivity training here?
I have not taken the UAP.
You can't offend these
yet.
otherworldly creatures. It'll probably take us all over. I mean, I don't know if I believe or not. I mean, is there any truth to this? Why are we talking about this, Tim?
Well, the interesting bit is that NASA appointed a research director to oversee its effort investigating sightings of these UAPs. But they're not going to name exactly who this is because of potential security.
Yes, exactly. Does he even exist?
Does he even exist? I think that's him in the suit right there. I guess, I mean, okay. Fine, whatever. I guess this is what NASA is designed to do. And I guess if things are out there, and who knows, they might be, you need somebody to maybe keep watch on their skies.
Well, they might be anomalous, and that would be a terrible thing.
Yeah.
I mean, is it X-Files we're looking at here, or something more like Resident Alien? We'd have to see. But you know where we won't be able to watch it is on ABC, potentially, unless you're an Nexstar customer, because it looks like ABC might be getting sold to Nexstar, or Chris Palmieri and the team just reporting that out now, that the whole network might get sold off by Disney, not just the local stations, which had been in the mix before. Now in the network and all of the local stations could be getting sold to Nexstar. We don't have a price or anything like that yet, but it wouldn't even be too difficult regulatory-wise.
Yeah, this news crossed the wire a little while ago, and again, it's based on, Bloomberg reporting, citing people familiar with the situation. But I think the idea that our reporting is basically saying these talks have already been held. So we've gone from just, okay, this might be an idea that Iger apparently is now actively shopping this around. Whether he gets the price that he wants, I guess that remains to be seen.
Yeah, Nexstar, we should note, according to people who we did not identify because the discussions aren't public, would only be interested in this at the right price, Simone. I think the question is what does this do to Disney in terms of assets that they do want to shed, in terms of legacy linear TV networks that they want to shed, and then perhaps the impact that has on the direct-to-consumer streaming division, which we know is really what the company's focusing on.
Well, and ultimately they're going to need content, right? It has to come from somewhere. So even if they want to become this, direct-to-consumer business, if you give away ABC, where do you get all your stuff that you're showing to consumers?
But also, we just had this blackout, right? Charter just had this huge tiff, let's say, with Disney. I don't want to call it a fight, but, there was a blackout there for several days, and it had to pay up to get these assets back. And does this mean now that Charter is going to be annoyed because suddenly Disney doesn't have ABC to offer, and how does that all work? It sounds complicated to me.
I mean, I think that's the big picture here, is the idea that in the future, these traditional media companies are just going to bypass the middle people, right? The Charters, the Comcasts, and go direct to consumer. Part of that deal did include Charter, of course, offering some of the company's direct to consumer offerings. We're going to keep talking about this throughout the program today. You guys have a great program. We have a great program. Let's check back in with each other in just under an hour when we all come back for Beyond the Bell. It happens weekdays at the U.S. market close. 4 p.m., we're going to take you through today's market close.
Continuing our coverage right here on the close, about 50 minutes until we get to the close of trading, at least going on in the public markets. We want to focus right now, though, on the private. No asset manager has really benefited more from the boom in private credit and private equity than BlackRock. It recently revamped, though, its nearly $300 billion alternatives business in an effort to capitalize on that growth. Edwin Conway was leading the alternatives unit. He's shifted into a new role, now heading a group devoted to venture capital, private equity, infrastructure, and growth equity investing. Pleased to say that Edwin joins us right now here in Studio 2 as BlackRock's global head of equity private markets. First of all, congratulations. I think the last time we spoke, you had a different title. This is a shift, not just in what you do, but really in, I think, the way BlackRock views the private capital space, and more importantly, how your clients view it.
No, it's absolutely right. I want to thank you, Romaine. Good to see you again. Hi, Bonnie.
Hi.
It is the notion that alternatives are alternative. We talked about it before. Mm-hmm. To us, it's no longer true. When you take a look at the majority of the allocations our clients are making today, From an institutional standpoint, we see at minimum in private markets today, our clients have an allocation of probably 20% up to 50. Wealth is probably more true. It's still in its infancy, but still a tremendous amount of demand and growth. So you're seeing anywhere from 2 to 5% of an allocation. But the reality is they're thinking about it in concert with their public market exposure. It's not one versus the other, it's one and the other. So as we take a much more holistic approach to the portfolio of the future, it has to involve private markets as a critical ingredient for success. So calling it alternative, we don't see that to be the case anymore. And so now what we've started to do is really pivot towards those private markets, the equity side, the debt side. And as we continue to bring the BlackRock muscle to this, as we believe, I think the advantage we've amassed over 35 years of BlackRock is the ability to source, particularly with corporates, this unique deal flow that we think in a world which is still confused, still uncertain, hopefully create differentiated alpha. So we're excited about the future, and probably one other new venture that I know we've mentioned in the past too, is our focus on transition capital.
Right.
Like this world is in transition. To us, that's one of the largest investment opportunity sets across our industry and for all of our clients.
Explain that a little bit more here. I mean, I think a lot of our viewers know what you mean, but when you talk about the opportunity for that in this particular environment here, is this something that is much more structural, meaning that this is more of a permanent sea change in business and the business cycle?
Yeah. It really is. And it comes down to, in many cases, customer preferences. You know, we're facing two extraordinary headwinds today. Like consumer spending has shifted. And it did so during the pandemic, where you had a huge demand for services that automatically flipped to goods. When that happened, that created tremendous supply chain challenges. And what you started to see is then the world react and inflation pick up as a result of these supply chains that just weren't able to cope with this new demand. Then you've seen an extraordinary shift in demographics. Aging population, baby boomers are retiring. So we have a fundamental shortage of labor now in the U.S. If you think about where we are today, and I'll get through to why transition makes sense. Pre-pandemic, per unemployed person in the U.S., you had 1.2 vacancies. Today, you've over 2. As you look at then the expected employment per month going forward and per year, we think the employment creation in the U.S. going forward is 0.5% post-pandemic versus 1.5% pre-pandemic. And so as we tied into maybe the early discussion of AI, technology, and technology is a critical part of every industry, every sector, but also the decarbonization of many of our industries.
Yes. Edwin, equity private markets, what are valuations like there now, and where are there opportunities? Where is the equity in the private markets?
Yeah, Vonnie, it's still high. And you saw, actually, for many of our clients, the denominator effect really hurting them. So the unfortunate thing in private markets year to date, you've seen in the first half, about 37% less capital deployed in the first half of this year versus the peak in 2021. 67% less realization than the peak in 2021, which goes back also to the question, is now the time to access the public markets? Are you starting to see more strategics so realizations happen? Because of the resetting in valuations, activity is picking up. The unfortunate thing is, though, you have 2.49 trillion in private equity sitting in dry powder. So what you will see is a dearth of capital come to play. Activity will pick up, hopefully in public and private, but valuations have started to more normalize. Things have gotten cheaper, but I would say from a PE standpoint, I would prefer being in the secondary market today than in the primary market, because at that point now that we can access, I would think, advantageous deal flow for our clients, you're accessing it at about a 15 to 18% discount at most recent NAVs, which have already come down.
So just to be clear, so you're finding that at least with price discovery in the secondary market, you think that's been more right-sized than in the primary market. Is that effectively what you're saying?
Well, I think it's certainly helping with price discovery, but what you've also seen is as clients are starting to think about the reallocation of capital, and this goes back to the transition conversation, they're thinking about infrastructure now in a much more profound way. Private credit, so there's a rebalancing happening amongst the asset classes, where the dominant asset classes of private equity and real estate in the past, it's not that it's going away, but there's a rebalancing towards a demand for yield, demand for diversification, and then this resilience they want to build in the portfolio because we're still living in pretty uncertain times.
Edwin, how does it really work? Because there aren't all of these wealthy clients coming in saying, you know, I want to jump on that decarbonisation train. I want to jump on that ESG train. These are all things that have been around for decades, right? These people want to ensure that they create wealth, and soon. So how do you jump away from these trends that are sort of out of trend anyway?
Yeah, it's interesting. We used to focus on asset classes in the past. Hasn't gone away, but themes are starting to permeate it through every single one of those asset classes. Decarbonisation, or transition as we would call it, is certainly one of those. And when I say that, if you think about the digitization of the world, everybody wants to be on the internet. Yet if you look at the US today, and we just did a venture with AT&T called Gigapower. We created Gigapower with a very storied US organization. Why? 46% of the US population has access to fiber. The rest do not. So I think about the investment opportunities. How do you bring more equality to each and every one in society in each and every state in the US? It allows us to enable internet access to millions of homes. That in itself is, in our mind, a great investment that is sustainable over periods of time, but allows for us to take advantage of a trend that's not going away because the digitization of this planet, this world, this society really is accelerating. I'd say the other thing we're seeing, even just with innovation, I think maybe it was on your show a day or two ago, Ascend Elements. So we do a lot of battery investing. Battery technology has been absolutely transformative. When you look at what Ascend Elements does, one of our clients' biggest concern, well, what happens when the battery stops working? It stops recharging and the utilization goes way down. Do you have landfills of battery? Well, the answer is no. What Ascend does, it takes the old battery, lithium ion, and recycles 98% of it and brings it back into production so the EV market continue to rise, but in a very cost-effective way. So I think, Vonnie, for the clients who are coming in on the wealth side, diversification that comes from like a Gigapower investment that we make, a growth or venture-like investment with Ascend Elements that provides a different type of return profile. But in our minds, independent of the uncertainty, actually across private markets and each one of these asset classes, there's a richness of opportunity set. You just have to work very hard to find it.
Fascinating conversation. I'm sure we'll be speaking to you again very, very soon, Edwin. Thank you for coming in. That's Edwin Conway, Global Head of Equity Private Markets at BlackRock. And coming up this hour, we'll have an exclusive interview with famed short seller Jim Chanos, why he told Congress that China poses grave financial and geopolitical threats.
Plus, I'm getting some insights into the factors driving the acceleration in investment in private markets. David Hunt, President and CEO of PGIM, also going to be joining the big show in the next hour. Stick with us. A lot more coverage coming up. This is Bloomberg. All right, welcome back to The Close. Let's find out what CEOs are thinking. Boston Consulting Group recently released its CEO Outlook. It found that almost 3/4 of chief executives expect macroeconomic uncertainties to be a key challenge. But at the same time, 79% are optimistic about their company's performance and 72% are planning cost reductions and other efficiencies. Rich Lesser is joining us right now. He's the global chair of the Boston Consulting Group, one of the big three, of course. And obviously the data you guys put out, these surveys, everyone pays attention to them. And it seems that CEOs, I mean, I know by nature they have to be optimistic, but they seem to be kind of maintaining that, I guess, rosy outlook.
So I do think part of being a CEO is to maintain a sense of optimism amidst all the turbulence in the world. But if you compare where we were a year ago, when people were worried about a world of either spiraling inflation or a severe recession, and you look where the world is today, and another great day on the market, but it's been a great year so far, I think that there is a sense that, you know, we are approaching a soft landing, still with risks, and that feels better. I just wrote a piece a couple days ago that was titled "The Hard Edges of a Soft Landing," and I do think we have to acknowledge that part of inflation coming down, part of a slow growth environment, is it's still hard to drive performance. There's going to be a lot of pressure on productivity, which was reflected in the survey, because wages are still outpacing inflation now, and you don't have pricing power to just pass it on to consumers. So that's a challenge, but overall it's a challenge against an optimistic backdrop.
But we've been talking a lot on this program about the so-called efficiencies. I mentioned it in the intro. And when I would look at the reports and your data and some other CEO survey data out there here, there's concerns about cost, but you don't necessarily hear as much concern just about pure revenue growth. Are you also hearing the same thing?
I think there's going to be more and more attention paid as people realize how much less pricing power they have to how to find the innovation, how to deepen customer relationships. AI is going to play a big role in that to be able to drive growth. And that was actually one of the main points I highlighted, that I think this focus on innovation is going to be a complement to the focus on productivity in a world where growth is tougher to find.
Rich, how are CEOs thinking about labor right now? Because it seems on the one hand, labor is very difficult to find, especially services labor is very, very difficult. Unions have some power and so on. On the other hand, it feels like the Fed is looking for layoffs and there needs to be more layoffs, and particularly the finance industry is laying off people left, right and center and right-sizing.
I actually think most companies made a call a year ago that they realized how much the human capital side was going to be a limitation to their future success, and they've been resistant to take on layoffs. And we've seen it in the data, we've seen it in unemployment rates. The good news is core inflation has dropped dramatically, in contrast to what people said, which is unless unemployment spikes up dramatically, we can't bring inflation down. We are largely bringing inflation down, and yes, because of fuel prices that went up in the last month. But overall, I think most companies are looking to avoid substantial layoffs, but they are searching for productivity. That's for sure, and AI is a part of that journey, as we're seeing. And productivity is certainly up, but you're saying that what the Fed is looking for, which is some kind of drop-off in the labor market, it may not materialize? Well, we've seen some. You know, the amount of open jobs has come down some. We've seen a moderation, a slight uptick in unemployment. I think what the Fed is learning, and we watch them learning, and they share that with us, is that the dramatic expectations for what we need in unemployment to bring inflation under control have proven not to be true. And I think most companies are recognizing that if they don't invest in human capital with the rate of change going on in the world, they're going to fall behind. It doesn't mean you don't search for productivity, but you don't just use cutting people as the way to hit your numbers in the next quarter. It's far more costly than it appears.
You mentioned AI a lot, and I'm told that you guys now have a partnership with Anthropic, right?
Yeah, that's the latest one.
The latest one. But I am curious because this is focused more on AI, kind of the safety around it, I guess the guardrails, if you will. And we just had all these tech CEOs yesterday. They went to that closed-door meeting with Chuck Schumer and other senators because we know at some point there's going to be legislation, regulation, how long that takes and what it looks like, who knows. But when you talk to these CEOs, they're kind of already moving forward with this kind of stuff.
Oh, I think so many CEOs. I mean, just for us. I think we've been in 1,000 senior executive workshops just in the last 8 months. We have more than 100 client engagements going on about how to embrace AI, and particularly now generative AI, and where you get real value from it. Because everybody reads this hype, but how do you get real value? How do you combine generative AI with predictive AI, and how do you do it responsibly? That is the question that is permeating so many executive suites right now.
Rich, we have to leave it there, but good luck at UN General Assembly Week. That is Rich Lesser, Global Chair at the Boston Consulting Group. From New York, this is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Interesting day for U.S. equity markets. Vani actually setting up for what's going to be their best day of the month. And that comes on the back of the economic data, which certainly mixed, but it seems to continue to show that this economy is resilient.
And you know what else is resilient? The U.S. capital markets, it would appear, because we had an IPO today. And we also have this talk now about Disney selling off ABC, the entire of its network of ABC and its local TV stations. And we have indices higher by, roughly 1% apiece.
Yeah, up about 1%. All of the major indices getting in on the action here on the day. And like I said, we look for these windows of opportunities, right, where things can come to market. It's not so much about just ARM, right? It's about the idea is, are the capital markets functioning in the way that people want them to function? And at least for today, they're getting some signals that that's the case.
Exactly. ARM now at 58.87, so up 15.4%.
A lot more coverage coming up here as we keep an eye on the public and the private markets. A conversation up next with Jim Chanos. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
This is the countdown to the close. I'm Scarlett Fu, joining Romaine Bostick. We know that Washington is scrutinizing China and wants to better understand the threat that the country may pose to the global financial system. So Congress called up famed short seller Jim Chanos, a longtime China bear. And in his prepared remarks, Chanos said, if China is unable to pivot its economic model, either due to reluctance or inability, it poses global risk. The question is whether China can ever wean itself from its debt-funded real estate investment while simultaneously keeping their economy afloat. Now, bad weather prevented Jim from making it to the House hearing earlier this week, but he has made his way into our studio today for an exclusive conversation. Thank you for coming in.
Thank you for having me.
And the weather cooperated this time.
The weather is beautiful in New York today.
All right, well, you say China's economic model, which is driven by investment, is all about growing GDP at almost any cost. The thing is, Xi Jinping, the Chinese president, isn't exactly playing by that playbook right now. He's intentionally downshifting, holding back from doing more to stimulate the economy. Do you understand Xi's ideology, and do you think it'll work?
Well, I think that Xi Jinping is a change from the leadership we saw prior to him coming in 2013. Previous leaders since Deng Xiaoping really put economic growth first and foremost. And with Xi Jinping, I think it is more about party ideology and things like national defense. It's a much more muscular China than we've seen in previous decades. And this raises sort of the global risk level of what happens if the economic model falters and we see some sort of other efforts, whether it's increased defense spending or foreign adventures, to distract the Chinese populace from what's going on with the economy.
Okay, we can get to that a little bit later on, but I want to talk about the cost of the economy for now. Do you have a sense of how bad China's credit losses could get? Because I've heard one estimate of up to 42% of GDP from 31% last year, not just in real estate, but across other sectors too, like technology, for instance.
Well, we saw this once before. When China entered the WTO in 2001, they had to clean up their banking system. Now, back then, the debts were mostly to state-owned enterprises. But when all was said and done, about 40% of the loans were bad. Now, that number would be horrific because China is so much more leveraged today than it was back then. I don't know. We don't have a number on what we think losses as a percent of GDP would be, but certainly that's in the ballpark, the numbers you quoted. In fact, if anything, that might be a little bit low. So it's a bad problem. And it's the real problem with the economic model, Scarlett, in that if you never write off the bad investments, right, your GDP is inflated because you're borrowing money to put up, another airport or another high-speed rail link that's uneconomic. And that resides ultimately in the banking system with the debt related to that. And so that's the inherent problem with the investment-driven economic model. Sooner or later, the diminishing returns on these investments begins to make a difference.
Do you think other people, though, have woken up to that? I mean, we're still talking about a nation that still has a lot of foreign direct investment despite some of the challenges as of late.
Well, I think people have figured out the risks. Well, when we turned bearish on China back in early 2010, I think the New York Times ran not one but two op-eds ridiculing the call. And so, you know, it was just after the Beijing Olympics, and China was unstoppable. And I think now people realize it's a little bit more accepted that this investment-driven model has real risks. So, look, I mean, China, we get tarred with the brush that we think China's going to be in smoking ruins, and it's not. No. It's going to have to downshift its economic growth, and it's going to have to make a transition from this model to a more traditional model if it's going to keep growing at a reasonable rate. And that's why we think the speed bumps that'll occur when they try to shift to a consumption or service-driven model will be more severe than people think.
It doesn't seem like much of a shift just yet, but I am curious with regards to Western investors, maybe dialing it back just a little bit here. Is that because of the economic model? Is that because of the economic decisions, or is it more tied to some of the political decisions and social decisions?
I think it's two things. I think you've hit it right on the head with the political risk, and tied in with that is governance risk, because Western investors have rediscovered the risks of the so-called VIE structure, which is the structure that Western investors have to use to invest in Chinese entities, because direct investment is basically prohibited. So we have the situation where if you buy stock in Alibaba or JD.com on the New York Stock Exchange, you're buying shares in a parent company sitting in the Caribbean, which has an economic agreement with the underlying businesses in the People's Republic. And if anything goes wrong, you have very little recourse to the assets inside the People's Republic.
So when anything goes wrong here, people look for a Fed put. They look for the Federal Reserve to ride to the rescue. What will it take for the Beijing put to kick in?
So I've always said that there's two things that Western investors count on in the last 10 years, that central banks will ease and China will stimulate, right? So every time we see a slowdown in growth, the call comes for China to spend more. The problem is you're just kicking the can down the road. And as I've said a couple of times, at some point the can kicks back. And if you have a bloated more and more debt in the banking system, more and more of the debt is being used to pay the interest on the old bad debt. And inevitably, that can't last.
It can't last, so that's why people do expect some kind of big bang stimulus. Would a big bang stimulus or the current drip feed of targeted measures that we're getting right now present a better opportunity for investors like you?
Well, again, we're not investors in China, so let me be clear.
But you could be betting against in different ways.
Oh, yeah, of course. And so I think that stimulus is expected. I think that stimulus does nothing but just, in effect, add to the debt problems. I mean, in effect, if you have investment, 40 to 50% of GDP every year, you're always stimulating. Literally, once you finish a building or a bridge or a rail project, you have to put up another one because the GDP drops off immediately once it's completed. And this is the inherent problem with the model. You just constantly have to be sticking a shovel in the ground. And sooner or later, the returns on the marginal project just don't justify the amount of capital put in.
Scarlett mentioned that you were supposed to testify at this House Select hearing. And we know that most of the Congress people, at least the ones at this particular hearing, are concerned about the economic linkages and the political linkages. The idea here that if the economy is weakening, as most outside investors seem to think it is, despite what the official numbers tell you, that this could exacerbate some of the political and, more importantly, some of the military issues that I think we're all fearing.
Yeah, I saw a report today that someone respectable pointed out that they thought Chinese defense spending was much higher than the sort of official $300 billion figure, that it was much closer to $1 trillion. And that would put its spending as percent of GDP higher than the U.S. So this is concerning certainly members of Congress and the administration, I think, as well as other countries in and around the area.
But what's concerning is that you can't give that number, and I don't know anyone outside of China that can give you a reliable number. on that or the economic data. I thought the whole entrance to the WTO, the embrace of some modicum of capitalism over there, was to create more transparency around what's really going on there. And yet I feel today, here in 2023, I probably know a little bit less about what's going on there than maybe what I knew, I don't know, 15 years ago.
Well, I think it gets back to your political risk question, which is I think the country has gotten less transparent in the last handful of years as Xi Jinping has increased his grip on power. And so towing the party line and making sure there's no bad news becomes paramount, as opposed to getting the amount of information that other investors need to make decisions.
You mentioned earlier China's foreign adventures. What do you think policymakers underestimate about the linkage between China's efforts to transition its economy, the challenges inherent in that, and its foreign adventures like saber rattling in Taiwan?
Well, I mean, I think that there's a myriad set of risks there. Just the general amount of defense spending. China's increasing its spending on its Navy, for example, to make a blue water Navy. And so all of these issues raise alarm bells for our allies in the area, Japan, Australia, Philippines. But what I worry about is a miscalculation. Right? Things happen in this world, and history tells us things can happen. And you get an incident where someone, fires a missile they shouldn't fire or whatever, and suddenly you have a crisis. And what we don't want is this Cold War, which seems to be growing, becoming a hot war. And as more and more planes and ships are in this congested area, sort of trying to claim sovereignty or exercise their right of passage, the chances of something bad happen. And I think that's something that everybody should worry about.
There's also a Cold War on trade and on economic relations between the two countries. Do you think Congressman Gallagher's committee and its work on the Chinese Communist Party will have any influence on the field of finance? Will this scrutiny lead to any changes in the way that Wall Street or financial people think or behave?
Well, I mean, I would like to echo some of the things that Jay Clayton said in his testimony. I think that one place to start would be reforming some of the rules that Western investors invest in and through Chinese instruments like the VIEs, accounting standards. I mean, that's sort of my world, and I feel comfortable in saying that should be tightened up. And I think that the whole idea that you're investing in shell companies that the Chinese, by the way, the Chinese courts do not recognize. It really is problematic, and I think that some reforms there would go a long way.
Yeah, I think Archegos found that out the hard way. I am curious, though, how much do you think China needs at this stage Western investment, external investment? You talk about this idea of them becoming more of a consumption economy, sort of turning inward, something Xi Jinping himself has said explicitly here. Is that realistic?
Well, the good news in all of this is that the cross-border risks right now are not huge, right, in terms of banking problems transmitting into Western financial institutions. It's basically equity and debt investments direct through pension funds and mutual funds, ETFs, and others. It's a couple $1 trillion. It's not. It would not be the end of the world. On the other hand, you'd notice it. I think that the real issues are going to be internal to China. That's what I'm more worried about, and how China deals with it internally without necessitating more Western direct investment. I think they can get by without more direct investment, but they like it.
They certainly like it here. But it gets to the idea that if there are problems there, everyone wants to know about the contagion risk. As much as it could potentially be contained, we're still talking about a behemoth of an economy, not just in terms of the dollar, the value of its in size, but also just its reach. I mean, the amount of investments that it's made in so many other emerging market nations throughout Africa and Latin America and Asia as well.
Commodity demand. Think about that. Yeah. And so. Of course. I mean, China is inextricably linked to the global economy and will be in ways we don't even, fathom yet if something should go really wrong. And I tried to keep my remarks to the committee really attuned to the economic model and the financial implications. But sure, I mean, there's broad ways in which China is connected both directly and indirectly to the global economy that would pose some risks.
Do you think the comparison of China to Japan that we saw 30 years ago, the slow bursting of the Japanese bubble, is that a valid comparison?
I think it is. I mean, I used to have a slide in one of my presentations. It'd say, "Who am I?" And I had this list of sort of attributes: directed economy, reliance on real estate markets. Right down the list. And people thought I was talking about China, and it was really Japan in 1989. And we know what happened, right? Japan kicked the can down the road for so long that it had 30 years of its hollowed out economy. And so there are some parallels. Obviously, there's lots of differences.
Yeah.
Japan's a Western democracy and had an open currency account would be the two biggest differences. But, in terms of the economic model, Japan was running investment around 30% for years. And finally, paid that price. And by the way, the Asian Tigers in the 90s had investment levels above 30% for about 4 or 5 years before that faded.
A lot of people are wondering whether we'll eventually see a decoupling of the Chinese economy with global financial markets. What do you think?
Well, I mean, the Chinese market has been a terrible place to invest for the last 10 to 20 years. The Chinese economy, if we believe the numbers, has quadrupled in size, and the equity markets are flat, maybe even down a little bit. And so it's been a terrible place for Western capitalists to invest, by and large. Obviously, there's some individual issues that have done well. But broadly speaking, you were well advised to avoid China for the last decade.
Yeah. All right. Jim Chanos, we're just getting started here. We have a lot more to discuss, including some of your short positions across the U.S. markets as well. Still ahead, we're counting you down to the closing bell. We have a market that is higher right now, Romain, on some better than expected economic data.
Yeah, still some hope here for that proverbial soft landing out of the latest economic data we got in the U.S. here, but this is still a global story. Yep. You saw what Christine Lagarde and the ECB had to say earlier this morning.
Dovish hike.
Yeah, dovish hike. We're not out of the woods yet. Stick with us. We'll be back in a moment. This is Bloomberg.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's CBOE, the exchange for the world stage.
This is the countdown to the close. Romain Bostic alongside Scarlett Fu with about 10 minutes until we get to the closing bells. A relatively strong day for the broader market. I think maybe even somewhat of a surprise given the economic data we've had this week, which seems to suggest that, well, there's resiliency, but maybe not enough.
There's resiliency, even though rates are going to stay higher for longer, and people seem to be okay with that. The S&P 500 above 4,500 once again. While we don't see this reflected in the indexes, ARM jumped as much as 22% in its trading debut. We have bonds lower, so yields higher. The two-year yield above 5% right now. Mm-hmm. And, of course, the euro weaker versus all the G10 currencies after a dovish hike out of the European Central Bank. Yeah. This is just as much a strong dollar story today, which is at a 3-month high against the euro after those retail sales and PPI numbers rose more than expected. And WTI remained at one point above getting closer to $91.
It is, right around there. I love to correct you on air, Scarlett Fu. We should point out that ARM shares right now hitting session highs, now up 23%.
Oh, there we go.
So a minor correction to 22, 23. But we won't quibble over a 1 percentage point there. But still, a very strong day here. A lot of people looking for some opening in the deal space. And, of course, a lot of hype right now around artificial intelligence and how that translates into corporate fundamentals. Jim Chanos still with us over at Chanos & Company to talk about, we spent a lot of time talking about China, but I do want to talk about kind of the hype mill right now around artificial intelligence. Certainly there's got to be some substance to what we've been hearing over the last few months.
Oh, I think of course there's substance. Mm-hmm. It's a technological advancement, and there will be companies that clearly benefit. But what everybody forgets is that in these leapfrogging moments for technology, there's as many losers as there are winners.
Well, let's talk about that because everyone's drawing comparisons to kind of the dot-com boom, right? We had kind of at the end of the 90s, early 2000s, the internet became this thing. And we know there are a lot of companies that never really made it out of the graveyard. Quite a few companies that are stars today, like Apple and Microsoft and the like, that sort of came of age in that space too. Are there not parallels now?
Well, there are, and to my point earlier is that when the internet came, any business that was in the business of selling something that was analog that became digital was in trouble. So think about companies like Eastman Kodak, right?
I covered that company well.
Film went to digital, and so their entire business model collapsed. And if we're seeing the same kind of situation with AI, there'll just be entire industries that are affected positively and negatively. And I think it's too early to tell. I mean, that's the thing. We're in that nirvana phase now where everything benefits from AI.
But everybody's throwing money at it right now.
Oh, that's Wall Street. You would expect everyone to throw money at a hot story. Come on.
Everyone's thrown money at Tesla for a number of years now. You've called it the it girl of the pandemic rally, post-pandemic rally as well. Is there an it girl of the AI bull market?
Oh, I suspect it's probably NVIDIA, which had the monster earnings back in May and again in August. So I would hesitate to say that there's something that's even more of an it girl for AI than NVIDIA. Might be out there. I don't know it though.
Okay, so NVIDIA is possibly the it girl at the moment, but the previous it girl, Tesla, you are still short on, but using options, yes?
We are. We're short the stock, and we just think it's ridiculously overvalued.
Right, but betting against it has not worked out yet. What do you think would prompt...
I've noticed.
Right. What do you think would prompt the market to be convinced of your take that Tesla is just a car company, nothing more?
Well, again, the Tesla story keeps changing, right? Every few months, the Tesla faithful trot out it's batteries, it's robo-taxis, now it's AI. And I'm a little bit bemused, having followed the company as long as we've been following it, that Tesla sort of admitted just recently in its full self-driving effort that it had been pursuing sort of the wrong avenue for 7 years, and that it's now going to a different type of software development for the next iteration of full self-driving beta. And so I'm just sort of wondering that this technological leader just told you that they basically were doing the wrong thing for 7 years. Now, my problem with that is they've been selling it as a product. They've been selling full self-driving since 2016. Doesn't exist. And so, this is, but this is a company that has gotten a wide berth from regulators in all facets of its.
It's gotten a wide berth from investors too, particularly amongst the retail set. And I am curious. I mean, as someone, as a short seller, and as someone who's been doing this for so long, you've seen how the execution of a short trade has changed. At least how, to a certain extent, it's become harder. Right? I mean, you can't necessarily do things as much out in the open as maybe you could have, I don't know, back in the WorldCom or Enron days. How much harder is it to execute that?
Well, I think you also have to watch your position sizing. We use options, as Scarlett indicated. The options market has gotten dramatically more liquid since 2019 than it's ever been. When I did Enron back in 2001, Enron's options were illiquid. It was an $80 billion market cap company, and the options market was fairly illiquid. Today, I have shorts on our books that are $2, $3, $4, $5 billion market cap companies where the options are more liquid than the shares. That's a big change.
That is a pretty big change. One of your big shorts since last year has been data centers. And I know that we talked a while ago, you were also bearish on commercial real estate, even before the March banking crisis. How are data centers similar to commercial real estate?
Well, data centers are basically seen as REITs. In fact, they are in REIT form for the most part. And so real estate investors have been gobbling them up recently because of AI, to get back to Romaine's issue. And so people are assuming just automatically that the legacy data centers will benefit from future AI demand. The problem is AI hastens the obsolescence of the old data centers. That is, the infrastructure that's in the guts of an old data center is not compatible with the new AI architectures. And you don't have to believe a short seller. You can see what Meta has written about this and other observers have talked about in terms of changing the architecture that the hyperscalers, Amazon, Google, and Microsoft have told you. This is going to be a whole new set of data centers that are needed for this architecture. And so the data centers trade at 80 to 100 times earnings, and the earnings aren't growing. And in some cases, the companies have negative free cash flow.
Yeah.
So it's not exactly a safe REIT. And we don't even think they're really real estate companies, Scarlett. We think they're technology service companies. And if you look at the financial statements, you would see that the returns on capital are really low, and they're heavily leveraged.
All right, Jim, we're going to have to leave it there. This was a great conversation. Appreciate you taking time for us here on The Close. Scarlett?
Yeah, we love seeing you. We welcome you back again to tell us about your next new position.
Thanks
Jim Chanos there over at Chanos & Company as we move closer to the closing bell. Stick with us. We're full market coverage coming up as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with our friends Tim Stenovic and Simone Foxman. Welcome to our audiences across all of our Bloomberg platforms, television, radio originals, and our partnership for those folks watching this on YouTube. Market screen across the screen here, Tim Stenovic. But before we dive into that, I do just want to bring some breaking news across the Bloomberg terminal a little while ago. Another big headline on Walt Disney Company, this time said to be cutting their target for Disney Plus streaming subscribers. Remember, a little bit earlier in our show, we told you about the news here that Disney is exploring a sale of its ABC News business, and now further reporting by our crack Bloomberg staff here, learning that Walt Disney expects to fall tens of millions of subscribers short of its last publicly stated 2024 target for the Disney Plus streaming service.
Okay, we had a great conversation with Chris Palmieri out in LA and David Weston here in our studio. Of course, David spending many years at Disney, many years as president of ABC and ABC Television, ABC News, I should say. And David made the point that when it comes to content, even if this deal were to happen, that it sort of depends on the structure of the deal when it comes to content from the network being included on streaming services. Because a big question I have is Bob Iger looks to, like he said, everything's on the table when it comes to potentially selling assets. How do those asset sales affect the content available in the in the streaming push that he's doing?
All right, hold that thought here for 1 second, Tim. We just want to get you the closing bell numbers here in New York. What has been a very positive day here. Maybe that's partly because of the economic data. Maybe it's partly because of the latest IPO to come to market. ARM having a big day, up more than 20%. The Dow Jones Industrial Average going to finish the day higher as well, up by about 1%. The S&P 500 closing above that 4,500 level, up about 0.8%. Similar move on a percentage basis for the NASDAQ Composite. And the outperformer on the day, believe it or not, the Russell 2000, higher by about 26 points or 1.4%.
I feel bad for Simone on days like this where she has to find decliners. In the S&P 500, 433 stocks in the green today, moving higher. Only 68 of those stocks in the S&P 500, Scarlett, in the red.
Yeah, more than 5 stocks higher for every one that is lower on the New York Stock Exchange. So when you look at the sector groups in the S&P 500, no surprise, everything is green. Banks, real estate investment trusts, and auto companies are leading the advances. They're each up by at least 1.5%. The laggards here are healthcare equipment companies. They're barely positive. Diversified financials, interestingly, given that banks are higher as a group. Diversified financials gaining about 0.2%, and pharma companies just barely eking out a gain as well.
Well, let's take a look at some of the gainers on the day today. Shares of ARM really popping toward the end of the day today. We were talking about them hovering around $58 a share. Look at that, closing up more than 24% to $63.59 on their first day of trading. The company raising $4.87 billion in the year's biggest IPO. We know what happened today. The big question is what happens in the next few weeks, what happens in the next few months. Is this going to be a catalyst for other IPOs from the companies that have been on the sidelines over the last couple of years? It's been the deepest, longest listing drought out since the financial crisis back in 2009. Let's take a look at shares of Disney with all of this breaking news happening late in the day. Shares still higher by 1.2%, despite the headline that Romaine gave you moments ago about adjusting its own forecast for its own streaming subscribers, up 1.2% on the day. This after Bloomberg News reported that the company's held exploratory talks about selling its ABC network and TV stations to local broadcaster Nexstar Media Group. That could bring in $4 billion, according to estimates from Bloomberg Intelligence.
And we should just point out real quickly, Nexstar also had a pretty good day, up more than 5% at the close.
So investors could optimistic that a deal could be beneficial for Nexstar too. You don't often see that, Romaine, when it comes to potential acquisitions, right? The company that's doing the buying sometimes gets punished when that news comes out. Again, nothing has been confirmed at this point, just reporting from our team. Let's talk about AT&T. Shares of the company finishing higher by 3% today. We heard from the company's CFO at the 2023 Bank of America Media Communications and Entertainment Conference. The company said it expects third quarter free cash flow in the $4.5 billion to $5 billion range and remains on track to generate full-year free cash flow of better than $16 billion. Investors certainly happy to hear that news.
Yeah, Tim, I have to point out that it was challenging to find some decliners today, but I did do it. But they're not down super much. HP, though, falling as much as 2.5%. Looks like it closed the day down 1.8% as Warren Buffett's Berkshire Hathaway disclosing that it had sold a close to $160 million stake. Remember, Berkshire Hathaway, one of the company's largest shareholders. So this adding to some of that disappointment around the outlook that it put out last month. Bloomberg Intelligence also saying that it reinforces rising concerns about the print maker's ability to stabilize and grow free cash flow in the immediate term. Also looking at shares of Robinhood, they were down a bit more earlier in the session, but now closing down about 0.5%. They're reporting monthly active users for August at 10.6 million, but that's down from July's 11 million, and Goldman Sachs says that's below expectations. Also, finally, looking at Visa, this is an interesting one. We got news after the close yesterday in a filing that the company is exploring ways to allow some of the largest banks, which are shareholders through a very unique share structure implemented pre-IPO, to sell their shares up to half their stakes. So the market's kind of digesting exactly what's happening here. We're seeing shares down a little over 2.5%, but Morgan Stanley says this may reduce uncertainty. Meanwhile, Jefferies says they expect to see some near-term skittishness.
Well, as far as what went on in the yield space, interesting moves higher in yields pretty much across the board here. Your two-year yield now moving a little bit deeper into that 5% territory here. And we should point out it was a pretty volatile day. Of course, anytime you have big economic data, you're going to see these big swings. But the net effect is a modest uptick in yields here at the close. 4 basis points on the 2-year, 3 basis points to 4 on the 5 and the 10-year, and your 20-year yield and 30-year right now also up about 3 to 4 points. So almost really, when I look at this now a little bit closer, almost a parallel shift here in the yield curve higher.
Yeah, definitely. All right. And of course, we talk about this idea that the case for a soft landing has been building. The Atlanta Fed GDP Now model now shows a move lower. They're now looking for a real third quarter GDP of 4.9%, so below that 5% mark versus 5.6%, a few weeks earlier. I wonder how you fold rising oil prices into that, right? Because that's just been going up and up.
All right, I just want to we actually are getting earnings, believe it or not.
Still?
Earnings season never ends, as Kitty Greifeld always likes to remind me. Adobe crossing the wire right now. Those numbers coming in, at least as far as their fiscal fourth quarter numbers, the adjusted EPS, 410 to 415. That's the guidance that they're giving, guidance for the fiscal fourth quarter, 410 to 415. Now, even the low end of that range is above the average of analyst estimates here. As far as their forecast for fourth quarter revenue, $4.98 billion. We'll just round it up to $5 billion. To $5.03 billion. And again, the lower end of that range is about on the nose, was what the street was looking for on average. Now, as far as the quarter that just passed, the fiscal third quarter here, also a beat on a couple of key metrics. Only minor beats, though. 409 on EPS, a minor beat there, and $4.89 billion in revenue, also a minor beat on that. Shares up about 2% here in after-hours trading.
Yeah, and what's interesting here is that analysts are going to be looking for some signals about how corporate budgets are looking. Corporate budgets have been tight, but do they see stabilization in the New Deal pipeline? We will hopefully get some more commentary on that as we hear from the executives later this afternoon.
We actually spoke to a president at Adobe yesterday. He was on our program. Adobe made a big announcement about Firefly and the corporate tools that they had available, the enterprise tools. What's that?
I used to love that show.
The show Firefly?
Yeah.
Well, look at what's on the screen right now, this generative fill that they can do, Romaine. We talk about AI and what companies are promising with AI.
Yeah.
They said they've been working on this for 10 years, and this is legit stuff here. Wow. I mean, they're literally generating images out of nothing. I mean,
it's really cool.
It actually is really cool. And there's some, they argue, serious economic implications for the company of doing something like this.
I feel like this is going to be available on the iPhone in like 2 years.
Yeah, it's a really good point. You can search for just people doing demos of this on TikTok. It's actually a thing.
You know, one thing to keep in mind when we do get to the conference call is whether the company says anything about Figma, which is looking to buy, but of course the EU has been stopping them and saying, wait, we got to look into whether this dampens competition. Yeah. And of course, this is a huge strategic purchase for Adobe.
I do want to go back to the Firefly thing, because I think we talked to the same person yesterday. And it's interesting, too, because there was always this idea here that most of these AI tools, at least in terms of being revenue generator, is going to be much more about selling to corporations, right? The idea that the applications there had much more profit potential. But Adobe had talked a lot here about kind of catering to just regular folks, if you will, the people that would use a Photoshop or Illustrator or something like that, and that there was actually a lot more opportunity there, at least in their view, than in some of the other spaces.
You know, but the challenge, I think, for the workforce, not so much for Adobe, is do people lose their jobs because they have all these tools at their disposal? Now, I will say the president of Digital Experience, who was, I think, on both TV and radio yesterday, didn't really answer this question.
No, he didn't answer.
Say.
No, I mean, look, we're all losing our jobs at some point, right?
Well,
I mean, that's just the way it works.
Someday.
But
I'm doing decline.
Reality check there.
But in all seriousness, I mean, that's still so far in the future. I mean, in terms of like en masse, when it starts to really replace things. I think most people say that's so far in the future. But you had all these executives in Washington yesterday. I mean, not necessarily the right executives, but you had some big executives there. And I mean, my main takeaway is that there really are no guardrails right now. I mean, companies could kind of do what they want, and by the time Congress catches up, well, they're going to be behind.
Yeah, I think catches up is the key phrase there, Romaine. Do you think they actually understand, the members of Congress understand what, should be regulated?
I seem to remember hearing from just 2 years ago where people were still trying to explain them, how Facebook sells ads, and that was just 2 years ago. So you think they understand AI?
Sir, we sell ads.
Yeah.
I think that's what Mark Zuckerberg said.
Guys,
that is going to do it.
Tubes, my friend.
That is going to do it for our cross-platform coverage. Coming up, we're going to be seeing you tomorrow, same time, same place. Don't go anywhere, though, because we got much more of our program coming up in a minute, and you guys are doing more on TV.
We are going to take a deeper dive into those earnings out of Adobe that just crossed the wire a little while ago. Stick with us here on Bloomberg Television. The close continues after the break. This is Bloomberg. The dearth of new equity issuance here in the U.S. finally seems to be broken. ARM, the chip designer that was controlled by SoftBank, coming to market today here in the U.S. Biggest IPO on a year-to-date basis, and it was a pretty good day. A sale at 51 overnight here and open around 56 and a close above 60. A pretty strong day here, not only for that company, but a lot of people really trying to extrapolate whether it ends up being, well, a harbinger of things to come for the broader market. Is enthusiasm out there? Is risk appetite out there? That still remains to be seen, but you're looking at a market that has put together a string of relatively decent gains. Modest gains, but somewhat sustainable to be sure, at least when you look at the breadth of what we've had over the last few days. Back at 4,500 for the S&P 500, back near 1,900 for the Russell 2000, and the NASDAQ now trying to break free from that 50-day moving average that's been like a little bit of a magnet, a force field, keeping keeping it tethered. Your 2-year yield, though, still remains elevated, as does much of the rest of the yield curve here. A focus on the economic data and, of course, a big focus on what's going to happen next week. The Fed begins that 2-day meeting on Tuesday with the big decision on Wednesday and, of course, the big press conference. No real changes expected in policy rates, but could be a big day here when we get the economic projections and, more importantly, whatever commentary Jay Powell thinks the market needs to hear. Of course, before we get to that, we're going to have to deal maybe with the potential spate of volatility tomorrow. Triple witching when we get those big options expirations all on the same day. Remember, volume on the market, at least across all the tapes, has been relatively subdued here, well below what we've seen on the average on a year-to-date basis. That's most likely going to change in a big way. We'll see whether that actually has an effect on market sentiment or this becomes more, Scarlett, just a technical event.
Yeah, and of course, we're also keeping an eye on earnings because they are still coming. Adobe just announced results about 10 minutes ago, and what we heard from the company is a third quarter beat, or I should say fiscal third quarter beat because it was for last quarter, more so on the bottom line than the top line. So let's bring in Anurag Rana. He is Bloomberg Intelligence Senior Technology Analyst. Anurag, give us your take on these results because we know that there was a lot of concern about the digital experience, which had been affected by weak business IT spending.
Yeah, I think, overall, we are encouraged by all the metrics in constant currency growth rates for all the three segments. And I don't see, anything that concerns me at this point. We'll see what they say on the call about next quarter's guidance and business activity. But so far, whatever we see, we like. It looks like we are seeing stabilization in IT spending at this point, which is something we saw both from Amazon and Microsoft.
And of course, there's a lot of talk about AI. The first line in the news release, or the second line, I should say, is we are unleashing a new era of AI-enhanced creativity around the world with innovations across our portfolio. And of course, we know that Firefly, the creative generative AI models, has sort of been priced. It's going to be cheaper than OpenAI. Anurag, what more do you expect the company to say on its earnings conference call on this?
I would love to see any numbers around initial adoption of some of these technologies or some of the use cases. Now, in the case of Adobe, I think it is one of the easiest beneficiary of generative AI because the company has a lot of data underlying, and that's kind of what I would say is commercial ready data that can be used to create images using AI prompts. A lot of other companies don't have that because they need to figure out how to train those models on customer data. But in this case, Adobe has a lot of pictures inside that can be utilized for generative AI.
So this gets us to this idea, though, here, too, about how accretive it can be to the business in terms of actual, not just revenue growth, but also profitability, Anurag.
So, Romain, think about it this way. If you are a graphic designer and you can create pictures on command, anything that you write and you really don't need to go to a graphic designing school to go out and create, images or be in a marketing team. You can just be a normal graduate and come out and do a lot of this stuff. So I think this does unleash the product to a brand new set of users that was not part of Adobe's TAM before that, or the total addressable market. And I think it really is going to help Adobe a lot more than other enterprise software companies that we cover.
Well, I guess it gets to my next question on Anurag, which is that when do we actually start to see that here? Because when I look at the forecast for the fourth quarter, I know this is kind of still early in terms of the AI tools and that, but when do we start to see a meaningful uptick in the guidance with regards to what they're going to make in the future?
See, think about it this way. If the product is available, widely available, let's say a quarter or 2 quarters away from now for everybody, they have a Creative Cloud base of about $11 billion. There is no logical reason why you shouldn't see an 8 to 10% or even a slightly higher uptake into that base because of the accelerated demand for some of these services. This is really, as I said, one of the easiest use cases of generative AI that I can see.
That being the case, Anurag, I'm curious what you think is going to happen with the Figma acquisition. We know that Adobe announced this back in September as a $20 billion deal. There was a lot of excitement around it, but then the EU, its antitrust unit, opened up an investigation not so long ago, and there's real questions about whether this will close. I mean, this is of pretty important strategic value at this point to Adobe, isn't it?
See, we have said this many times, we think Adobe is going to be fine with or without Figma. This company has a massive install base. It has a product that is loved by millions of people. I really don't think Figma is going to be that big of a game changer. A lot of other people disagree with me. I think Adobe will be fine without it also. I don't think that is going to be a big deal in my view.
Anurag Rana, the best of Bloomberg Intelligence out there in our Chicago bureau. A look at Adobe. Shares unchanged here in after hours trading with the beat for their most recent fiscal quarter and a raise in guidance for the quarter to come. All right, a lot more coming up here on the show. We're going to sit down with the new CEO of RingCentral, Tarek Robbiati. We're going to talk about AI and his vision for the future of the software company. That conversation coming up after the break. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Okay, ARM, of course, was the big talk of the day. The chip designer making its NASDAQ debut with shares trading well above its IPO price. It's also been 10 years since software company RingCentral celebrated its IPO. They had a big banner there outside of the stock exchange there. And they're now looking to blaze a new trail for connectivity using what else but artificial intelligence. And they have a new man to helm that strategy as they move forward. Tarek Robbiati joining us right now. He is the relatively new CEO of RingCentral, about 3 weeks into the job, and formerly he was the CFO over at Hewlett-Packard Enterprise. Great to have you here in the studio in New York.
Thanks for having me, Romain.
I know you're still early in the job and getting your feet wet here. This is a big transition. You're taking over for effectively the founder of the company. And I'm sure that has to be somewhat daunting that when you have somebody who has that kind of vision and now he says, I'm going to hand the baton to you and do what you can.
Yes, absolutely. Yeah. And it's wonderful and very deeply humbling and honoring to be in that position, to be the second ever CEO of RingCentral. And Vlad is iconic in the UCaaS space. He has really spearheaded unified communications well before anybody, and he created a fantastic company that is in a very select club. One where companies have more than $2.2 billion of recurring revenue annually, and it's truly remarkable. And I'm here to take the company to the next level. He's still around as executive chairman, and we intend to grow the company and scale it up much more than what it is today.
When we talk about sort of the type of technology that RingCentral has, the way it sort of allows everyone, all companies to connect and their employees to connect here, and I think about all the talk about artificial intelligence, it seems like that's kind of a match made in heaven. Did RingCentral already have a presence in that space?
Yes, we do. In fact, AI is something that has been in use in the industry for quite some time. But obviously, the series of circumstances have led to the entire world focusing on it since the beginning of calendar year 2023. And we've been using AI technology to really infuse a lot more intelligence in the way people and companies communicate. And so if you really think about contact center solutions, for example, they use already AI. And the big bet is that the use of AI technology will help drive significant increases in productivity and competitiveness to the next level. Think about it this way. If you think about a conversation, a lot of things can happen with AI before the conversation takes place. During the time the conversation takes place, as you analyze what's being said, you summarize it and so on, and after, a lot more after the conversation, because what AI can allow you to do is to really action tremendously what has been said, and you can think about many different things. You can think about spearheading a marketing campaign or decide to kick off a purchase order. Lots of opportunities exist in our field of unified communications to really turbocharge productivity and competitiveness through AI, and that's what I intend to do.
Those opportunities, though, require investment. I'm wondering what you see as spending on this AI capability, what that will look like in the next year versus the next 5 years.
Yes, I mean, it's early days to call the investment figure. We believe that we have great capabilities. We have hundreds of engineers at RingCentral that are capable of really building AI solution and enhancing what we already have. I'd say from our vantage point, our goal is to continue to grow the company and accelerate the growth, making sure that it remains healthy in doing so in terms of calories and bottom line profitability. I would say that our investments will be around people, some systems, but it's not going to be reinventing everything from scratch. What's really important is that we use tools and AI techniques that have existed for quite some time and put them to use, stitching them together to suit our case and use cases from our customers. That's what we intend to do.
Integrate them into your existing functionality, in other words.
Absolutely.
So
exactly that.
let me ask you about the rise in hybrid work. Obviously, that's something that helps a company like RingCentral, but now that everyone wants their employees to go back into the office, how are you seeing that play out in the utilization of your services?
Well, we obviously benefited from the pandemic, like many other players, when everybody was remote, right?
Yeah.
And the reality is that the world is coming back to normalcy, and so are we, by the way. We want to make sure that everybody in RingCentral comes back to the office as we invent new stuff. But the world is also different post-pandemic than what it used to be before the pandemic. The world is much more hybrid. There is a degree of flexibility expected by employees, which we respect. Well, we're going to be looking forward to bringing back people together to continue to invent and to strategize and solve complex problems. And that requires people to be together. And most importantly, a collaboration platform like RingCentral that allows people to really and truly communicate in an integrated fashion across video, messaging, phone, in any circumstances and in any place you are, you can use the same app to do so.
There's obviously a growth story here that investors are looking to. What about the cost story? Have you been forced to sort of take a closer look at the costs that the company has and change them?
Yeah, Romain, the way I look at this is like a fitness test. We all need to go to the gym and find ways to be lean and mean, and there's no difference around that now. And it's been done by the team at RingCentral. If you really analyze our performance, the team has done tremendous progress in expanding operating profit margins. Right now, we are guiding the market at about 18.5% operating profit margin for the end of this year.
Yeah.
And we feel very good about it. And we are on our way to continue to expand revenue and in doing so, grow operating profit.
Are you comfortable with staffing levels where they are right now?
I would say so. Broadly, I would say so. I will have to take a closer look, but I think my focus has always been, walk and chew gum, make sure that we can continue to grow and at the same time do so profitably. And if I see opportunities to be more efficient, I will take them.
As far as the revenue growth, do you think most of that's going to be organic? Are you actually considering any sort of M&A strategy?
First and foremost, organic growth is what's more important. And M&A is just a tool to turbocharge the growth story. Eventually, we may look at opportunities if they make sense strategically and financially on the M&A side.
Tarek, really appreciate you taking time for us, and congratulations on the new role. Got a lot of work ahead of you, and hopefully we can talk again. Tarek Robbiati there. He's the CEO of RingCentral. Here on The Close, a lot more coverage coming up, including an exclusive conversation with the head of PGIM, David Hunt, going to be joining us after the break. We're going to get his thoughts on a wide variety of topics. You don't want to miss that. This is Bloomberg. Welcome back to The Close here on Bloomberg. We're going to turn now to the growth of private markets. As investors seem more willing to move into less liquid assets, and asset managers have taken notice. David Hunt is the president and chief executive officer over at PGIM, which recently boosted its private alternatives business. David, great to have you here in the studio.
Thanks for having me. It's nice to be back.
I think the last few times we've spoken a lot about private markets because, quite frankly, that seems to be what clients are interested in right now. How has that evolved in terms of what specifically they're asking for?
It really has changed a lot, Romain, in the last year or two. I would say that we've had a bit of a front row seat at this. I mean, we're at $300 billion in AUM, AUA. We're probably one of the largest private alternative managers. But our footprint is a bit different in that we didn't start with private equity. We really started with real estate and much more of a bent toward private credit. And in fact, that's been what's growing really quickly for us. It's been real estate debt to some extent, infrastructure, and some of the more specialized forms of debt, including private credit. And what people, I think, don't appreciate is that this is not just a short-term phenomena. This is a change in how the economy is being financed. If you go back 10 years, Banks did all of this. Banks did lending to middle markets. Banks did infrastructure. Banks did project finance. They aren't putting money into these markets. And so institutional investors are stepping in and doing that, and it's being architected by asset managers such as ourselves.
But as sort of more clients become interested in this, of course, you have to come up with ideas for new ways to invest this money, new products, if you will. We were speaking a little bit earlier with Edwin Conway, who heads one of BlackRock's main divisions, and he kind of made the point, I mean, as I'm sure you know, alternatives in the old days was just that. It was real estate, commodities, and that was about it. Right. And now it's just so vast. And I know PGIM is now exploring new businesses, including something like reinsurance.
No, the alternatives definition really is much broader. And I think that if you look out 5 to 7 years at an institutional investor's portfolio, you're going to see a higher proportion in privates. You're going to see a higher proportion in privates that are debt-oriented, and you're going to see, I think, fundamentally much more variety in the types of strategies. So let's take the one that you mentioned, which I think is a great example, which is reinsurance. So obviously, PGIM owned by Prudential, we have benefited from
an insurance company.
We've benefited from being able to invest with insurance liabilities backing that for 50 years. In the last 10 years, a number of the private equity firms and others have sort of figured out this magic a little bit to get in. And so what we did announce last week was a big step forward and a new platform that we're developing together with Warburg Pincus to make reinsurance much more available to institutional investors.
So they have another option, in other words.
They do, and what's important, I think, about this reinsurance announcement that we made is that it's not just a transaction. We actually announced a platform. So while the transaction was the reinsurance of some Prudential liabilities, this is set up so that we can do many more types of those transactions, and we can do other third-party insurance companies. So while I'm delighted at the $10 billion in assets to be able to manage in that, this will, over the foreseeable future, grow to multiples of that as we get more and more reinsurance assets in. And this is a powerful growth driver for PGIM because, two of our big growth areas, one is this private alternatives we've talked about. This fuels a lot of that. And solutions. More and more clients are looking for ways that they can actually use multi-asset class to drive returns and diversification. And this is exactly what they're looking for.
Okay, multi-asset classes, driving returns. Your clients want increased allocations to private assets, private credit in your case. What is this increase coming at the expense of? What are they making room in their portfolio? What are they not buying? What are they not spending money on or putting money into in order to make room for private credit?
It's a great question, and I think there's a longer-term answer and a shorter-term answer to that. Because right now we're in this kind of strange period where many of our clients have obviously had all of their public securities marked down a lot as interest rates rose very rapidly. Their privates didn't come down so much, and we can argue about the legitimacy of that. But in any event, they didn't. So they have this problem where right now on their asset allocation, they're over-allocated to privates. So they've got to work themselves out of that a bit. In the very near term, they've actually taken money in the last 2 years out of public fixed income to fund a bunch of this. That is about to change. And I think the real bellwether for this is when we have assurance that the Fed has topped out and is beginning to move down. And when that happens, we're going to see an enormous shift back into public fixed income. And then where's the liquidity going to come from? Equities. Public equities have been in outflows among institutional investors for quite a long time, particularly active. And I think that probably continues.
But when we talk, if that ends up being true, is that because of the return differential? Is it because of the risk differential? What?
It's all of the above. I mean, I think it's partly that it's easier to have real alpha in the private markets. Many public equity managers, net of fees, have struggled to beat index funds. And they've run too close to the benchmark. And so in our strategies, we run, much higher concentration pieces and don't have that problem. But the industry overall has. So you've got better returns after fees,
right?
And you've got better diversification because the private markets operate on a different cycle.
Yeah. Well, you talk about the idea that, of course, when we get a sense of that the Fed has sort of ended its rate hiking cycle, that maybe ends up being the inflection point. I have to ask you about some of the economic data we've gotten. I mean, what do you make of it? Because I can look at that economic data and say, yeah, the Fed probably is done. I can look at that same economic data and make a case that the Fed is going to do more.
Yeah, it's very hard to know exactly when we've hit that. I think we can say with some assurity that they are a lot closer to the top. Whether we can completely call it or not, I don't know. But I think that the piece that the markets have wrong is that I think there's this view that somehow the Fed will kind of somewhat rapidly begin to come down. And our view is the economy is stronger than most people think, at least in the U.S. We can talk about some other. But in the U.S., it's stronger. The labor market is stronger. And that means that rates are going to stay higher for longer than the market's currently priced in. At least that's how we're positioned at the moment.
And with rates staying higher for longer, the dollar continuing to stay strong, what does that mean for the appeal of U.S. assets, whether it's in public markets or private markets from overseas? You travel the world. You talk to clients all over the world. What are they telling you?
They're saying that, gee, David, talk to us about the hedging costs, because they believe that the U.S. is going to outperform in terms of the kind of local currency alpha that they can create. But the dollar has been very strong. And so for the most part, they are hedging it back into euros or yen. And when those costs get very expensive, this whole trade really comes under some scrutiny. But at the moment, they're able to hedge that, and we are seeing many of our clients overweight to the U.S. at the moment.
You said earlier that investors are making room in their portfolios for private assets by not being in, say, public fixed income markets now, and down the road maybe public equities. The thing about public markets is they're liquid. What is your confidence that private assets, private credit, will be liquid when investors need them to be?
So liquidity is, I think, one of the most important issues in all of that, because, of course, these markets are not liquid. And indeed, part of the reason you're getting a spread over publics is you're getting paid for that illiquidity. And I think that people need to construct their portfolios knowing that that is true, and knowing that they won't be able to immediately get liquidity on that. Now, I will say that over time, there are ways of mitigating that. And one of the best examples of that is, the secondaries market. So, for many years, if you were in private equity and others, you were kind of in there for the duration. We have a private equity secondaries business that's actually extremely busy right now, because clearly a lot of people are saying, I have too much private equity, but I don't have enough money to allocate to new private equity. What's the solution to that? The secondaries market. And so we will see these become more liquid over time as other secondary markets grow up in real estate and in private credit.
I am curious, looking forward here, David, what's the big risk that you are keeping your eye on right now?
Well, I think that whenever you get in a situation like this where debt has grown pretty dramatically over the last 5 or 6 years, and even before that and before COVID, you saw pretty big rises and the kind of search for yield. So we're keeping our eye really clearly on areas where there's a lot of leverage. We are watching the CLO market closely. We are watching some of the private equity firms that have actually levered up, at the fund level as well as at the individual level. We're looking very closely at the bank loan market. So there are clearly areas where there's been a lot of leverage put in, and I think we all need to be a bit careful in those areas.
We always appreciate your candor. David Hunt is CEO and president of PGIM.
Thank you.
Thank you so much. All right, coming up, the economic and political ramifications of the United Auto Workers strike, which could come in the next few hours. The deadline is what, 12 a.m., right?
Yeah, midnight tonight here, and we've already hearing some commentary out of some of the car executives saying not a lot of progress has been made. That story coming up after the break. Stick with us. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Welcome back. We want to bring you some breaking news here on the close. Earnings for Lennar, the big home builder, crossing the wire just a little while ago. Their fiscal third quarter numbers coming in slightly above estimates here. $8.73 billion of revenue in the most recent quarter. The street was looking on average for about 8.5. Adjusted EPS coming in at $3.91. The street looking for $3.51. Here's the forecast going forward here. The company saying that in the fourth quarter, its fiscal fourth quarter, it actually sees deliveries of around 21,500 to 22,500 here. The lower end of that range is above the average of estimates. The company also saying that new orders themselves will be at 16,200 to 17,200. The lower end of that range slightly below the average of estimates on Wall Street here. But once again, we're talking about a company that has had a phenomenal run, at least for the stock price as well as for its order book, Scarlett, here at a time when a lot of people thought that the housing market would just tank.
Yeah, and instead there's plenty of demand, and the stock moving slightly lower in after hours trading at the moment. We are, of course, hours away from a possible union strike between the UAW and the three major automakers. This is an event that could bring shockwaves to the U.S. industry, U.S. auto industry, and of course the economy at large. Bloomberg Detroit Bureau Chief David Welsh joins us now. David, there has been some flurry of negotiations in this last day. We're getting some more details on some of the proposals as well, right?
That's right. General Motors put out a new proposal to the union today, offered 20% raises, which is up from the 18% they had previously offered, sweetened the retiree benefits for those who have an existing pension plan already. They didn't give in on pension for the younger workers, which is one thing the union really wants. They didn't give detail, but GM did say they offered some cost of living allowance, some inflation protection for workers. That's been another big issue. But it doesn't, so far we don't have any kind of release saying there's an agreement on this from the union, nor have they said that they're turning it down. But, it's been so heated the past few days that it's hard to believe this one is going to do it, but we'll see. We'll have to wait until about 10 p.m. tonight to get more direction from the union on where they want to go.
Well, I'm curious. I mean, we, of course, heard from Sean Fain with this live stream the other day here. So we have a general sense here of the strategy that the union plans to take, assuming they don't reach a deal tonight here. How much have we heard from the automotive executives themselves and how they will adjust should a strike take place?
Well, look, they're preparing for a strike in any way that they can. Mostly what they've said is they've just kind of voiced frustration with Sean Fain's rhetoric and the fact that they've put out what they believe are very rich offers, only to be denied by the union. I think the companies think that the union is just determined to go out here almost no matter what they put on the table, and that's partly because of this pension issue, this big sticking point. After 2007, any new hire got a 401k instead of a pension, and in the union's eyes, that was taken away. It was something they gave in the bad old years of the financial crisis and should come back, and the companies have no interest in doing that again. So that's where if there's going to be an impasse, that will be it.
Yeah, that seems to be a hard red line there for the unions. David, you've been covering Detroit, you've been covering the auto industry for more than 2 decades now. Does this impending strike feel different? Is what the union staying firm on different than what it has done in the past?
It definitely does, because first of all, we've got this moment here where we've got writer strikes and UPS, and you've got organizing drives at Starbucks and Amazon. This is a moment for labor these days. But this union leader, Sean Fain, comes out of a reformer movement, and they believe that past UAW presidents have given up too much to the companies and never went to get any of it back. And the union did make a lot of sacrifices when GM and Chrysler went bankrupt, giving up cost of living increases, giving up pensions and retiree health care for new workers. And they feel that the companies are very profitable now, and they've seen CEOs get 40% raises over the past 4 years, so why can't they get 40% raises as well? And look, there's some logic to some of these demands. Others, like 32-hour work week and pensions, would be financially very difficult for the car companies. That's why I say this pension issue is going to be so crucial, because if the union wants to stay out a long time to try to get that, the companies will really dig in, and we could be in for a very long strike. Yeah. If the issues were just over cost of living allowance and pay, they can come up. They can come to an agreement on that.
Just real quickly, David, I was actually a little surprised about the pension demands here, because that really is kind of taking us back in time. Was that just kind of put in there as a negotiating tactic, basically ask for way more than what you want, knowing that something's going to get cut anyway?
You know, that's something I thought all along, that's what they were going to do, is put that out there just so they could get good pay increases. But Sean Fain keeps talking about it. And in this current body of union workers, 60% of them were hired after 2007 and don't have that pension. Yeah. And this has to be ratified by more than 50% of the workers. So if you're promising something or saying you're going to get these pensions for 60% of the, let's call it the voter base, and you're getting them excited about it,
yeah,
it can't be a bargaining ploy. You're setting yourself up for some real trouble if you're the president of the union.
All right, David Welch, our man out in there in Detroit, keeping an eye here as we count down to midnight, where the UAW has threatened to begin that strike. And of course, this has some potential ramifications for the economy as well as for the president of the United States. The president has weighed in on this, trying to nudge both parties towards some sort of a deal. But quite frankly, the president's hands appear to be tied. Jordan Fabian, our White House reporter, joining us right now for a little bit more insight here as to how involved the Biden administration has been in these negotiations, Jordan.
So, Romaine, this is not like the freight rail dispute of last year where the president got involved and basically imposed a contract on the parties and made sure that the freight railroads kept running. The president doesn't have that legal option. So he's basically been on the sidelines while encouraging both the union and the auto executives to stay at the table and try and negotiate a contract that meets both sides' demands. And as David just laid out, the sides are still pretty far apart.
I know I tend to use Detroit as shorthand for the different automakers and where their plants are located. But the truth of the matter is that the manufacturing plants of these automakers run up and down the Midwest. So it's a lot more than just Michigan. It's Ohio as well. Talk us through what this means in terms of how Joe Biden and his team think about what they're going to say to potential voters across those states.
Yeah, the elephant in the room, as you point out, is that this is happening right as the 2024 presidential campaign is ramping up. Those states are going to be critical, Michigan especially, for President Biden's chances of winnings. And some estimates say that a prolonged strike could cause a recession in Michigan. So, whether the president appears to be on the side of the union or not, whether what side the voters are on, if the economy starts tanking in those key Rust Belt states, that could spell political trouble for the president. And not to mention this strike and this union contract dispute has big implications for the president's clean energy agenda. At stake is his push to move the country toward electric vehicles. That's been a point of discussion here, a point of tension between President Biden and the union as well.
Yeah, and this has already become a political issue. I mean, Jordan, I'm sure, as you know, we've already heard from former President Donald Trump, who right now is still the leading Republican candidate for president next year. And he's kind of made it clear here that he's going to make this a political wedge issue if he can.
That's right. He's sent out a number of statements saying, look, the President Biden's EV agenda is killing the auto industry. You're either with me or you're with the left. And look, there's going to be a lot of union members who blow that off. Union leadership has said they're not going to endorse Donald Trump. But that could appeal to some union members who voted for Trump last time around, and it could soften support for Biden. There could be union members who decide to stay home or don't go out and organize for the president, and he needs all the help he can get in the Midwest from unions to win this election.
All right, so Jordan, there's a couple of hours to go before this deadline really comes and goes. What is the White House likely to do? Does Gene Sperling now, is he in Detroit? Does he force everyone to come to the table? Does he sit at the negotiating table?
So the president, last we know, talked to the union president and the auto executives a few days ago. I would suspect there's going to be some outreach to the sides today, whether it's Gene Sperling or the president. But it's important to know Gene Sperling is not at the table. He's been basically on the sides trying to smooth out communications, trying to encourage them to stay and negotiate and to not have a work stoppage. But look, the union leadership appears determined to push its demands, and that could lead to a strike come midnight when the deadline expires.
All right, we're all keeping an eye on that. We should point out the UAW has already scheduled a press conference for 11 p.m., so before the actual deadline itself here. We'll keep an eye out on this. Jordan Fabian, our man in Washington, and of course a full team out there in Michigan, keeping an eye here on what could be one of the more consequential strikes that we've had here in the U.S. in at least the last 5 years. Still ahead, we're going to set you up here for what to watch tomorrow on Friday. Yes, thank God it's almost Friday. This is Bloomberg. Welcome back to The Close. Let's set you up for what the markets will have their eye on Friday. And we start Friday in China, which is just a few hours away. A big dump of data on their economy.
Retail sales, industrial production, home prices, the jobless rate. The government's not even giving the jobless rate for youths anymore because it's gotten to a level where everyone just is, it's mind-bogglingly high.
Yeah, it'll be interesting to see what it says. Because remember, the last big batch of data we got wasn't necessarily good. I guess if you remove some of the bad data, then I guess it all ends up being good. I don't know. We're also going to keep an eye, of course, on the UAW strike, the big auto workers union set to strike at midnight tonight, but they've already scheduled a press conference for 11 p.m. Eastern time.
They're going to talk about what the plan is, how they're going to move forward with strikes, these targeted strategic strikes across the different manufacturing plants.
More economic data in the U.S. tomorrow, including the University of Michigan consumer sentiment data.
Yeah, a lot of eyes will be focused on the expected inflation expectations because that'll give us a sense of what the Fed's going to do going forward.
And it could be a busy day for option traders tomorrow. Triple witching here in the U.S. market. Usually see a pickup in volume. That does it for us here on Bloomberg Markets to Close. Appreciate you watching us. We'll be back tomorrow. Balance of Power is up next.
Leading to a 25 basis point rate hike. That was ECB President Christine Lagarde in Frankfurt, Germany. This is Bloomberg's The Open. I'm Jonathan Ferro. And here's your market 10 minutes into the session stateside. Equities up by 0.5% on the S&P 500. On the Nasdaq drifting higher as well. Some outperformance on the Russell. A ton of US data we need to talk about. Over in Europe, in the bond market, yields lower. A bond market rally. The 2-year in Germany down by about a basis point. On the 10-year down about 6. In the FX market off the back of that, the euro a whole lot weaker against a stronger dollar. A break of 107, 106.82. We're negative there by 0.5%. President Lagarde did not want to commit to a pause, but there was a strong suggestion the ECB is doing just that.
Based on our current assessment, we consider that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target.
Let's get over to Frankfurt, Germany with Maria today. Maria, what stood out for you?
Well, Jonathan, as you say, it is a rate hike. It was interesting to hear from the head of the ECB say, I don't want you to think the debate was antagonistic, but it was obviously not a consensus decision. And then she pointed to the solid majority. To me, I thought it was very interesting going into this meeting, as you say. The market really picked up on this line, which said, of course, if you have interest rates at a, quote, sufficiently long level for a sufficient duration, you could have a substantial contribution to a timely return to inflation to the 2% that was seen potentially as maybe this is it. Having said that, and again, this really stood out to me, she was given 2 opportunities to put this debate to rest. Is this the final hike from the European Central Bank? One, she was asked directly, is this the end of it? And she cited a theater play where she says, well, a door can be open or closed, but that is a theater play and this is life. And then secondly, she was asked, have we reached that peak level when it comes to rates? And she said the European Central Bank could not determine that. So to me, that was striking, that perhaps given that opportunity to perhaps settle this debate, she did not. Again, she also said from now on, this emphasis on the data dependency continues to stay. The central bank, obviously, who has to deal with inflation. We know there were changes made to both the forecast that would point to higher inflation and lower growth. She was asked about stagflation. She was asked about recession. But obviously, at this point, this was not ahead of the European Central Bank that wanted to talk too much down the economy, but also clearly signal that, of course, the downside risks are obvious and they're palpable for this economy.
The theatre is supposed to be entertaining. There was certainly nothing entertaining about that news conference. Maria, thank you. Joining us now is Invesco's Alessio De Longis, Winnie Caesar of Credit Sites. Winnie, you were looking for a rate hike. We got a rate hike. What's next?
So I think that now you do have to have a base case of potentially a pause. We had anticipated another rate hike after this. When you look at Eurozone inflation, it is still objectively too high, even on a 3-month annualized basis, well over 3% if you average things out. And even though the economy is slowing, and as Lagarde pointed out, we're kind of in the midst of that now, those inflation levels really do need to continue to come down. So I would say a base case of a pause, but we do think that another hike is within the realm of possibility.
Alessio, a strong suggestion will get a pause. She read this one quote in the statement about 5 times. No harm to read it once again. The Governing Council considers the key ECB interest rate have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to target. Alessio, did that statement sound like a pause to you?
It's meant to suggest a pause, but I think she did the right thing in not committing to it. While my base case is that rates are going to stay here over the next 6 months, that's my base case. But I do think that the risks, if anything, are tilted towards another rate hike, not towards an immediate cut in the next 6 or even 12 months. Yes, the economy is weakening, but it was a split decision. It was a debate. But if you really look at an unequivocal interpretation of the mandate, you can't raise your inflation forecast for every single year of the horizon down to 2025 and not raise interest rates. And I think given what commodity prices are doing, what food prices are doing, and you alluded to it, the strength that we're still seeing in the U.S. economic data, which we know will tend to lead, as they've done in this cycle, also European data, the risks are tilted that this cycle is not done.
Let's talk about that strength in the U.S. data. 14 minutes into the session, equities are higher here. Mike McKee, upside surprise on U.S. retail sales.
However, John, we had some revisions to July that make the news not quite as good, but it does show the consumer hanging in there. Now, remember, retail sales are calculated by dollar volume, so no surprise we saw a big rise in gasoline stations, up 5.2%. We'll talk more about that in a second. But the rest kind of looks like back to school. Clothing store sales strong, electronics store sales strong. Interesting thing, real weakness in furniture stores. We have seen problems in the real estate business, so that probably accounts for that. Something like 5 out of the last 6 months, we've seen declines at furniture stores. Now, let's make something out of the gasoline story here. The question that everybody's going to ask is, how's this going to affect us going forward? And as you can see, until the pandemic, gasoline sales and non-gasoline sales, gasoline prices, non-gasoline sales sort of went together. Then all of a sudden, we started spending a lot on both. And you can see the yellow lines there basically point to the times when gasoline prices rose a little bit and we saw retail sales ex-gas fall a little bit, or at least flatten out. But that's not what's happening on the far right-hand side. How long are we going to see gasoline prices going up without retail sales being affected? That is going to be the key question for the Fed in terms of how the economy is hanging in there. Other numbers out today, PPI does go up. It's an oil price story as well. 60% of the rise in goods prices during the month attributable to oil, according to the government. Initial jobless claims barely moving. And continuing claims, they only go up by 4,000. So at this point, the labor market remains strong. Americans are still spending money, but gasoline looms as a black cloud on the horizon.
Mike McKee, thank you, sir. Energy a feature of the conversation of the ECB in a higher inflation outlook. Mike McKee nailed it there as well. Brent crude, 93. WTI, 89. Alessio, you like stocks, you like risk, you like equities over bonds. You think Goldilocks, and that theme is here to stay into year end. Do you think this move here in crude could disrupt that?
This moving crude at the moment, I think, is actually validating that to some extent. You're not expected to see rising commodity prices when overall global economic activity is that weak. I think commodity prices tend to be more of a, especially energy, more of a coincident indicator of growth, while stocks tend to lead. So commodity prices here are validating a little bit of the move. Now, is that the perfect Goldilocks scenario? Well, not so much if you remain on the verge of raising interest rates at every meeting, but if it's actually eliminating the spectrum of the imminent recession. I think for risk assets, credit, and stocks at this stage, the ability to lower the probability of a recession further out into the future is essential, and that's what's supportive of risk here.
Winnie, is $93 Brent reflection of good things or a recipe for bad things?
I think that I would thread the needle a bit there. You know, we do have to consider what has driven crude over the past week or so, and that has been a reiteration of supply cuts. And we have to look through that a little bit in terms of central bank policy, as the Fed and other central banks are cognizant of commodity price increases, but not necessarily trying to manage their inflation mandate to those headline moves. I think that there's some mixed factors here. Heading into the fall, we had anticipated the consumer to start to slow down. There are a number of different factors, from student loan repayments to that drawdown of excess savings. It is encouraging to see that commodity prices are remaining stable, but they're also quite negative for the consumer more broadly, as you see that increase in energy prices pushing away from the ability to have incremental discretionary spend. So I think it's a little bit more of a nuanced and mixed picture rather than just commodity prices, energy prices higher equals good economy.
Commodity prices are up, the labour market's still tight, unit labour costs might be climbing as well, particularly in Detroit. It's going to be a fascinating day today. The data's behind us, US retail sales, jobless claims, a central bank decision behind us as well. In front of us, a big deadline for a deal between the UAW and Detroit's Big Three. The deal nowhere in sight, with less than 15 hours until the deadline. AMH joins us from DC for more. Morning, Anne-Marie.
Good morning, Jonathan. And that's right. We do not have a deal just yet. And come 11:59 p.m. this evening, that contract ends. And what we heard from Shawn Fain yesterday, the head of the UAW, really in his clearest signal yet, saying that there will be strikes, and unprecedented at all three of these big auto companies, Stellantis, Ford, and GM. Just they're going to be targeting specific plants, Jonathan. This puts the president in a very difficult position. We have seen a number of labor issues come to him in the Oval Office. What the president likes to do is be out front with the rhetoric, supporting labor unions. He claims he's the most pro-union president in history. At the same time, behind the scenes, we do know that the president would like to stop a strike. This is usually how he's operated, whether it was the ports or the freight railroad unions, Jonathan. We do know that a number of individuals in the White House are tasked to deal with this. Gene Sperling is the liaison. We know that Julie Su, the acting labor secretary, is monitoring it. And we heard from Jared Bernstein yesterday, his chief economist. He said they are encouraging everyone to stay at the table. Jonathan, as a president, it's not just an issue for today. This could potentially mean the president losing blue-collar workers that could vote for him next November.
Big story for us today, tonight, and tomorrow. AMH in Washington, thank you. This is what's on the table right now. UAW, big union, wants a 36% raise. This is the offer, according to President Fain. Ford proposed 20% raises over 4 years. GM offered 18%, Stellantis 17.5%. Winnie, a question that's dominated this program now for the best part of 2 weeks. Do you see this as the dying embers of a hot labour market, or something we've got to live with for the next few years?
Well, I think that there are definitely a lot of real problems in terms of labor supply that are probably going to keep labor markets tighter for longer than a lot of people anticipated heading into the pandemic and the kind of erosion in participation. Now, that being said, recent economic data and recent payrolls data have actually shown some upticks in terms of labor participation. So I'm not necessarily convinced that this is kind of the dying embers of a hot labor market, but I do think that we are starting to reach an inflection point that should put the labor market into a little bit more of a balanced state.
Alessio, what does this mean for the viability, sustainability of some of these industries? I'm not just thinking about autos, I'm thinking about airlines as well. Do you think really they can pass on these costs to consumers, or ultimately they've got to eat this and margins are getting hit?
I think margins will eventually have to suffer here. I think the point that was made on the rising labor participation and some of the relaxation on the costs will be more evident over time. The increases in the labor participation rate are quite meaningful, and they're not only indicative of better supply, but also overall optimism among consumers. But ultimately, I think that it will not be possible to keep passing costs onto end prices this way, and margins will have to take a hit. While bullish, as we said, on the overall economic picture, margins are still wide, and given how tight labor markets are, and we are towards the end of the cycle, a compression in profit margins is the longer path ahead.
Alessio, thank you, sir. Alessio De Longis and Winnie Caesar on three important stories there. The ECB, the latest data out of the United States, and that negotiation between UAW and Detroit's big manufacturers, the big auto manufacturers. Your market right now looks like this. 23 minutes into the session, equities doing okay, up by 0.4% on the S&P 500, higher here by 0.2 on the Nasdaq 100, and some outperformance there on a Russell. From New York, your trading diary up next.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
25 minutes into the session, stocks just about positive across the board here. The equity market on the S&P just about positive by 0.4%. That's the price action. Let's take a sneak peek of the calendar, the week ahead. President Biden discussing Bidenomics at 2:45 Eastern. At midnight, the UAW strike deadline. Next week on Tuesday, President Biden in New York for the UN General Assembly. Wednesday, we get a Fed rate decision and Chairman Powell news conference. On Thursday, another round of jobless claims and existing home sales. The data so far this week, so far, so good stateside. Let's see if that changes. From New York, that is it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
I'm head chef at the Mariah, an unbelievable cultural oasis. People from all over the world get to experience fine dining, arts, and events here. And it's my home, a reflection of Saudi's culture and beauty.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Shonali Bassick at Bloomberg's world headquarters in New York. Ed Ludlow is off today, and Caroline Hyde is live at the NASDAQ. This is Bloomberg Technology. Coming up, we are live from NASDAQ to bring you full coverage of the ARM IPO as it makes its trading debut as the biggest IPO of the year. More ahead. And as ARM makes its trading debut, we'll push ahead to the other companies lining up to go public during our venture capital spotlight. We'll Also, look at the prospects and use case for digital dollars with former head of the CFTC, Chris Giancarlo. All that and more coming up next. Now, before we head over to the NASDAQ, where Caroline Hyde is standing by with a very senior executive, we are also getting indications that ARM may open shortly in the next 10 to 15 minutes. We are getting price indications of about $56, give or take $56.30. That would give the firm a valuation of about $60 billion. Let's see where we head, though, Caroline. We are heading over now to Caroline and Karen Snow, Senior VP and Global Head of Listings over at NASDAQ.
Sonali, thank you so much. And yes, I am sat here with Karen, and wow, we're back at it. We've almost forgotten how the IPOs work.
It's very exciting.
How important is this ARM listing for the rest of the companies that now stand to list? I think you were saying, 157 are there waiting to come to the market.
Mm-hmm. It's important. It needs to trade well. I think that this is a moment in time that everyone is really paying attention. The markets have been open for great companies for some time now when you look at the VIX and the secondary market and what we're seeing in the private markets. But it's really been on the supply side. Mm-hmm. And ARM is really set to unlock that.
What's so interesting about ARM is how idiosyncratic it is, or not, because many want this to be a bellwether. It's in the tipping point of AI, but also China anxiety. But what's so interesting is it's only a little free float, less than 10%. How easy or hard is it, therefore, to square up demand and supply at this moment? Is anyone going to want to be a seller? What's happening behind the scenes?
Yeah, well, that is why it's taking a little bit of time to open. It's really important to get the opening cross right. And one of the things that we do is we provide technology to the person opening the stock, and that's JP Morgan in this case. It's called the stabilization agent. And we've turned it into more of a science than an art. There still is an art, though. And you want enough buyers and sellers in that opening cross and to price the opening at a level that it'll trade well.
When you have that sort of technology, is that what wooing the likes of ARM, the likes of Instacart are looking to come with the NASDAQ as well? How do you set yourself apart from some of the other exchanges in this moment?
Right. Well, it is a part of it, I would say. We do find that the underwriters have more information, and that's really helpful to them. But there are other factors, obviously. I would say brand alignment is really important. The fact that we have own and operate our differentiated services. So we really build relationships with our companies throughout their life cycle.
At the moment, the pushes and the pulls of deciding to go public. In general, I mean, I cast my mind back to when ARM first went public back in the 90s. There were a lot more companies that were public at that point. There's been this sort of desire to be away from the fiduciary duties that you have to shareholders, the costs. Yes. How does it look as a company looking to go public at the moment? Is it desirable?
We would say so. And we do a lot of work with the SEC and advocacy work on behalf of our issuers, really around that, because our objective is to keep we want high-quality companies coming, but we want to focus on the issues that are really important, and we want the cost to remain reasonable for companies.
To that end, so when they're looking at compliance costs, they're looking at volatility more broadly in the market. You said that looks pretty good at the moment, VIX remaining low. What, therefore, could be the catalysts into 2024? When are we going to see windows open and close, do you think?
Yeah, well, I think ARM is likely to open a window here. And I think a lot of companies are ready to go public. Q4 will probably be a lot more interesting. Mm-hmm. And a lot of companies want to go in the first half of 24, really getting ahead of the election.
Okay, so there's sort of political risk within that. At this moment, there's geopolitical risk. And it's interesting that, of course, ARM has exposure to China. You are head of global listings. How are you seeing the overall pushes and pulls of the global narrative right now?
Yeah. Well, there's a lot of interest from global companies, a lot of interest from Chinese companies listing in the U.S., Latin America, EMEA. The market's really open in the United States, and it's very recognized.
I mean, the LSE recognizes this at this moment, because it's a bitter pill for the London Stock Exchange to swallow today that they didn't manage to woo ARM there, given it's a UK-based company. But I'm interested, you say China and companies still want to come here. Are they not worried in any way about the closing of investor base to China, particularly in this current political environment?
Yeah, I would just say it's a tricky time, but I think everyone recognizes that the U.S. markets are the most liquid, and everyone has to consider them when they're going public, regardless of where they are in the world.
When we're looking at the companies that could come after in the next week or so, the Instacarts, the Clayviews, I'm interested in what is the recipe? Is a company having to demonstrate profit growth, having to demonstrate revenue growth to be able to access the market right now?
I would say yes to both of those, and they also have to be priced at a valuation that accommodates for that growth or not.
Mm-hmm. What about the overall desire, it feels like, of Masayoshi Son himself not wanting to go to the very top of a range he could have done?
Mm-hmm.
Did that speak to wanting to ensure that this share pop? And then what is the perfect price point, therefore? How do you see that art rather than science?
Yeah. I think his view is long-term, right? It's the right thing to do for the long term. And I think you'll find that investors love to, what we call it, get a little bit of a kiss. And that not every dollar that could have been taken is taken by the company. And ARM, of course, is thinking about this for the long haul.
In many ways, ARM has gone against the grain. They've had a democratization of the banks in the way in which they've been underwritten. But they've also ensured that there are those linchpin investors, the Apples, the TSMCs, the Intels who have bought up this stock. Does that make it a recipe for others to try and follow suit in that way? How difficult is it to replicate?
Well, there's a lot of different factors that go into a company's decision and how they put their book together, who their partners are. There's no one recipe that works for everybody, is what I would say. It really depends on the company, the advice that they're getting, and the decisions that they decide to make around that.
And interesting, of course, ARM is very much a B2B play. We're going to see some more B2C names. Retail investors become important at that moment. We think back to the meme stock crazes and the heady days of 2021. Will the retail investor be as crucial going into this next era of IPO opening?
Yeah, I wouldn't say that they're crucial, but what is important to recognize about the retail investor is they weren't an important part necessarily for a long period of time. They've become much more active. And I think it's exciting, and it does democratize the process, and everyone's able to participate. And so many more people got educated or took the time to get educated about the public markets and what that can really mean about your overall wealth.
Karen Snow, it's been so wonderful. You're hosting us here. Thank you very much indeed.
Thank you. It's great to have you.
VP, of course, head of global listings right here at the NASDAQ. Shonali, back to you.
That's Bloomberg's Caroline Hyde and Karen Snow, Senior VP and Global Head of Listings at NASDAQ. Thank you both. Now let's turn to our own Bloomberg intelligence analyst, Kunjan Sobhani, for more on today's ARM listing. What's interesting to me is that if you look at the price indications at about $56 per share, that implies a valuation about $60 billion. Does ARM have a growth rate that justifies that type of a price tag?
Well, not in the near term, but definitely in the long term. The valuation implies that investors are underwriting the long-term growth that it is expected to achieve from the fast-growing markets of data center, AI, and automotive, where the company is just getting started, versus where the company...
We actually are going to go to the ARM Holdings actual price for a second before we get back to you on the valuation, because we are getting ARM trading live at $56.10 a share. That is more than $5 above its IPO price. There is your IPO pop that you're seeing for ARM Holdings. Remember, this is a fairly thin float that you were seeing for ARM, so it did take a couple of hours to get the first trade moving for the underwriters and stabilization agent to make sure that the book was built just in time, and it is just about as smooth a day you could have for an IPO in a year where we've had virtually no IPOs. At $56.10 a share, you are looking at a company that is worth about $60 billion. That is about $59.9 billion in terms of valuation for ARM. We're going to turn now to Bloomberg's Abigail Doolittle to put this into perspective for us as we look for a landmark day this year for ARM and the IPO market.
Absolutely, Shonali. And we do have a nice pop here for ARM right now, trading higher by about 9.4%, of course, priced at $51. There was the possibility that they were going to price it at $52, $53, $54, but CEO Matsuoka-san wanted to make sure that they weren't too greedy, and it seems like he and the bankers did a good job. Right now, 10% above, raising the valuation on the actual IPO price of $51 at $54.5 billion. And of course, this is the biggest IPO of the year. And the reason that matters is because back in last year, there was roughly $179 billion raised through the public markets. This year, or the year prior to that, 630. There's been a drought this year. So the big question is this IPO, will it stay successful through the close? Right now, it looks very positive. Is it going to provide the support for Instacart next week, along with Clavayo? And more importantly, Shonali, going into next year, 2024, is it going to create what investors, companies, bankers want to see relative to having the confidence that some big tech IPOs can go? Of course, we've had the setting over the last 12 months of rising rates, inflation. That makes some of these growth stocks, riskier IPOs, maybe less attractive. So again, right now we are looking at a positive opening here for ARM Holdings, up 9.8%, an impressive IPO start right here on the day.
Certainly about 10%. That is a very healthy little pop you get there from the likes of Goldman, JP Morgan, Mizuho, all underwriting the deal alongside Barclays and the 20-some other banks involved in the deal. We're going to turn back now to Kunjan Sobhani of Bloomberg Intelligence to talk more about the valuation here, because you are looking at a company at $60 billion on its first day in public markets after its ownership of after its SoftBank ownership, and that implies a 22.4 times multiple to its trailing sales. What does that mean to you?
I mean, this is definitely in the premium, and along with the semi-design IP peers and sort of the AI companies like NVIDIA. And like I was saying, it seems the investors are underwriting the future growth coming from these markets rather than the current revenue composition, which is heavily based on smartphone and consumer electronics.
It's also a good day. Let's talk about that. It's a good day in the markets, Kunjan. And so they're getting a little lucky here. They have relative calm. There was no crazy CPI print yesterday. Retail sales kept the market relatively calm. The VIX is low, but there are a lot of risks on the horizon. If you're a new investor looking to ARM, what are those risks that you should really be aware of impacting this valuation that we see today?
Yeah, so in the near term, like I said, because the revenue composition is heavily relied on the smartphone, and we know that smartphone market is going through a slump right now. So as they come out for the near-term quarters, investors will have to be patient and face for some hurdles coming in the near term, because those data center revenues will take time to become a significant portion of the total revenue. And the second key risk is China. From China, it's about two angles. One is the exposure and the concentration. I mean, they have 24% revenues coming from China, which is not a lot or not an outlier for any large semi company. I mean, all of those have exposure in that range or even higher for a smartphone company. But the other key risk is concentration. So ARM China is their gateway to the entire China market. So every customer they sell, what they want to sell in China, they have to go through this one entity. So if something were to really go south there, we're talking about cutting off the entire market. So that's the two risks investor needs to brace themselves for.
All or nothing feels a little risky. But at the same time here, when you think about the long term, you've said that a couple times now, how long is the long term? When do investors have to be patient until?
I think at least about 3 years. I mean, today when we look at the server market specifically, their market share is in mid-single digits. And in automotive, it's, again, low double digits. We expect it to almost double in 3 to 5 years. And these markets are large. So even if you get a small pie of, like, say, a data center AI market, that's still adding revenue in north of billions of dollars to a company which is almost doing close to less than $3 billion last year.
When you think about the competitive landscape, at this point you have ARM now in public markets. SoftBank at some point will look to sell more shares. How do you expect them to stack up against their competitive set when it comes to how investors will put money to work in the sector?
Yeah, I mean, I think they need to continue executing on the promise that they would have delivered for that ramp in the roadshow presentation. So investors are going to be keeping key eye on how they're doing in the data center and the automotive market. So any accelerated growth design wins there should be a tailwind for them, or a headwind in absence of that.
That's Bloomberg intelligence analyst Kunjan Sobhani. Thank you so much for your time. We're going to head back down to the NASDAQ now, where Bloomberg's Caroline Hyde is getting all the latest details. But Caroline, before those details, what's the mood? It must feel pretty good to be watching an IPO pop after such a big drought.
Shanali, the relief, the optimism, cautious optimism. I mean, now that they've seen this trade, you can see behind me, we're currently trading up more than 13%. It was this art and science balance that everyone has to remind themselves of. It takes a while to ensure that they've got the right amount, basically, of sellers in place. In this particular instance, the issue is of course, they got, $700 million being taken down by some really important investors who are basically customers, Apple, Nvidia, and the like. But they've also got to ensure that some people are going to be putting the less than 10% free float up for sale at this moment and locking in some of the profits. Now, it's been a big profit for SoftBank. You know that they've made about 70% on this particular purchase that they made of $32 billion for ARM back in 2016. But this is so important for the sentiment of the market. The fact that they managed to decide to go in lower, $51 was just at the top of their range. They didn't get greedy, and they've decided to price it and put $56, therefore to allow it to continue to trade higher for the rest of the day. That's what Instacart, that's what some of the other companies eyeing this market need to see.
A 10% drop, or pop rather, looks a lot better here than an 8% pop would. Do you think this conservatism that they took in their underwriting approach to the IPO price last night is what's going to be the name of the game for the companies coming up?
That's what's so interesting. Is this idiosyncratic? Is this Massa, head of SoftBank, who apparently, we understand due to our reporting, really took some charge in this, deciding that they weren't going to go for the $52. They were going to stick to 51 to ensure that they got that, really good gauge of sentiment. He is a long-term holder of this stock. He said that time and time again. Yes, he wants to see that valuation increase in the near term, but in the longer term too, maybe, he, as you were just mentioning with your previous guest, maybe he offloads more stock, maybe he uses it as collateral for further financial engineering that we know that he is so artful at. And I think that we will see the likes of Instacart and some of the other companies having to decide whether or not they want to take a long-term perspective, leave a little bit of money on the table to ensure that their company comes with a good set of pop into the market that then continues to have that demand side. We know that there's loads of concerns, geopolitical risks being one of them, anxiety around interest rates. This has been a volatile market for a long time. People have been waiting for this IPO window to open, and they want to see it continue to be open until, as we heard Karen Snow say, before the elections of next year.
Bloomberg's Caroline Hyde, we thank you so very much for all your time, and what perfect timing we have had you at the top of the show while the stock has opened. Now let's continue the conversation on venture capital and bring in Bloomberg's Katie Roof, because what a win for SoftBank. They needed a win. And so them having this on the books now, what does it mean for not only their portfolio company, but also the appetite for other VCs who are now looking to get some money back on the table for themselves?
Sure, yeah. So I think, this is obviously a positive sign for tech broadly. We have Klaviyo coming up next week. We have Instacart coming up next week. And so we want to see public investors, or they want to see public investors with enthusiasm for tech stocks. I would say that a 10% pop isn't a big pop. I mean, typically you would see 20 to 30% pop on day one. I mean, there have been times that it's gone higher, but usually the goal is a little bit higher than 10%. But, the fact that it went up is good, because there aren't a lot of tech stocks that have gone up in the last 18 months. This is the only big tech IPO we've had since 2021. So people are watching this one closely, even though it is a pretty different sector than a lot of the other tech companies and certainly the venture-backed companies.
What about the approach? We're talking a little bit about pricing, but what about ownership? In this instance, SoftBank is only floating about 10%. In the last 24 hours, a lot of agitas about VCs holding on too long into an IPO. Investors want their money back. So do you expect more investors to start doing that?
Yeah, sometimes we've seen this, it's called a low float IPO, where you just take a small percentage of the company and release it to the public. And that is actually often designed to help ensure a better pop, because, if you limit supply, then it kind of artificially raise demand. And so we've seen that in the past. I think that right now, certainly most tech companies would probably be wise to price these things conservatively, or at least that's what people are telling me. Because it can, if you make a bad first impression on the market, it can spook investors in the long run.
Katie, I've got to say, it's so nice to have you in New York for a big listing in New York from an international company. But also, I know that you've been kind of running around doing a lot of reporting. I got to do a little bit of the reporting with you. What's the new name of the game? It's not just about profitability, is it, when we think about the companies that are looking to list? And the window doesn't seem to be as open as people think it is.
Yeah, that's the big question on everyone's minds right now, because VCs tend to be growth investors. They really look at companies with top line revenue growth, and that was what public investors seemed to be interested in a couple years ago. But then there's been a perception that that changed and that they care more about profitability. But VCs will tell you that that's at odds with growth, because if you have to cut, your sales and marketing to be profitable, then that will, reduce your growth rates. And so we see with Instacart that they are profitable in line with what the perception of what tech public investors want, but they have had slowed growth. And so that's going to be one that people are watching. You have Klaviyo, on the other hand, where they're both growing and profitable. So we'll see.
How do you think about the next week ahead? Obviously, the bankers are going to be very busy on road shows for both of these companies. What's the timeline?
Yeah, so right now we have the road shows for Instacart and Klaviyo underway, and they're both scheduled to go next week around the same time.
So another thing also that has just happened is Databricks raising more money at a $43 billion valuation, I believe. What does this mean? Because you saw other companies kind of raise money pre-IPO. Does it change the pre-IPO kind of appetite as well?
Yeah, so a lot of companies, other than AI companies, pretty much no one has been able to raise at high valuations, or at least even flat valuations, in the last year or so. There's been very, very few. Databricks is a company that has a lot of investor interest, so even though the price is already high, they've been able to sustain that. Typically, when I see a company like this raising money, I think they're not on the verge of IPO. I mean, certainly they could go public in the next year, but you wouldn't want to dilute your ownership in the next few months before an IPO unless you were going to do a direct listing.
That is Bloomberg's Katie Roof. We thank you so very much for your time. We want to give you an update as well on where ARM is trading. We are looking at that IPO pop still holding. Now, listen, remember, this has been rising as much as 15%. We are seeing some of those gains a little bit volatile, but remember, we did see initially that pop of about 10%. If you take a look at trading now, we are looking at a stock now very much up, more than $60 a share. This was a stock that was priced at $51. It was Masa-san that himself told the bankers that he wanted to keep this more conservatively priced. They tried to bring it up about $1 to $52 a share, but bringing it down has not only given it that initial pop, it is a little more than what it would have been if they priced it higher. Now, remember also, to the point that our own Katie Roof was making, there have certainly been bigger pops in history, but there were questions coming into this IPO from the beginning about the valuation itself. So, you know what? This is something that is stacking up for a win for the underwriters and certainly for SoftBank. Now, let's get more context from Bloomberg's Ian King. Ian, when you take a look at the competitive dynamics that ARM is facing, why do you think that it is getting such a warm reaction in public markets?
Well, I mean, there are a couple of things here going on, Sonali. There are the setup of the mechanics of the IPO itself. Remember, this is just a very small portion of the company that's being offered. There are strategic investors already involved. So there's relatively little kind of supply here in terms of the supply-demand balance on the stock. But on the flip side of it, we're also IPOing at a time when people are very interested in semiconductor shares. You know, the Philadelphia Semiconductor Index is up very strongly this year, and obviously everybody's very focused on, the opportunity that AI is creating for these companies.
What about the competitive dynamics? Given that they're getting such a warm reaction today, do you think that this is excitement around the new kid on the block? Or is this an idea that will keep sending the other shares higher as well?
I mean, it's a yes and no to that. They're really not the new kid on the block. Everybody knows about ARM. They've been around a long time. Their technology is pretty much everywhere. It's used by all of the major chip makers. At the same time, they are pitching themselves as a different company that does way more than just sell the bare bones of the IP that goes into these chips. They're selling themselves as being much more comprehensive company and having access to higher profit margins.
Quickly in here, what about the SoftBank ownership? Given they've only floated about 10%, they will sell more eventually over time, but the governance all points to SoftBank. Is that a plus or a minus?
It's a variable. I think that's the way to describe it. Obviously, SoftBank will do what SoftBank does in terms of maximizing its profits down the line. It's an investor. It's as much as it is a technology company. So that's definitely an overhang or a consideration on ARM. But at the same time, it also gives them perhaps some latitude that other publicly traded companies might not have.
Our thanks to Bloomberg's Ian King. We want to touch back in one more time here on ARM share before we head to commercial break, because we are looking at that IPO pop. Not only is the IPO market back, it is back in time for cooler markets. When we're looking at $61 a share here, we are looking at a price here that is almost 20% now more than what we initially had come to price at just last night. Now, what does this mean in terms of valuation? You are watching a company shoot higher very quickly, closer to $65 billion in valuation. The current valuation at $65 billion would be a little bit higher than what SoftBank had brought back its ARM stake for just a couple of weeks ago. This is Bloomberg.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
Welcome back to Bloomberg Technology. I'm Shonali Basak. We're going to look quickly at that ARM IPO price. Once again, that first day of trading here, you're getting that IPO pop. You're getting almost a 20% pop in the first day of trading so far. That is about $60 a share, and it is up meaningfully from the 51 it priced at. At more than $60 billion in valuation, you are getting a price very near what SoftBank had bought back its stake for in ARM. We're going to now bring in Ajay Shah for his read on this. He is the managing director and co-head of the Technology, Media, and Telecommunications Group for Deutsche Bank, one of the underwriters on the ARM IPO. When you look at what has happened today, what does it really mean in terms of the companies that can finally make it back to market next?
Sorry about that.
It's okay. Ajay, actually, we are going to get right back to you because we are standing by with a pretty key guest for a day like today. That is ARM CEO Rene Haas with our own Caroline Hyde. Caroline.
Shonali, it is great to be here with Rene, the CEO of ARM. It is your day. Rene, talk to us about the amount of emails, phone calls, text messages, celebrations, the Cambridge part of your company going berserk. How does it feel?
Oh, gosh, what an exciting day. You know, I'm hearing from high school friends I have not talked to in a long time who are saying, you never told me. I think as they're watching this on TV. But most of all, I'm so thrilled for the employees of ARM. 33-year-old company, great heritage. But watching all the employees in Cambridge celebrate simultaneously, that was magical.
And they might continue to celebrate as we see, 17-18% increase. How has that journey of going out to investors, the roadshow, the story that you've been able seemingly to successfully sell, the fact that you're trading well on this day, what was the vision they wanted to hear? Revenue growth, I hear of 11%, up to 25% in the next couple of years. What drives you?
I think it was a great process. Investors really wanted to understand the opportunity we had in front of us. And of course, AI, which you can't really talk about our industry without talking about AI. And I think helping them understand that you can't really run AI without ARM, without a CPU, and just pointing out to them that it's everywhere in every device that people touch was a big part of the process for us.
Because everyone has made the equivalent of your smartphones, completely absorbed. More than 90% of phones is where your CPUs are. But the design, the fact that you now want to be integral to data centers and the like, how certain are you on the revenue vision, on the profitability vision, even though we see concerns about macro environment still and whether or not we're in an AI hype cycle?
Yeah, so AI is everywhere. And if it's your edge device like the Assistant or the Alexa or your autonomous vehicle, that's all AI. And now we're seeing it in the cloud and the data center with all the growth of NVIDIA. NVIDIA announcing one of their newest products, Grace Hopper, that is based on ARM. So ARM is everywhere relative to AI. We also have a very unique business model that gives us the ability to have a very, very good vision in the future in terms of when people use our products. So relative to our confidence in the outlook, we have a very, very high confidence that the growth rate that we have talked about will be sustained.
How worried were investors about China and your exposure?
I think there were a lot of questions, as you can imagine, about China in general, given all the geopolitics. Our business there looks a lot like the rest of the world. We have great growth in the data center. We have great growth in automotive. China's huge on electric vehicles, so it's been terrific there for us. I have the same kind of headaches that every other tech CEO has regarding how to navigate through this, but no different.
Do you think there will be more pressure now that you're public again? Ultimately, I mean, you came to ARM in 2013, you were listed at that point, but it's not been since 2016 that you have been. How does the game change as a leader of that business now?
You know, I think there's some things that we were able to do as a private company that will just be different, right? Yeah. Quarterly earnings, making sure that we hit all our commitments. But ARM is not a business you measure from quarter to quarter. You measure us over years and decades. And the long-term vision is something that I am very, very passionate about and will continue to drive the company the same way, private or public.
You have a lot of key vested interests, whether they be your clients, Apple, TSMC, Intel taking big stakes in the company today. How important are those voices vis-a-vis Massas, the head of SoftBank, who I'm sure you're on the phone to daily?
Yeah, so one of the challenges of our industry, and particularly with ARM, is that the fact that we're everywhere, none of this works unless we play nice with others. So we have to have a lot of engagement with strategic partners and making sure that we're managing that balance, including Masa, our chief shareholder.
Do you think he lets more of ARM become public? Is that something you'd like to see?
You know, Masa and I talk quite frequently, but it's really not about the day-to-day. It's about the long-term vision, the passion that he and I have about the future, and really about what this company can be long-term. So I don't expect that to change, being a public company.
Do you think you'd go public in the UK? I'm sure it's been bittersweet for the London Stock Exchange today.
Yeah, so today, obviously, we're in New York, but we're incredibly proud of our UK heritage, and we are open to considering that down the road.
Okay. Any sort of time frame for that?
None that we can talk about today. I'm trying to get through today a little bit.
Well, before you get through today in that respect, investors do love all things regarding artificial intelligence, but how have you managed to land that your story is different? People have been so exuberant about NVIDIA, where you used to work, but they're really exuberant about GPUs. How have you said that you are able to claim a larger royalty share of how AI continues to be served?
Yeah, so one of the benefits of the roadshow was spending a lot of time with investors talking about AI and where we fit. And I think one of the misconceptions is that a GPU can run without a CPU, which is just not the case. The CPU is central to every electronics device, and there are devices that ship with a CPU and a GPU. So once investors kind of got that, then explaining where the puck was going relative to, gosh, NVIDIA's next generation most advanced product, Grace Hopper, is using ARM CPUs instead of the competition, the light bulb went on. That, oh my gosh, you need the CPU, and at the same time, NVIDIA has made a big bet on ARM in their most sophisticated product. And once that message kind of sunk through, people, the light bulb went on as, oh my gosh, I get it.
There has been this moment, though, at which we're trying to understand how the landscape works with global demand and that translating into revenue. When you think of Oracle's numbers that came in, and look, they delivered 30% increase when it comes to their cloud provision and their AI bet, but it doesn't always immediately turn into revenue in the here and the now. How convinced are you that it is going to be in the bottom line evident in the next coming quarters?
As far as AI? Oh, I think it's unquestionable that AI, which has already been here, right, for a number of years, the ChatGPT moment taught us that, oh my gosh, the capability of what this can do going forward has gone up a level. And I think we've seen that over and over in our industry. There tends to be lightning bolt moments that greatly accelerate the adoption of technology. And I think with AI, as you move towards AGI, computers that can think, I think we now have seen an accelerant for that. Ultimately, down the road, how people make money off that, it'll get figured out. But AI is here to stay. That's unquestionable.
And it seems as though you're integral to SoftBank's vision of AI and Massa's vision of AI. How can you enunciate a little bit? You say you're talking to him daily. What his vision of ARM within the ecosystem going forward really is?
He and I share a very same view that ARM is one of the most important technology companies in our industry, foundational, if you will. And I would like to see us over the next 5 to 10 years really be recognized that way. And he and I are very aligned on that. As you can imagine, when you think about 5 to 10 years out, there's a lot of things to talk about in terms of the art of the possible, but that's really where he's focused on when his conversations with me.
Long-term thinking, but then near-term action. We understand he was pretty integral to calling the shots on price points for today's listing. How was that as just an IPO experience? Did he end up being like, no, we need to leave a little bit of money on the table, this needs to be a successful trade?
About all I can say is, and this is my first roadshow, so everything was a learning experience. We wanted to be at the high end of the range that we set, 47 to 51, and that's where it ended up. So we're happy. We're very thrilled with today.
You said that school friends are getting in touch. Why have you been hiding this from them? How do you feel differently now as a CEO of a publicly traded company? Do you feel differently today?
I feel a little bit differently in looking ahead at this number than what the share price is. That wasn't something we looked at before. But, you know, again, I told this to employees, while the IPO is amazing and I could not be more proud of it, I'm far more excited about the next 5 to 10 years. And that's where my head is focused. Obviously, we need to do things as a public company CEO, but I don't feel too much different.
And sometimes these are marketing exercises. ARM is B2B. But do you think you've become more relevant B2C now? You're saying how people had no idea. Well, that's because largely people don't realize that every day they're interacting with your designs, with your blueprints.
The people who need to know what we do know, obviously, just given the fact that all the global partners that we work with. Going forward, how to market ourselves as a public company, that's one of the things as a public company CEO I'll spend some time thinking about. But right now, we're just kind of focused on today and what that means.
And meanwhile, within this exuberance of today, yesterday we saw basically every key chief executive of an AI company, AI-related company, indoors in a closed hearing with Senate Majority Leader Chuck Schumer. Can you tell us about regulation? How do you see the landscape evolving to ensure that you can harness that AI moment?
I think it is one of those areas that is an unknown moment. And I remember talking to an executive about the analogy or metaphor we used was when cars were invented. You didn't have driver's licenses, you didn't have lanes, you didn't have rules of the road. There was a lot of things that people had to figure out in terms of taking a device that was going to be very, very productive, but could be very dangerous in terms of automobile accidents. AI is a little bit of the same in the sense that we're now in a new paradigm where some rules and regulations need to be figured out. And that's why I think you're seeing all this activity around that area.
Is the US leading the charge on regulation? Is Europe? Is the UK? Where's getting it right from your perspective?
I think all the governments are trying to figure it out. I know the EU has spent a lot of energy on this, as had the UK. So in terms of who's getting it right, I think it's still early days, and everyone's really just trying to learn how technology and this new powerful algorithm will work together.
Keep teaching us. Great to have some time with you.
Thank you so much.
Of course, the CEO of ARM. The day of their listing, I'm looking at the price point up 17%. So a heady pop for the day's trading, Shonali.
Absolutely. Caroline and Renee Haas, ARM CEO, first roadshow. Thank you very much for your time. Now let's bring in Ajay Shah, Deutsche Bank's Managing Director and Co-Head of Technology, Media and Telecommunications for Deutsche Bank, one of the underwriters as we've been talking about. You know, I first want you to react here to what Renee had to say, because he did talk about this idea that people will pay for AI-related stocks and companies eventually. But we are in a different era than that hyper-growth, unprofitable type of company. You had a profit at ARM, it was slowing. What is investor appetite for anything but upward trajectory?
Yeah, Sonali, thanks for having me on the show. Look, you know, we have definitely seen an increase in activity on the capital market side. Certainly post Labor Day, you know, there was a lot of pent-up demand and expectation that the markets would open, and ARM would indeed open the markets with the IPO. As you've seen, obviously the IPO has done very well so far, and ARM is really a play on increasing demand for advanced processing needed to support AI. And you obviously just heard Renee, walk through some of the key highlights around ARM and why people are so much interested in investing in ARM. We have certainly seen, the markets sort of change the tone from, as you said, growth at any cost to growth at, with profitability. And so I think investors have been doing work. They have done a lot of work around ARM. They've done work around some of the other IPOs that came to market earlier this year, Kenvue on the consumer side, obviously ARM in tech. And we've seen investors do work, and they are still obviously still sensitive on valuation, but there is clear appetite to pay for growth with profitability. We have a pretty robust pipeline of some of these IPOs, that are yet to come.
Right, on that pipeline, the reality is there's not that much time left in the year. You really have to file pretty soon if you're going to go public.
Right.
So is the pipeline into next year much bigger? Is it still quite muted given the dynamics we're seeing in the market? There's still a lot of macro uncertainties out there.
Sure. The pipeline is big, and it is getting bigger by the day. Obviously, with ARM's successful IPO, I think you'll see a lot more companies come to market, certainly between now and end of the year, and gearing up for next year. We're seeing, all across the tech ecosystem. On the internet side, there are companies like Reddit or Turo, GoPuff. In fintech, we've seen, expectations around Stripe and Plaid. On the software side, you've Genesis, you've got UKG, Rubrik, and others. And even in the semiconductor space, after ARM's success, there are companies that would certainly like to access the market. Companies like an Ampere or Astera Labs and others. So the pipeline is robust, and we will see the pipeline grow going forward. Obviously, it is going to depend on how ARM does, how investors feel about the overall strength of the economy. And ultimately what the Fed decides to do going forward.
Is there a playbook here? On one hand, you did see them kind of tamper down expectations in order to get this smooth debut. On the other hand, there's a cross current that seems to be peeking its head up in the market, which is M&A. Is there a reality that M&A can meaningfully compete with the IPO markets, and what will give a company a better exit valuation?
Yeah, so the M&A market has slowed down this year relative to years past, and with the IPO market, showing signs of opening, that is a real competition to companies looking to acquire. So I do see the opportunity for M&A also to increase going forward. Again, not just because the IPO market is strong, but also valuations are increasing. They're stronger than what they were last year. We've seen S&P up 17%, Nasdaq up 32%. The VIX volatility index is down 40%. And so I think those are factors that certainly corporates look at when they think about M&A. And now there is a real option for companies to go public. So we do expect companies to start, looking at more corporate M&A. We've seen some financial sponsors and private equity deals happen in the market. We haven't seen as many, corporate M&A, but again, with the robustness in the market and the economy starting to grow, we do expect M&A market also to pick up pretty materially in the next year.
Also think about here is that this is not a U.S.-based company, but listed in the United States now. Are you scouring the globe for hopefuls, just given that valuations might be more reasonable outside of the United States?
Absolutely. There are, several companies, obviously in Asia and Europe, that have been waiting for ARM and a few other IPOs that will come out, between now and the end of the year. And we will see increase in certainly either cross-border listings or just listing in Europe and Asia. But we are working with a handful of companies that are looking to go public, across both sides of the continent.
That is Ajay Shah. He's Managing Director and Co-Head of TMT for Deutsche Bank's Investment Bank. Thank you very much for your time. Now joining us here in studios, Cameron Ansari. He's Headline Venture Capital Partner for his read on the IPO landscape and other paths to exit. We've been talking here about IPOs versus M&A. There's another question I wanted to ask you, though. There's been a lot of fireworks about this idea of VCs holding on too long when you go into public markets. How do you see that playing out? Do you think that there will be more willingness to start to sell into an IPO rather than hold on and clip the gains over time?
Yeah, I mean, I think that you're going to see, in the ARM case, you really only have one seller, which is SoftBank. And it's not a traditional venture-backed IPO, though, the way they might consider it. You know, SoftBank took it private 7 years ago and is bringing it back out now today. But you have a couple other companies coming up this week or in the next 10 days, Klaviyo and Instacart, which are both venture-backed, startups, quote-unquote, in the traditional sense. And I think in both those cases, you'll see the venture investors selling into the IPO in a meaningful way, but it's also going to be a liquidity event for the company and the employees, as well as a fundraising event, right? It's an event for the company to actually raise funds and capital so they can shore up the balance sheets as well.
It's been a bit of a strange year. When you think about the hopefuls and companies that are going public, there is some hope around fintech. There's a lot of consumer. There's a lot of food and delivery. But how much is AI the real silver bullet? Do you think that it's a red herring, or do you think that there's more opportunity elsewhere?
Well, look, ARM is one of the only plays right now for consumers and retail investors, as well as investors generally, to play into the AI kind of theme, other than maybe owning Microsoft as a pass-through to OpenAI or Google as a pass-through to Bard or NVIDIA, right? There really aren't many public opportunities to play the kind of boom in AI. But I do think it's a little bit of a red herring, and that there's a lot of opportunities elsewhere, and a lot of the companies that are going to be listing and coming out, including Klaviyo and Instacart, and we talked about Reddit or Intercom or Databricks or some of these companies that are coming out. They're not AI businesses per se. They're terrific companies, and they're going to do very well. And I think the one that in the tech space and the fintech space where I spend a lot of time, everyone's waiting for is Stripe. So I think Stripe's going to be the big bellwether, but that's not likely to happen
When
this
do
year.
you think it actually goes?
Who knows, right? They raised a massive fundraising round very recently at a steep discount, at about a 50% discount. They were previously priced at $95 billion. They raised it about $50 billion to really shore up the balance sheet, and also primarily to incentivize employees and keep them around because of a stock option plan that was expiring. So with that fundraise, I think they have a lot more runway now. So I'm guessing that's easily going to be well into 2024 before Stripe is going to come out.
Now, you think about Instacart, and it is a big win for some of the early investors, including D1, where D1, Dan Sundheim, for example, they had roughly 60% of their assets invested in venture capital and private equity. It's been a drag on returns. When you look at those crossover funds, those big hedge funds that have come into the market, what role do you think that they play now that they're finally starting to exit a little more now?
Well, going forward, and really this year, it's been very quiet with those guys. We used to see Tiger and Coatue and SoftBank and a lot of these funds coming into earlier stage opportunities in the venture space, sometimes even like seed deals, which is very strange. They've been pretty quiet, and you're also hearing about some of those funds trying to sell their positions or package up all the positions in a secondary. So I think going forward, I expect to see less of those folks coming into really early stage venture deals. But in the case of Instacart, you also have one of the greatest venture funds, Sequoia, is one of the major holders. You have traditional venture firms in there as well that'll be looking to hopefully I think get out as part of the IPO.
Now, as they get out, how do you think that changes the dynamic around valuations, given we've seen so many down rounds already this year?
Well, it's been a market reset, right? In the case of Instacart, I think the last private round was in the $39 billion range. I think they've priced it very attractively, frankly, at $9 billion, which is actually, if you look at the comp, which is DoorDash, which trades at 4 times revenue, Instacart's around a $3 billion revenue business. So the fair price should probably be closer to $11, $12 billion. So I think pricing it at 9 leaves room for upside. But it's a vast reset, right? And we've seen that with Stripe, with Klarna in the private markets, as well as in the public markets. The companies like PayPal and Square Block, they're all down 60-70% from their 2021 highs. And I think that's consistent across the board.
You look at what you're seeing in ARM today, you're looking at almost a 20% pop, more than 17% pop at the moment. It has been trading in and around more than 20 times its trailing sales. Do you look at these companies and say that's achievable, or is that a one-off?
I think ARM itself is really a one-off in terms of the type of company it is, that, again, the play on AI in the current moment, the size and scale of the business, the partners they have, these very stable relationships with folks like Samsung and Google and Apple. So, at the same time, it's a slow growth business in a high growth sector, right? They're not really growing right now. They've had kind of a flat last year, and I think they're going to start to grow again this year. So the story is not a perfect story, and yet you're seeing, obviously, a 15-20% a pop as already happening. But there are also non-tech names coming out. We started this IPO kind of wave these last few months with Kava, so it took kind of pita and hummus to get us here. And now, I heard yesterday, you saw on the news that Birkenstock's coming out, which is, again, a non-tech name. that's going to come out, and I think drive interest as well.
It's no secret, Birkenstocks is now my new IPO attire. Wore them to work this morning.
Birkenstock will be a public stock.
Yeah, absolutely. Cameron, I'm sorry, Headline Venture Partner, we thank you so very much for your time. Now let's take it home with Bloomberg's Caroline Hyde, who's been on the ground at NASDAQ for us, looking at that 15% or so pop at the ARM IPO, just right out of the gate just about an hour ago. What's next?
Yeah, what's next? Klaviyo, Instacart, all of the eyes on these companies coming next week, and they're going to be from the NASDAQ, they're going to be from the New York Stock Exchange. There is going to continue to be an eye on really how this company continues to perform. We know that there's exuberance around the first day of trade. How does ARM manage to continue this narrative of growth if in the face of China? I thought that was notable from Rene Haas, talking about, look, it's the same headache as every other CEO who's exposed to China is currently having. I think it's also on the road for ARM and Destiny really interesting that he told us that they are potentially eyeing a UK listing, so a secondary listing at some point. That was news that they gave to us, so I think that's an important step in terms of reminding everyone this is a global company with global exposure, but also a global headquarters. It's UK based. And then what for SoftBank? Of course, this is a company now that is trying to show that they're back winning when it comes to their venture bets. This has been a 70% upside for Masayoshi Son, and he's also taken a very hands-on approach to how he's guided this IPO. How will the rest of the IPOs be able to deliver those sorts of returns for their VCs and indeed manage to sustain the growth story and indeed manage to see a pop on the first day of trade? As Karen Snow from NASDAQ was telling us, Shonali, this is largely an art as well as a science. They try and make it as much of a science as they can with their technology, but at the end of the day, this does tend to be an art of getting the right price point.
Something I had heard him tell you, Rene Haas, was that this was his first roadshow. It's interesting because you think about the list of IPOs around the corner and the entrepreneurs that are trying to make it to market and the role these underwriters play, some old, some new. Goldman's big day, the fact that they're playing such a big role in the technology market. Mizuho just coming up swinging not only in this IPO but some of the ones next week as well. What did he tell you on the sidelines about what it felt like to be listing such a massive company in the market right now for the first time?
I mean, I do think he's trying to keep his emotions contained. And look, he was telling us that friends that he knew since college were getting in touch saying they had no idea. This is a B2B play, less than an Instacart B2C. And I'm so sure Fiji over at Instacart is getting a lot more friends to recognize she's about to have a slog to get this company to go public as well. But notably, this has been very idiosyncratic in the way that they've democratized their banks, the way in which they've had so many underwriters, really taking a leaf out of Alibaba's book here. How can that be replicated? How can they ensure, also interestingly with Instacart, they're going to be depending not on so much the institutional players and the integral players like an Apple, TSMC and customers. Instead, they're going to be basing their focus on the retail investor. And of course, that's why, so interestingly, SoFi is coming to play an underwriting role there. So I'm going to be interested as to how they sell that narrative, not just to the business population, but to the public too, Shonali.
Right. Instacart would be SoFi's first underwritten IPO. Now, last question here, Caroline, for you, because down at the NASDAQ, you're also interviewing NASDAQ's executives. Direct listings, the business that includes listings is about 20% of last year's total revenue. How do they feel about the market finally coming back?
Buoyant. God, everyone I've spoken to has a smile on their face. They look relatively exhausted, having not slept for a few days, but they cannot wait for this really pendulum to swing back open. They've totally said, Karen Snow, as you were referencing, head of global listings, saying that there is so many companies waiting to come out. 157, of course, have filed, looking to really access this window. She feels it could shut by, well, the 2024 elections. Many want to get ahead of that sort of political environment. So if we can sustain some sort of lack of volatility in the markets and some appetite for these companies coming forward, there is a whole host of companies that want to start listing and want to start listing soon.
Yeah, that timeline certainly makes sense, let alone the October government shutdown and a whole host of other potential things that could get in the way. Bloomberg's Caroline Hyde, we thank you so very much for your time and your incredible interviews at a pretty pivotal moment, watching that ARM IPO open, interviews just around that. Now that does it for this edition of Bloomberg Technology, the IPO edition. Coming up next, you don't forget to check out that podcast. You can find it on the terminal. You can find it online, as well as on Apple, Spotify, and iHeart. This is Bloomberg.
us, along with many in the street, were looking for a slowdown and looking for a recession this year, and it just hasn't manifested.
It's still a very strong labor market.
The U.S. economy is far from robust. It's still in positive territory, absolutely, but the momentum seems to be shifting to the downside.
I think the consumer is incredibly stretched right now.
I think the reaction function of investors is to get out quick if the data starts to deteriorate.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Inflation in America, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market slightly negative on the S&P 500, 2 hours and 30 minutes away from CPI in America. TK, that report just around the corner.
It's like Howard Johnson's 28 flavors to measure. My measurement, somebody stopped me on the street last night and said, what do you look at? And I look at Cleveland CPI. There's different names for it, not the nowcast. Everybody's nowcasting. Do you know there's Bramo nowcasting?
We've got a Bramo nowcast.
Bramo nowcast is a level of gloom that's out there. It's pretty high this morning, actually. But the answer is I look at Cleveland CPI. We're not going to go into the details now, but it's at 4.80% coming down. And if that comes down again off the data this morning, that's called disinflation.
Later on today, it's about the split, Lisa, the split between headline CPI elevated, led by gas prices, core CPI, potentially showing more progress for this Federal Reserve.
My concern is what levels are actually going to change the needle for people who are not going to look at one print. The Fed's going to say they're not going to look at one print. So my key question today is how big of a miss or how big of a hit of a boost could you potentially see a reaction from? In other words, where is the threshold and where is the market biased to, an upside or a downside surprise?
If this sets us up for the Federal Reserve next Wednesday, we need to set up for the ECB this Thursday, stuck between a rock and a hard place. Reports yesterday from Reuters that this ECB might have to upgrade their inflation outlook for next year to north of 3%, Tom. That's going in the wrong direction. And then moments ago, reports suggesting Germany will have to downgrade their outlook for growth this year to a contraction, never mind stagnation. We're talking about the biggest economy in the Eurozone in contraction for the year, and the ECB upgrading its forecast for inflation potentially Thursday for next year.
Former President Summers of Harvard leads the charge on this. I'll let Larry Summers speak about, does it smell, does it feel, does it look like stagflation? I think it does.
Smells like it, right?
Yeah.
What do you do if you're President Lagarde on Thursday?
The textbooks don't tell you. That's why people stop and listen to Larry Summers on this, and frankly others as well. Which do you attack? Do you attack growth? The politicians are going to attack growth every time, or do you go, OMG, we got to do something here? And the distinction here is this word austerity. You remember it, and it was the cant in London around Brexit. But are you going to goose the economy in Germany? That's anathema to their economic culture.
That's a conversation for a little bit later. Yeah. Let's start the conversation in the equity market on the S&P 500. Pretty muted price action. Equity futures here negative by 0.07%. In the commodity market, new highs for the year. Yeah. On crude. We're getting closer and closer to 90 on WTI, through that level in the past week or so on Brent. Lisa, right here, right now on WTI, 89.36.
Which is going to be a key component of the discussion at 8:30 a.m. when we get the CPI print and the headline number. How much has it been increased by the price of gas? I'm also looking at real wages, which is calculated once you take a look at inflation. And you can see they've started to tick down. And yesterday, the Census Bureau put out a report saying that U.S. inflation-adjusted household income fell last year by the most in over a decade. Keep an eye on this. Today, Barclays Global Financial Services Conference continues. Citi CFO Mark Mason speaking at 10:30 a.m. Yesterday, David Sullivan of Goldman Sachs talking about those capital rules, slamming them yet again. We heard that from Jamie Dimon, basically saying that this is going to restrict access to companies big and small. And at 2 p.m., this is the other thing that kind of has come under the radar, is real yields has really led this whole charge up in yields. And we're going to get the August U.S. budget statement. How much of this is just the U.S. is getting more in debt and selling more debt to cover that? And is this really going to get juiced as we see that increase later today?
Lisa, thank you. Looking ahead to AMH a little bit later this morning down in Washington. Need to talk about the potential for a strike in Detroit as well, Tom. Listen to this from Jim Farley of Ford. I think this line is so important. What these wage negotiations mean to them. There is a line in the sand for the sustainability of the company. The sustainability of the company. We heard that yesterday as well about the viability of the company. Can they really take on the kind of pay raises that UAW, Tom, is pushing for?
I interviewed Bill Ford once, and we've known each other for years. The guy is very good at pond hockey, John. You'd be great at pond hockey. You go north of Dearborn, way up in the Michigan.
It's like Mighty Ducks.
Climbs, like Mighty Ducks,
like Mighty
except
Ducks.
you're outdoors.
I know all about pond hockey.
No, you're outdoors, and you're on the ponds, and you're competing with old farts, and Bill Ford leads a charge on this. We're talking about pond hockey, and then we talked about the fabric of the family. We didn't go bankrupt. They did. And Farley's channeling that. Ford and Dearborn, they will do everything they can to avoid what they avoided back when Steve Ratner was car czar.
Back in the day.
Brammo's
around the financial crisis, of course. MH joining us next hour. Anne-Marie from Washington, D.C. Joining us now, Larry Adam, Chief Investment Officer over at Raymond James. Larry, let's start with 831. What are we looking for at 8:31, a minute after we've had that inflation report? What would you expect to see, and how would you expect this market to respond to it?
So I think, obviously, we're going to get mixed results when it comes to inflation, headline moving higher. But I would still focus on the core number, because I think that number is going to continue to go lower. And I think that's the broader picture of what's happening with inflation. I think inflation is going lower. When you look at this economy, it is starting to slow. It's going to continue to slow as we go into next year. When you look at goods pricing, yesterday the Adobe Digital Price Index came out, and for 12 months in a row, goods pricing has gone lower. More importantly, it's at a 40-month low. And then I think we're going to continue to get supplemented with lower prices, with the fact that shelter prices are going to start to be reflected in these numbers. And keep in mind that if you look at real-time data like Zillow, this core CPI number would probably be below 3% if we were to switch out and put some real-time indicators in that. So I think that trend is going to continue to show deceleration in inflation.
Larry, bring it over to the stock market, and let's get real right now on nominal GDP. You know, nominal GDP ties directly into revenue growth, et cetera. Are we anywhere near the tipping point where we see substantial lessening of revenue growth because nominal GDP comes in lower?
I think we're actually going to go into a mild short recession going into next year. And to your point, I make it really simple, and that it's simple in the sense that, do you think you're going to spend the same or less over the next 6 months that you did over the previous 6 months? And when we do our proprietary surveys, most clients say they're going to spend the same or less over the next 6 months. Now, assuming that job growth remains constant, that means you're in a recession, because after inflation, to your point, you're in a recession. So I think you're going to start to see this economy modestly struggle as we get into early next year.
Well, mildly struggle, that's fine. Give me an SPX update here. I mean, we're sort of at the atom level on the stock market. Can you get more enthusiastic as corporations adjust to your recession?
Now, to your point, where our target for this year is 4,400. I think one thing to keep in mind is that we've only seen 5% pullback so far year to date. Historically, you get 3 to 4 5% or more pullbacks in a given year. So I think time is there that you're likely to see some downward pressure in this equity market over the next couple of months. I think that'll set up a better buying opportunity as we go into next year. And to your point, when it comes to inflation, I'm not so sure if inflation comes in as people expect, particularly on the core, you're going to see a big rally. We've been rallying on the same news for most of this summer. So I don't think that's going to lead to a big upside just if those numbers continue to show a deceleration in inflation.
Larry, back in August when you came on with us, you were talking about how you became cautious, which is notable because you were really optimistic for a lot of the year. Does cautious mean buy tech? How do you express caution in an equity market that's been driven by the biggest companies that, albeit there was a somewhat soft reaction yesterday, have been really delivering?
Well, tech continues to be one of the areas that we do like. If you look at our favorite sectors, they tend to be the ones that have, in our mind, the most attractive valuations. Tech falls into that realm. I know some people think that's not correct because it has an elevated PE, but we always want to look at what is going to be in the future. And when you look at tech earnings, it continues to be that one sector that consistently beats its expectations. And when you start to apply the consistent beats that we've been seeing, tech's really not all that expensive. And that's one area where if growth gets constrained, that's one place where investors can look for growth. And I think you'll continue to see fund flows into that sector.
Well, here's an area that's struggling right now, Larry. Let me bring you some news. Spirit Air is cutting its third quarter total revenue forecast, blaming increased fuel prices and steep discounting. That stock is down about 2.8%. For anyone following the airlines and the S&P 500 down about 20% from the July highs. So the airlines have already been punished over the last couple of months, TK. Fuel prices are up, costs are bad. And ultimately, are we starting to see some pressure domestically that's leading to lower fares? On inflation Wednesday in America, this is a big part of the conversation.
What I do is I go to Google Flights, real scientific, John. I go to Google Flights, I go New York to LA economy, what's the price? And the answer is lower. I mean, United Airlines doesn't have the problems of Spirit, but they're $275 and Spirit's $197. I mean, that's the price discount. That's a big discount by Spirit, but $197 to go that far?
Sure.
Who's making money?
Larry, talk to me about this. I wonder if this is a Spirit problem or if this is a broader story. We've got higher costs off the back of higher crude prices, higher fuel prices, and maybe testing our ability to pass them on to the consumer. Is there a story there for you, Larry?
Yeah, I mean, it's a pretty complex story. First of all, I do think the consumer is going to struggle going forward. Third quarter growth is going to be pretty healthy, right? We all knew third quarter was going to be healthy because everybody was getting out into what we call the summer of revenge travel too. But looking forward, as you mentioned, we've already seen a lot more struggles with the pricing going forward as people are starting to pull back on their travel. So I think that is a big issue and why we think we're going to go to a recession. Higher energy prices is going to continue to cool spending by the consumer. As we approach $4 a gallon, I think that's going to conserve people's what they have to spend, and that's going to further lead to some weakness by consumer spending into the year end.
What gives you confidence that the decline in consumer spending, Larry, is going to be short-lived and shallow and not something deeper if there is some sort of true recession with a feedback loop?
Well, again, we think it's going to be a mild recession because in many ways we've already had some rotating recessions to come into this. So I don't think it's going to be as broad-based, but I do think that the consumer, being the biggest part of the economy, is going to have a digestion period. And that's what's going to lead to this mild recession. When I mean mild, I think it's going to last 6 months. I think total growth being subtracted is going to be about 0.5% instead of 2.5%. And the total number of jobs being lost, we think it's going to be around 500,000. Historically, in a recession, you lose about 2.5 million jobs. So that's why I don't think you're going to see a total deep rollover in consumer spending.
Larry, great to get your input this morning to kick off our programme ahead of CPI in America. Larry Adam there of Raymond James. Your equity market pulling back just a touch on a session at the moment near session lows. We're negative here by 0.2% on the S&P 500. The latest news in the last couple of minutes from Spirit Airlines cutting their outlook for their third quarter forecast, third quarter revenue off the back of increased fuel prices and steep discounting. That stock negative, Tom, by 2.8%.
I look at LAX. Bramo emails me. She goes, would you look at Paris? We're thinking late October.
Is this business class or first?
I look at business class. Bramo only goes business class.
Stop projecting.
I'm looking. Exactly. I'm looking at the international flight. I look at it used to be about $7,000. One ticket business class, $14,000 for a loving couple. It's gone from $7,000 plus to $3,148.
That's a change.
That's wow.
So that's international.
I think this weekend.
International arguably is where some of the strength might have been. Domestically, Lisa, where Spirit is focused, that's where the struggle has already been flagged.
Which is the reason why I liked your question to Larry about, is this a broader story, especially if this is an airline that caters to families, that caters to vacations, that caters to people who are watching their budgets. Are you starting to see more of a pullback there? We've seen mixed signals. Yesterday, Walmart's CEO didn't necessarily have that kind of tone in an interview, but there is this feeling that there are people who are getting severely hammered by inflation and by wages that aren't keeping up.
How's your budget for this? USB-C to Lightning adapter, $29 on the Apple website.
Loved it.
$29.
Love the dongle.
You're buying that? You're getting the dongle, the adapter?
You think? 3 or 4?
For goodness sake.
But it includes a cord.
I thought it was fascinating.
But not the actual thing.
We could talk about this through the show. Inflation leads today. But, John, I thought the Apple soiree was fascinating. Ludlow killed it.
He was great, wasn't he?
Yes,
yeah, he's fantastic.
He's
Did a brilliant job. Tom Forde coming up a little bit later of D.A. Davidson on Apple from New York City this morning with inflation data a few hours away. Good morning.
The Mariah is just an unbelievable place. It's a cultural oasis and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
Since the very first iPhone, we focused on giving our users a device that's incredibly powerful, remarkably easy to use, and beautifully designed. Every year, we've built on this foundation to create experiences that make a real difference in our users' daily lives. Today, we're pushing what users love about iPhone even further.
There's so much marketing buzzword stuff in that, Tom. Experiences, beautiful. Apple CEO Tim Cook yesterday at their annual product launch announcing the new iPhone 15, the stock lower off the back of it, lower again this morning by 0.5%. Tom Forte over at D.A. Davidson, here's the quote, Tom, killer quote. Unlike years past, we believe the company may not be able to rely on strong iPhone sales to drive its share price higher. That's the change.
We are doing the best we can on this, and when you have Mark Gurman and Ed Ludlow leading the charge, it is best in world analysis of this. And what Bloomberg Surveillance has done is get away from the blah, blah, blah and actually talk about what it means for the company, what it means for the stock, and frankly, what it means for America. Mr. Forte joins us now, senior research analyst, D.A. Davidson. He is a neutral on Apple. Let me cut to the chase. I thought some of it was fascinating and the rest of it was sort of eh. But Tom, to me, the key thing is what does it mean for the broader Apple ecosystem? I mean, I think there's when you have storage, everybody's complaining about 2 terabytes of storage in iCloud. They pop that sucker out to 6 to 12 terabytes. Little things like that below the headline. What's yesterday mean for the Apple ecosystem?
Sure. So I think that what I thought was most interesting is that they're taking a de facto price increase on the Pro Max. They're not offering the 128 megabyte model anymore, so it's $100 more to get an iPro Max. And then the dongle, you teased it before, but the fact we're talking about accessories, not the phone, is
Right.
good and bad news. The good news is that it should be accretive to margins. The margins on a $29 dongle ought to be fantastic. For the ecosystem, I think that you may not see the incremental new buyer this year, but as you pointed out earlier, the wireless carriers seem to want to subsidize their 5G networks, which is also good news for Apple.
I got 8
so some good and bad.
Yeah, I got 8 ways to go here, Tom, and John and Lisa have more intelligent questions. They got a 3 nanometer A17 chip. Is it enough for someone to upgrade in China? Is it enough for someone to upgrade sitting to my right here in New York where he's adamant he's not going to fall for the fanboy baloney? Is that new chip enough to upgrade?
I do not believe that it is. So when I was thinking about all the buzzwords and all the new things in the iPhone 15, I was chuckling at titanium and how there have been titanium golf clubs for some time now, or how they're essentially, no one's pointed out that they're offering OnStar. And so I'm concerned that there's a lot of small incremental adjustments, but there's no one item that I think is going to get you to wait in line, like we used to for an iPhone.
So, Tom, you know the bullish thesis. The bullish thesis sounds like this. There are tons of people who haven't upgraded. The iPhone 15 is going to get them to upgrade. Now, Tom, you clearly don't buy into that. So let's go through your rating. Neutral, 180 price target. In the pre-market right now, we're at 176. Given the multiple that this stock has and the fact that you don't believe in the bullish thesis, Tom, I've got to ask the question why this isn't a sell and why that 180 isn't a whole lot lower.
Yeah, so I do think, you still have an amazing balance sheet, so they have the potential to buy back billions of dollars of shares to support the stock. I don't think they would ever raise their dividend yield to, say, 3% to attract that pure dividend investor. But the foundation is still there, and I don't think that the stock is so overheated that would warrant a sell rating at this point.
There is this question, though, if there isn't anything to really catch everybody's eye, except for a $29 dongle, there is an issue of the increasing geopolitical concerns, especially as right after this launch, China came out and said that they flagged a number of unspecified security incidents with the iPhone. How do you factor that into a price target?
So the way that I factor it in is about 10% of their revenue comes from China. They're clearly still heavily dependent on China from a supply chain standpoint. And when you think about what I'm thinking of is protectionist behavior by the Chinese government, we have protectionist behavior in the U.S. as well when you think about banning TikTok and things of that nature. But to quantify it, 10% of their sales are at some level of risk, and that's bad news for Apple.
So if you're looking at right now a product that isn't necessarily going to encourage a real refresh kind of cycle, where is the bulk of the revenue going to come from? Is it going to increasingly come from services, or can it continue to come from just the fact that at some point this is going to break and even John is going to have to upgrade? So,
all right. So there is some element of the slow to upgrade consumer, but I think that this is why there was a lot of enthusiasm for the Vision Pro. But we still think that the Vision Pro, which looks to be on track for launch next calendar year, they're not going to achieve mass adoption with their augmented reality, virtual reality headset. So if you don't have the next new thing and you have kind of the iPhone aging on the vine, it's a challenging period for Apple. It's somewhat remarkable how well the stock's done, given that they already tipped off their hand that they're going to report their fourth consecutive quarter of declining revenue in the September quarter. So new products and I guess still a foundation on iPhone and buybacks might be the things that hold up the stock on a near-term basis.
Tom, that's worth 30 times forward earnings?
No, it's not. But yeah, so it is not. The services element is what enabled them to get the premium multiple versus where they were trading before. Services, it's still a good story. But at some point, either the iPhone's going to have to exceed all of our expectations, or the Vision Pro is going to have to do much better than I think for the stock to continue to go higher over the next 12 months.
Tom, let's just finish on this line that Lisa mentioned from China. I wonder what the response will be from Apple to this, because it's not something you typically hear. This is from the Chinese Foreign Ministry spokeswoman. We noticed that there have been many media reports about security incidents concerning Apple phones. Tom, what do you think they're alluding to?
Yeah, so I think they're alluding to the reports that government workers in China are not able to use Apple devices. I think it's interesting. I've been trying to figure out the appropriate chess piece for Apple in the increasing tension between the U.S. government and the Chinese government. They're clearly not a pawn. They're not the king. They're not the queen. Maybe they're a knight. But they have tremendous sway in China thanks to their relationship with Foxconn. But I think they're getting kind of caught in the middle here on this increasing tension between the two countries.
Without a doubt. Tom Forde, thank you, sir, of D.A. Davidson, following the release, the unveiling, the big reveal of the iPhone 15. That tension between China and the United States, Lisa, thanks for mentioning it, because that story is going to be pretty wild through the next quarter or so, just to see what those sales actually look like on the ground in China.
Especially if they're flagging unspecified security incidents right after we heard about not using these from government workers in China, but saying it's not an outright ban. I mean, they're basically specifying that. Is this sort of a tit for tat after selling the iPhone more aggressively in China? I mean, is this because of the new product launch?
I just think it's demand. I don't have a bullish bearish case here on China, what they're going to do, but I look at luxury sales in China and all that, and frankly, it's a mystery right now. I think the Apple sales in China are the same as LVMH or Hermes or the rest of
luxury in North America, Tom. North America, never mind China. North America, we've seen that flagged by many luxury retailers.
Well, there's a small group at the top and the others. Yeah, there's
entry-level stuff,
split. Sure. Well, just whatever it is, but I don't have a lot of certitude on what we're going to see in China in the next 90 days on luxury, and frankly, an iPhone. The 15, what is it, Pro Max with 1 terabyte of storage, you're popping $1,400.
Is that enough for you?
For that puppy.
Is that enough storage?
And, well, yeah. I mean, Vet wants one, but the bottom line is that's a lot of money.
How much storage does one need? Isn't that a ridiculous amount?
Yeah, it's ridiculous. 256, we'll get it done.
Ridiculous.
For all digital pack
for your
rats.
ego, if I want to go down the street,
Oh,
you
right.
know, I need
But how would
512.
anyone know? You've got to
I need
tell,
512.
tell everyone that's what's
I'm going to
storage is on your phone.
He has 512,
Nice.
1 terabyte.
They're T-shirts.
From New York City, future's a little softer. This is Bloomberg. First day of losses in 3 on the S&P. Let's see if we make it 2. Equity futures on the S&P 500 slightly negative this morning. Going into CPI, we're negative 0.2% on the Nasdaq. We're down about 0.25% on the Nasdaq 100. If you look at where we were since August 10th, Tom, where we are since August 10th, the last CPI report, this equity market's basically dead flat, Further signs of disinflation. Stock market's gone nowhere at the index level.
And Tom Forty talked about it with the thing everyone owns or doesn't own or wants to own, Apple, in that there's a wall of money out there. I'm going to give credit to Lawrence McDonald, as we did yesterday. And the bottom line is, as Larry wrote in a brilliant essay, there's just this wall of money holding things up, including, Lisa, would you say corporate spreads as well?
Yeah, everything.
I mean,
We've
just
talked about
putting the bid on bonds and notes and bills, and it's just a wall of money.
You can actually get some yield. Let's turn to that yield. 2-year, 10-year, 30-year in the bond market. 2-year through 5%, up another basis point or so at 5.02%. On a 10-year through 4.30, up 2 basis points today. If you think about where the equity market has been since the last inflation report, dead flat. This bond market, anything but. Arguably, Lisa, absorbing, internalizing the higher for longer message at the front end of the curve.
And the most shocking part about it is it has not disrupted riskier assets. I mean, pairing those two ideas really speaks to a tension right now. Can you have a soft landing with higher for longer? And that really is, honestly, increasingly at debate.
It's certainly stronger dollar off the back of it, that's for sure. You push this through foreign exchange. It's been an interesting week already. Monday, the US dollar was weaker. Tuesday, it was stronger. This morning, it's stronger again. The euro's negative by 0.2%. The euro right now, 107.36. I really don't know what the ECB can do, will do, should do at the European Central Bank in Frankfurt, Germany on Thursday.
I'm using Euro Swiss as a barometer. It has not moved. You got the German news of a slower economy. As you say, the complete mystery of the ECB. And my litmus paper there is the euro as compared to Zurich. And the answer is it has not shown strong Swiss franc.
Under surveillance this morning, 2 hours away from US inflation data. CPI expected to show price pressures remaining sticky, adding to risk policymakers will keep interest rates higher for longer. Over in Europe, starting in the UK, the economy shrinking at the fastest pace in about 7 months, reviving fears that a recession might be underway. And traders ramping up bets that the ECB will raise rates when it meets tomorrow, following a report from Reuters yesterday that the central bank sees inflation remaining above 3% next year. So tomorrow, Tom, we'll get these forecasts, and those forecasts will be available to the Governing Council when they convene to set interest rates. The idea being, if they have to upgrade that outlook for inflation to above 3, not at 3 for 2024, does that embolden the hawks to say, let's go, we need to go again?
I need some Jamie Dimon humility here. How valuable are those forecasts? Let's go back and look at the forecasts 6 months ago, a year ago. I mean, we're lucky. We get to, BS about it here. People have to actually make forecasts. Greg Bottle had the courage to come in from BNP Paribas the other day and say, I had to go bullish, I'm not bearish. What is the value of a next year 3% ECB forecast?
Well, how have they missed? They've underestimated inflation, right? Time and time again. Hasn't that been the story in Europe?
They've underestimated the rigidities in Europe. This is a real economy issue.
They're underestimating how quickly it can come back down?
Yes, because of the rigidities. Trichet would say he would say it more romantically than me with that French accent.
Sure.
Rigidities. Or however,
is that how he would say it?
Sound good there?
I hope Trichet's not listening this morning.
I hope Catherine Deneuve is. Good morning.
Looking forward to our coverage of the ECB tomorrow. Let's take it back here to the United States. A strike by the United Auto Workers looking more and more likely as the union and the big three, they remain far apart on a new labour contract. The UAW president planning to confirm the union strike at 10 p.m. Eastern tomorrow, 2 hours before the contract officially expires. This all according to people familiar with the matter. They've come down from 40, Lisa. They're at 36. I was speaking to David Welch of Bloomberg over in Detroit yesterday. I said, what gets it done, David? What gets it done? He said he reckons 20 gets it done. I have no idea if Ford, GM, Stellantis are anywhere near coming to the table and offering 20.
Especially because it's unclear what other details are on the table. There was a report about absenteeism and how absenteeism was about 23% at Stellantis. And that's one of the things that they want to remedy because this is costing them a lot of money. And they said if people actually showed up to work for all of their shifts, we would save enough money to offset this. Just it's the rancor sort of underpinning some of these discussions on both sides, really percolating out and showing how difficult it is to come together.
It's also, to your point, this idea of the fiction of a 32-hour work week. We want to be like the Germans. I mean, that's the bottom line. And maybe Stellantis of Europe is leading the charge on this. How do you make money in America on a 32-hour work week? Please help me.
TK, we're finally talking about the elephant in the room in the EV transition.
Yeah.
And it's such a difficult line for the president to walk. He wants this transition. He wants to establish his climate credentials. At the same time, he wants to establish and convey his union credentials. But we know these automakers are going to struggle to compete with their Chinese rivals. The Europeans are talking about it this morning. We'll have that conversation in about an hour. How do you do that? How do you square that circle? Isn't the elephant in the room that the EV transition is going to cost the workers that this union represents? And UAW get the joke and they're trying to do something about it.
Do we know what the EV transition is? I'm not sure. I'm still not clear. You know, I just got they put all the Harvard Business Reviews on my desk at home. The bottom line is it's all AI, EIEV, EIEIO. Baloney. Nobody knows what AI is going to do. Yeah, thank you. But nobody knows what
had a farm.
What do we know what EV's really going to do?
Or
besides, what do we do with the lithium batteries?
Or what kind of demand there's going to be. Ultimately, how much angst is underpinning this negotiation? And you've talked about this before, John, about how is this going to be the last? What is the outlook for certain workers in an increasingly automated space at a time where the actual technology is also changing? We just don't know, and that is underpinning some of the concerns.
Let's get to the outlook for crude just quickly. The IEA, there's another one for you, Tom, warning that oil supply cuts by Saudi Arabia and Russia will create, quote, a significant supply shortfall and threaten a renewed surge in price volatility. The announcement coming a day after Brent touched a 10-month high above $92 a barrel. This morning, $92.58. TK, going into CPI in America, we have crude at the highs of the year.
Yeah, I take it off July 4th, I believe it was, and it has been a surge. Is it a moonshot in oil? Maybe not, but it is a surge in the price of oil. It's got to change behaviors. There's no question about it. Right now, we're going to stagger forward into April of next year. John Farrow and I are riveted on the North London Derby of April 24th, 2024, April 27th, 2024. Rubila Faruqi of High Frequency Economics says that when John and I are at the North London Derby in April of next year, we're going to have a two-handle on U.S. inflation. Rubila, no one believes you. How do we get to a sub-3% inflation by the time the Tots take out Arsenal?
Good morning. Great to be with you. Thanks for having me on the show. What we're seeing right now is a little bit of a dichotomy between what's happening with headline inflation, what's happening with core inflation. The Fed's mandate is headline. Obviously, an acceleration in that is going to be a concern, but we are seeing the right signs on core inflation. Rent inflation, shelter, that's going to start to diminish. The pressure from that is going to start to diminish. We don't think, if you're traveling, if you look at airline travel, that is still very strong, but we don't think that's going to keep on going at the pace that it has been. The labor market is key to these data. The labor market is slowing. Our base case remains that as the labor market continues to slow, as wage growth also continues to, moderate, even as inflation diminishes, even as real incomes are positive, we do think that inflation pressure is going to continue to diminish. We think we will be at a two-handle by the second quarter of 2024.
How does our study of real estate now, or our study of real estate at the North London Derby in April of next year, how does it affect what the Fed will do about 2.8% inflation?
The Fed is looking at, it's a difficult thing, right? Because they are looking at backward-looking data. They're data dependent. But at some point, they also have to, and they're talking about it, that this rent, this housing component, that is going to start, the lagged effects are going to start showing up in what we see in inflation going forward. But, whichever way you look at it, inflation is too high. The Fed has to, we think they're done hiking. They have to maintain this policy stance for some time The question now is, are they sufficiently restrictive? Do they have to push forward a little bit more? We think they don't. We think they're done. The peak in the Fed funds rate is where we are now. It's just that, can they call victory on inflation? Absolutely not. They have to keep that, hawkish bias. They have to lean into that. But I do think that the message is, from our perspective, that they have reached the peak and they're going to stay here for some time until inflation starts to, is on a sustainable basis moving towards 2%. And we do think that that's going to happen over the rest of the year and going into the first half of 2024.
Rubila, about an hour ago, Germany put out an increased forecast or a revised forecast for GDP this year to a full contraction of 0.3%. We were talking about how the ECB is grappling with the nightmare of central bankers, which is stagflation. How far away from stagflation is the United States?
I don't think we are close to stagflation at all. Look at the positive momentum in this economy. We have constantly underestimated that, the household sector, the business sector. I think what's really important to remember is that going into this recession, we saw such extraordinary support for households and businesses that household and business balance sheets were fortified, coming off a very, very strong base. And I think that's what we've constantly underestimated. This economy still has positive momentum. It still has positive job growth. We are concerned about the fact that if the Fed keeps pushing, what is going to happen to this deceleration in job growth and what's going to happen to unemployment. But right now, we are not seeing any signs of distress that would suggest to us that the U.S. economy is really hurtling towards a recession or a contraction.
One of the biggest debates right now among economists, and I even see this on the Federal Reserve with certain papers that are conflicting about how much of the Fed increases in rates have already trickled through to the economy, with some people saying most of them have already come through, other people saying no, the bulk of them is going to slam into the economy in the next 12 months. We were hearing from Bob Michael of J.P. Morgan yesterday on that front. Where do you sit?
I think a lot of that effect has already gone through. We've been talking about lending standards tightening. We're talking about borrowing costs, at very high levels, multi-decade highs. The consumer has still been very resilient despite those headwinds. So I do think we're looking at a different cycle. This is not a typical business cycle. This is not a typical response to over 500 basis points of tightening. This is not what we expected. So I do think things are a little bit different right now. We do still expect that these tightenings are going to affect the labor market. Things are going to adjust, and that's going to filter through to businesses and to households, towards the demand side of it. So I do think that we are going to see the effects. It's just that we've been surprised. The economy has surprised us to the upside over and over again. We're still looking for growth to decelerate pretty sharply in the fourth quarter. Based on the fact that the labor market is going to soften. But we are also prepared for upside surprises, given what's happened so far this year.
Roberta, just quickly, what do you think is going to be captured in the forecast we'll get from the Federal Reserve next Wednesday?
Oh, I think they have to upgrade their growth forecast. They have to downgrade their inflation forecast. I think what happens with the Fed funds rate is important. I think they leave it where it is, given that they want the insurance. They don't want to give the impression that they are at the peak and that they're not ready to do more if needed.
Got it. Roberta, thank you. Roberta Faruqi there of High Frequency Economics. Looking ahead to the Federal Reserve next Wednesday. Get a set of forecasts, not just a decision. Tom, North London already complaining. Did you spell Derby with an A?
I thought that's the way you guys spell it. It's a Derby.
That's how we say it. It's not how we spell it. I feel like you knew that.
I'm learning every day.
I was told over the Bloomberg just to correct you quickly. So you understood before we go to London.
But you say why don't you say Derby? I mean, it's a Derby.
It's a Derby.
It's a Derby.
It's a Derby. Will Kennedy's going to join us shortly.
Is Merseyside a Derby?
It's a Derby too, Merseyside Derby.
With Everton?
Liverpool and Everton. Get Everton right.
Everton.
Nailed it.
I'm nailing things.
That's not Will Kennedy's team. Will Kennedy's going to join us shortly on the oil market. A warning about a deficit in the crude market. A deficit. Tom, not enough supply, and it's driving up crude prices again, 92.63 on Brent.
Francisco Blanch is brilliant yesterday on this. I mean, he didn't say 100 on the way, but look at that. 1, 2, 3, we're there.
How far away are we?
Up.
Will Kennedy of Bloomberg just around the corner to weigh in on that. Crude prices elevated near new highs for 2023. Those latest prices going into a higher CPI print off the back of more costlier gasoline. We'll talk about headline inflation and the difference between that and core in the next hour of the programme. From New York City, this is Bloomberg.
the market is really tightening in the second half of the year. With the extensions of the cuts by Saudi Arabia, but also Russia through the end of the year, we're seeing global oil demand overtaking supply by about 1.4 million barrels a day in the fourth quarter. So this risk, tightening the market, increasing volatility.
We've had warning after warning yesterday from OPEC, today from the IEA. Toro Bassoni there, the head of the oil markets division at the IEA, warning of the deficit we could see in the crude market. Not enough supply. It's driving up prices. Let's talk about prices right now. 92.63 on Brent crude, WTI 89.44. New highs for 2023, even with supply in America near record highs and a slowdown, we're told, in China. Crude up, equities looks like this. Let's whip through the price action for you just briefly. Equity futures negative here by 0.14% on the S&P 500. Yields a little bit higher by a couple of basis points at 430. Going into CPI a little bit later on this morning. The estimates, Tom, look a little something like this. Headline month over month, because of this move in crude and gasoline prices, could come in at 0.6%, according to our survey. The previous number was 0.2. If you look at core month on month, totally different story. 0.2% previously, 0.2% is the estimate now in our survey. So the question is, do you ignore what's happening in headline? And do you ignore what's happening in the commodity market if you are the Federal Reserve? Particularly when the likes of Marko Kolanovic over at JP Morgan has this to say, Tom. Here's the quote. The potential for the commodity price surge to feed inflation and extend the hiking cycles over at central banks. Tom, is that the risk going into this Fed meeting next week? Or should we embrace that softer core figure for another month?
To me, the risk, as you put it, is it's two separate conversations. The conversation of our listeners on radio, our viewers on TV, is the real world out there. If I look at a gallon of gas, $3.84, the answer is my long-term moving average is $4.30, Lisa, down from the spike of $5. $4.30. We're a long way from that, but at the rate we're going, we could get there sooner than later.
Are higher oil prices inflationary or disinflationary? And this is at the heart of the debate for the Fed. But at the bottom line, if you have this appearance of inflation, that could create a self-fulfilling kind of prophecy in the University of Michigan Sentiment Survey, which you guys follow very closely. That's going to be important for at least politics, but also maybe the Fed.
Actually, Will Kennedy just fell off his chair in London because he's looking at petrol, they say. A gallon of petrol.
That is what we say,
a little bit higher. Will Kennedy, a gallon of gas in London, that's like $7 something, isn't it?
It is. But, I drive an electric car these days, so I'm not sure of the size price, but it's definitely going up.
How does Saudi Arabia, who seems to be in the driver's seat, no pun intended, how do they deal with Will Kennedy driving an electric car or China committing to an electric car? At what price of Brent crude do more people buy electric cars?
It's a good question, but I think that, lots of us are driving electric cars in China, but the really important thing from the Saudi perspective and the oil market perspective is it isn't doing that much yet to dent demand. Demand is looking robust around the world. Gasoline demand especially is looking quite strong. Part of that is people switching out of diesel cars, which we've grown to hate, used to love in Europe, and now we hate them. But in China, people are driving more electric cars, but they're also driving more gasoline cars. They are moving around. After being locked up for several years, they are moving around again. And gasoline demand over the summer has been very strong in China. And I think one of the facts about the market right now is there was a lot of concern about Chinese demand. But when you look at the numbers, it's looking pretty good. And the Saudis know that.
Did the Farrow household have a diesel vehicle?
We did not know. We had a Rover 416.
But everybody went nuts on it. My father went nuts on it.
Did he get a diesel?
VW diesel.
We didn't do that. There was a big German push. Yeah. German manufacturers really pushed that stuff. Well, let's talk about supply deficits. I've seen two different numbers in the last 24 hours. There's quite a big difference between the two. OPEC have given us one. IEA's given us another. Well, you and a team running commodities in London at the moment. What's the number I need to be thinking about? How big will that supply deficit be through this year?
Well, I think the thing to point out is that even the IEA number is a pretty chunky deficit when you're looking at global demand in the sort of region to, just over 100 million barrels a day, 102, say, you're looking at almost 1% even on the IEA number, and that adds up pretty quickly. And if you split the difference between the IEA number and the OPEC number, you're looking at pretty chunky deficits, and that's what's driving markets higher here, and that's why it's clear that, the Saudi decision to keep that cut in place by the end of the year is severely tightening the market, and as Toril Bassoni said on the program earlier today, is driving down inventories very quickly. I think increasingly, though, the market's going to be focused on what that number looks like in the first quarter of next year. There will be some, year-on-year growth will not be quite as strong. There will be some more oil in the market, probably, and so that balance will increasingly come into focus. But there's no doubt, no matter which number you choose, if you look at somewhere in between, we're looking at a pretty tight market where inventories are coming down quick.
Well, are we back in the zone where we're going to be talking about the weather, and we're going to be talking about how cold the winter is going to be, and the value of not only oil but also gas is going to surge on that if inventories are so low heading into what has always been a big question mark of weather?
Yes, I think it's always a question, and a lot of people around the world use effectively what's diesel to heat their homes as heating oil. And the diesel market right now is a part of the oil market that looks extremely tight. Refiners are being rewarded for making diesel. The spread between diesel and oil prices has really blown out on just the global resilience in industrial demand as we, as the economy keeps going. And if we do get a very cold winter, that part of the market will continue to be under pressure. And yes, a cold winter always drives demand. So yes, we will start having that conversation. But it's worth pointing out that in Europe, the natural gas inventory situation looks as good as it could be for this time of year.
At the same time, when we do talk about heading into winter and some of the inventories and how depleted they are, I wonder about the lag effects, not of monetary policy, but of output cuts. Do we have a sense, Will, of how quickly the Saudi Arabia could turn on the taps and change that balance? Or is this something that could get a bit over their skis as they try to target a $90 to $100 price target, as we were hearing about yesterday?
Yeah, I mean, they're going to have to watch the market carefully. They won't, clearly they want to see prices rise higher than here. They won't want it to become a full-blown upward ramp, I don't think, because clearly then it does have an impact on the economy. But, the one thing you can say about Saudi policy is that they do meet their pledges and follow through, and they can adjust relatively quickly. I mean, it takes a number of weeks for them to get the oil on the tankers and to market, but they are able to respond, and they do tend to do what they say. So although they're committed to this 3 months, they always reserve the option to readjust if the facts change on the ground.
A monthly review, I think we're told. Will, I'm also watching the weather, but somewhere else, hurricanes forming and potentially heading towards the United States. And as we know, the SPR was built up for a reason, Will. I'm sure it was in the midterm elections a year or so ago. And Will, that SPR has been depleted. I just wonder, from your perspective, given where crude output is in America near all-time highs, just how vulnerable the market might be with the SPR as low as it is.
Well, I think there's enough in the SPR to cope with a hurricane season, because also there you really need oil products if the refineries are knocked out, which is often the greatest risk. But what I would say is the market is very right to focus on hurricanes, and that Gulf of Mexico region is becoming ever more important to the global energy system. You've got the refineries on the Gulf, you've got oil production in the Gulf, you've got oil export terminals for shale to get to the rest of the market, and you've got LNG export terminals. So those hurricanes absolutely need to be watched across all sorts of markets. And a really big hurricane blowing up, in the Louisiana, Texas area could cause a lot of havoc, and we're not at the end of the season yet.
That's where the supply boom is currently. Will, thank you, sir. Will Kennedy there on the latest off our London desk on the commodity market. TK output in America, thank goodness it's near all-time highs, given what we're seeing develop elsewhere.
To the late Bill Richardson, former energy secretary, governor of New Mexico, dying last week. To Bill Richardson and others who were energy secretaries, one of the charms of America is we never really had an energy policy. We just went out and did technology, and pretty much like the internet, nobody saw the technology of shale coming. Now what?
92 is now what on
now
Brent.
What?
89 is now what on WTI. And Lisa, to your point, I've been asking this question. I think it's an important one. I agree with you. Is this crude price a reflection of the extension of the cycle or the recipe to end one? And that's the question I've been asking as well to a lot of the guests that come on the 9 o'clock. Brahma, which one is it?
If it's driven by supply cuts, then you could argue it has a greater chance of ending the cycle because not driven by strength.
We'll continue this conversation. Gargi Chowdhury of BlackRock joining us very shortly. Crude at new highs for 2023. Equity futures slightly lower. We're down about 0.1% on the S&P 500. Inflation data in America 1 hour and about 34 minutes away from New York City. The second hour of Bloomberg Surveillance up next.
Us, along with many in the street, were looking for a slowdown and looking for a recession this year, and it just hasn't manifested.
It's still a very strong labor market.
The U.S. economy is far from robust. It's still in positive territory, absolutely, but the momentum seems to be shifting to the downside.
I think the consumer is incredibly stretched right now.
I think the reaction function of investors is to get out quick if the data starts to deteriorate.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The most important data point of the month coming right up. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P slightly negative by 0.1% on the S&P 500. That data is 90 minutes away. TK, that data, US CPI.
It's going to be nominal data there, the core number, and then and on top of it, the inflation number. We've studied it all. We'll give you, Michael McKee's treatment here at 8:30. Just printing moments ago, the 10-year real yield, John, pops up to a 1.96%. That's a 2 basis point move here, and that's underlying churn here between nominal analysis and real analysis. We'll do that at 8:31.
And the difference, Tom, between core and headline within the data itself. Core, we're making progress. Headline, do we have a problem? Lisa, Brent crude, 92.65. WTI, 89.50.
There's a big debate. Does headline matter? If you do see a pop upward in response to higher oil prices, do we care? Does the Fed care? And we talked about how you hear JP Morgan analysts saying that maybe the Fed's going to game out oil prices and respond to them. The issue is, it's how they are increasing. Is it increasing in a way that reduces consumer spending, and do you see that show up in the numbers?
On the commercial break, John Farrell's looking at what Lando Norris is doing as he goes to Singapore for the Formula One this weekend. What am I doing? I'm looking at a log gallon of gas, Lisa, and we're up above 2 standard deviations, above $5 a gallon gas. We're at $3.84, just teens-weens above 1 standard deviation. Now's when the tension starts.
What Tom just said, reverse it. I was doing one thing and Tom was doing the other. I was also reading this from Andrew Hollenhorst just moments ago. He says this about the Federal Reserve going into next Wednesday. The Fed is very likely to skip hiking this month, but stronger core inflation could convince the Fed to leave the 23 median dot, showing another 25 basis point hike in November. We've got to work out what this oil story does to demand. I think this is so important. So let's pick a company. Already this morning, in the last hour, we've heard from Spirit Airlines, domestic-focused airline here in America, citing increased fuel costs, steep discounting, and cut in the outlook for revenue. Lisa, that stock is down 2.95%.
And this is such a confusing picture because you've seen some airlines getting beaten up more than others. But you raise such a good point, which is, do you see discretionary spending coming in dramatically? Or is that strength and that surprising resilience that Rubila Fariki was just talking about, do you see that come to the fore and that actually consumers are able to keep spending well past what people expect?
Let's get to the price action this morning. Futures a little softer. We're down by 0.1% on the S&P 500, 87 minutes away from that economic data. Futures pulling back just a touch. In the bond market, yields higher by a single basis point, 429.42 on a 10-year. In the FX market, tons to talk about in Europe. We'll save that conversation, but I'll tell you where the euro is currently. It's slightly weaker against the dollar, Lisa, 107.38.
8:30 a.m. in about 90 minutes, we do get the key data point of the day, arguably of the month. As you were just saying, U.S. CPI comes out. People are going to be parsing through the headline number as well as the core figure. I'm also looking at how it compares to the pace of wage increases or not. And this, to me, is important because it's basically a question of, Does this inflation reduce the spending power of the average American? If it does, to have a different response from the Federal Reserve. Today, we do hear from more banking executives at the Barclays Global Financial Services Conference. We do hear from the Citi CFO, Mark Mason. Yesterday, Goldman Sachs' David Solomon talking about the resilience that we're seeing in IPO markets, but again, raising this warning about increased capital requirements and how that could hamper the access to capital markets by companies. And we've heard this a lot from a lot of banks, but maybe it's a little bit different. And 2 p.m., Tom, you were talking about the real yields. And I'm also looking at the real yields on 10 years, on 10-year treasuries. How much does it have to do with the deficit in the U.S.? And at 2 p.m., we get that August U.S. budget statement. As the deficit increases and as you have other regions move away from buying, like Japan, what does that do to the real yield? How much can that drive some of the gains that we're seeing?
I get that the debt and the deficit discussion is going to be huge and politically huge forward, but I'm going to go back to Jeff Curry of Goldman Sachs, who said this real yield, John, permeates everything we do, including buying the next iPhone. I mean, the real yield is different. It's back to our youth. It's back to 1994, 1984, et cetera. It's a whole new world after all.
I know Jeff is no longer at Goldman, but I know he often tunes in. Can we give him a victory lap for his crude call? What a forecast. Ultimately, we're up here,
Great
aren't we?
Call.
In the 90s, going into the back end of the year.
Each of these guys is different. And Jeff Curry, I don't know what he's going to do. Maybe he's going to go teach microeconomics again at Chicago, but he brings microeconomic foundations to the debate like no one.
Gargi Chowdhury joins us now, Head of iShares Investment Strategy Americas at BlackRock. Gargi, wonderful to catch up with you. It always is. Two-part question. One, what do you expect the data to look like later this morning? And two, how do you expect this market to respond to it?
Sure. Good morning, Tom, John, and Lisa. So for the CPI data this morning, I think the expectations are for a stronger than expected headline. I think that'll be around 0.6. Obviously, the market will put a little bit more focus on the core data. I think that's where we get a strong 0.2. Now, after 2 months of that weaker, about 15, 16 basis points, expect this one to be closer to 23, 24 basis points. What I will be focused on is really looking at some of the details. So where are we seeing weakness? Are we still seeing that goods weakness? Are we still seeing goods weakness, especially in used and new cars, which is my expectation? And then focusing really on that shelter and more specifically on the owner's equivalent rent. And obviously that moved up a little bit last month. To see if OER comes down a little bit this month will be important. And then finally, last point I'll make is that despite the weaker data, especially on the core front last month, bond markets really didn't have the reaction that you would have expected. So I think this month it's going to be all around seeing how the bond markets react if we get that 0.2 expected data for it.
Gargi, your research notes all 1994, which is the last time the Red Sox and the Yankees were fighting for first place in the American League East. I hope you love the doubleheader yesterday at Fenway Park. The bottom line, Gargi, is I'm looking at a research note talking how quaint the belly of the curve. Teach us about the value of the midpoint, the belly of the curve.
Sure. It was great to actually be in Boston, where I'm joining you from for that. But sadly, I did not get to go to the game. I was at a client event instead. But I'll say about the belly of the curve, the part that we're talking about is really that 3 to 7 year point. And, we look at the iShares ETF IEI, which gives you access. And the reason we're talking about the belly, number one, that's where the carry we think is the most advantageous to investors. So you can hold that 5 year point, or you can hold anything from that 3 year to the 7 year point. Rates can still move higher. And I think that's a really important thing for us to remember. Rates can still move higher by about, call it 60 basis points or so for the next 12 months. And you can still have a positive outcome in your portfolio. So that's number one. Number two is, and as you know, Tom, we've been speaking about this before, we'd come into this year and we talked about this, bonds are back in yield of dreams, but we'd really focused on the very front end. And now we're telling investors to move out a little bit and add some duration in that 5 year point, in that belly. And that's primarily because I think with the consumers slowing down in the in the fourth quarter of the year, as well as inflation moderating, or at least core inflation moderating, all that behooves a little bit more duration. Wouldn't go out past the 10-year point quite yet. I heard you guys talking about the deficit issue earlier, obviously Bank of Japan and their actions. There can be a lot of reasons for the longer end to continue to move higher and the yield curve to continue to move steeper. So the sweet spot is really that 3 to 7 year point.
If oil prices keep rising, as they have over the past couple of weeks, what does that do to your call?
Yeah, I think that's a really important point. I think it depends on how it rises. So whether it's like a grind higher or a sharp move higher. The second point will be how where it gets to. I think if we sort of hover between $90 to $100, obviously that's a very high number, but I think that this is an economy that can still withstand that. If we're looking at an oil shock at 120 or something, significantly higher than today's levels, number one, I think that becomes a huge problem for the Fed. They haven't historically focused on headline, but they would have to, and that brings in a question of many more rate hikes. And the second, I think that also brings up a question of, again, the consumer slowing down. That is a huge tax on the consumer at that 115, 120 level. And I think that then brings us to a point of buying duration again, because that means that growth slows down pretty meaningfully. Everything that we're talking about for Q4 having a 1+ handle on growth, I think we would have to question that. So I think, the very front end would certainly suffer because the Fed would have to raise rates more than what's priced in. But I still think that the belly could probably be okay, especially when you think of the carry that's priced in. And then the last thing I'll say is, one of the things that we've also talked about in our research note, and we've been recommending since sort of our mid-year guide, is talking about owning tips, owning real rates here. And especially as we move closer to that 2% level, I think real rates become really attractive in a diversified portfolio. And again, if you have that real rate allocation in your portfolio, I think that can work out pretty well in that higher yield situation as well.
Do you notice fewer potential buyers when you're visiting clients? I know that you're in Boston and you mentioned the Bank of Japan. Are there fewer international buyers, and are there enough domestic ones to take over?
I think that that's exactly what's beginning to happen now in the fixed income market specifically. Obviously, we talked about how some of the international buyers may be stepping into their own domestic markets, given the yield availability in those markets. But I think if we look historically at who owns treasuries, if you look at households, that they have historically been a buyer of treasuries, and they haven't really bought as much yet, and they have a lot more room to add. And let's be honest, if you look at the last 15 years, last 10 years, there was really not much need for investors, households particularly, to own fixed income at 2-1%. And I think now at above 5%, sitting in the 2-year point or a little bit lower than that on the 5-year point, I think households will gravitate towards owning fixed income, not just as a diversifier to an equity risk, but a real source of income. And I think that's why obviously there can be volatility in the short term if we continue to see actions from the Bank of Japan or other central banks. But I think for the most part, I think there will be buyers coming in the U.S. market.
Or as a wise lady at BlackRock once said, the yield of dreams, Gargi. The yield of dreams. Gargi Chaudhry, Gargi, thank you, of BlackRock. Gargi's words, not mine. If you're just tuning in, welcome to the programme. On the S&P 500, equity futures here lower by 0.16%. The conversation will continue. Daryl Cronk of Wells Fargo in the next hour. In just a moment, coming up next, we're going to catch up with Bloomberg's Anne-Marie. Can someone help me and translate what on earth is going on in DC, TK? The impeachment inquiry launched by House Republicans.
We've seen it before, but it's like on steroids. It's the same debate as before. Anne-Marie is encyclopedic on this, but it's just been amped up, ramped up. Of course, all of this leading into the election next November.
Got to talk about that one and this too, the prospect of strikes Thursday night in Detroit.
Yeah,
it's like right there. It's right on the horizon.
It's right there. And you mentioned your good conversation with our great team in Dearborn, Southfield, and Detroit. And the answer is, is it like the cable TV thing? They get it done so we can watch the Jets go down in flames.
And record viewership, I think, on ESPN for Monday Night Football off that game.
Well, that's the
Bills,
power of
Jets.
sports, but
Sure.
UAW doesn't end that romance. It's
Yeah, I
gonna
think
be
this
really
this
interesting to
dispute
see.
is slightly different, Bramo,
I don't
between ESPN and carriers.
This doesn't feel like a marketing tool, and this doesn't
Not
feel
at
like
all.
just sort of a positioning kind of drum, beating of chest. They're really far apart. When you look at the details, it actually makes you feel like they're even further apart.
Can we close that gap in the next couple of days? Those two stories coming up next with Bloomberg's Anne-Marie. AMH just around the corner. US CPI about an hour and 16 minutes away. Equity futures negative here by 0.2% on the S&P 500. In the commodity market, crude making new highs for 2023. From New York City, good morning.
Opportunity.
People? Things get done?
Before, I never did business in Georgia. I was amazed what kind of opportunities. There are many of them here.
Very little bureaucracy, simplicity of doing business. You have access to markets, finance, and authorities.
It's perfectly located logistically. We have the biggest suppliers nearby.
EBRD has invested 4.6 billion euros in 270 projects, and I think that speaks for itself.
Georgia. A pleasure.
Doing business.
I am directing our House committee to open a formal impeachment inquiry into President Joe Biden. This logical next step will give our committees the full power to gather all the facts and answers for the American public. That's exactly what we want to know.
The latest from the nation's capital coming up shortly with Bloomberg's Anne-Marie. That was House Speaker Kevin McCarthy.
He looks tanned like John Boehner.
He's at a vacation,
yeah,
is he?
I think I'm wondering what's going on. He's getting the Boehner look.
I'm not
there
sure
a little
how
bit.
rested Speaker McCarthy is after the
inside
events of the
baseball.
last 24 hours.
Wow.
I understand. We'll talk about that in a moment. Equity futures right now on the S&P, 1 hour and 13 minutes away from inflation data in America. Equities pulling back here by 0.2%, just a little bit softer. Dollar stronger, euro weaker, tons to talk about in Europe. We're talking about recessionary environment through the whole of this year in Germany in the latest forecast set to be unveiled later this week. We're discussing the Reuters report that came out yesterday, suggesting that when we get new forecasts from the ECB tomorrow, they will be upgrading, not downgrading their CPI outlook to north of 3% for 2024. All of that's still to come in the next 24 hours. Tom, your yield on a 10-year, 4.30.
Oh, there it is, and the real yield again elevated as well into this key inflation report, 1.96. So enough of the chit chat. We need to go to our Bloomberg soap opera correspondent, Anne-Marie Horton in Washington as well. For those that are in inside baseball, Anne-Marie, and we know everybody listening and watching is, how close is Kevin McCarthy to the edge of Boehner?
Well, that's a great question. I would turn to Matt Gaetz, representative from Florida, who says that he wants to come in. It's going to be the prayer, the pledge, and the motion to vacate, meaning he is looking to potentially ouster and have this motion to vacate, ouster Speaker McCarthy from the job. And he gave this fiery, hot floor speech yesterday saying Kevin McCarthy is not in line in doing the job that he was elected by those members to do, which is potentially why everyone says you see McCarthy yesterday, first day back, going to the podium and without a House floor vote, which he indicated that he would take this to the floor first. He just launched an impeachment probe into President Biden.
I got 8 ways to go here, particularly for our international audience. We don't need a civics lesson on Boehner of Ohio down in flames. He had to get Democratic votes, folks, to get things done as a Republican Speaker of the House. But, Anne-Marie, just cut to the chase. How big is this group of Republicans? Is there a dearth of Republicans in name only in the House?
Well, the issue, Tom, is that every single one of them wants something different. So a member of the House Freedom Caucus, which many would say these are far-right members of the conservative of the Republican caucus, Ken Buck says there's just no evidence right now to go along with an impeachment inquiry. You have others that are more focused on not wanting a continuing resolution. Scott Perry, the chair of the House Freedom Caucus, saying we're not going to go on with a continuing resolution. We want deeper spending cuts. We don't care about the deal Speaker McCarthy cut with the administration when we were discussing this back with the debt ceiling drama. So every single member has some sort of provision they want in order to get their vote to say keep the government open. And that is what makes this so difficult for Speaker McCarthy to navigate.
One of the things that you do best, Anne-Marie, is to strip out the noise from the signal and to focus on what's the political drama, the soap opera, the theater versus what is real. Is it fair to say that the impeachment is theater and most everybody in Washington, D.C. is treating it as such?
Well, it is, because it's an inquiry at the moment. And even if the House was to have a vote on impeachment, there's no way there's going to be a conviction in a Democrat-held Senate. So this is an impeachment to nowhere. It's going to be a ton of theater in the House Judiciary Committee, in the House Oversight Committee, James Comer, Jim Jordan. There's going to be subpoenas for a number of bank records, et cetera. But a lot of this is going to be noise. At the same time, while there's no evidence yet, potentially keeping this in the news, the Biden administration is going to have to deal with it. And so is the campaign, because obviously he's running for re-election in November of next year.
So that's the theater side. And here's the real side that a lot of people are looking at right now, away from the political circus, which is the UAW strike and the potential for some sort of breakdown in negotiations. Goldman Sachs put out a report saying that that a potential strike would reduce quarterly annualized growth by 0.05 to 0.1 percentage point for each week it lasted. This is going to have a material effect on growth. What is the response from the Biden administration, and what is the response from the Republican leadership?
Well, Wally Adeyemo recently said, and he's the one we have this week on the record talking to CNBC, saying that he does not think there'll be a strike. There are still negotiations. But the reporting we have from our colleagues out of Detroit is that they are very far still at this moment, and that Sean Fain, by 10 p.m. tomorrow, will have plans in place if there is no agreement to go on strike. Maybe not at all three, maybe not at all plants, but a certain number of plants. There will be strikes and walkouts if they do not have this agreement. Between the labor workers, the union, and the big three, they just are not coming in on the hard demands that both sides have laid out. And Sean Fain has said that we are willing to strike over this. This is going to be a difficult position for the White House. The president wants to make sure that he is on the side of the union, but at the same time, he doesn't want to see growth impacted because of this or strikers on the streets in Detroit. And he also wants to, the crux of this is move the auto industry into a greener future. What you saw at the end of last month was $15 billion to retrofit those factories instead of having these companies go to the South and do these joint ventures for battery operations for EVs. And last month, almost a month ago, it would be a month to the date of the contract expiring, the president put out a statement, and he talked about how its union workers should get the first shot at any of these jobs, and there needs to be a just transition, and that union workers should have the wages they deserve to support a family. You could see the line he is trying to walk as he's trying to balance two big goals of his administration.
I'm not sure how he walks this line, AMH, without picking a side. You've got the auto manufacturers in Detroit warning about the sustainability and viability of their companies as they make the effort to make the transition. How does he carry on walking this line without picking a side?
Well, it would have been easier for him if in the Inflation Reduction Act, what some Democrats wanted, which was an extra bonus tax credit for those who bought electric vehicles that were made by unions. But guess what? Toyota has a huge non-unionized factory in West Virginia, and they were never going to get Senator Joe Manchin's vote on that. This is the predicament for President Biden. At the end of the day, there's going to be a lot of phone calls that are going to be worked between the big three and the UAW. He's already tasked Gene Sperling to be in the middle of this, but so far, there's still no agreement.
Has the president made it harder for himself by continually saying that he is the most pro-union president in the history of this country?
Potentially, if you're going to see a strike and if the UAW feels like they're getting a lot of pressure from the White House to settle for something they do not want, they can say to the president, well, you're supposed to be backing us. At the same time, really, a big bedrock of this discussion and a source of serious consternation for UAW workers is being left behind in the EV transition. And what we've seen from this administration is the biggest industrial policy when it comes to EVs, climate change since the end of World War II. And that is why it is so complicated for the Biden administration.
It could potentially be a massive test for his position later this week. AMH, Anne-Marie, thank you. And the position, of course, I'm talking about is the position of someone saying that they are the most pro-union president in the history of this country, Tom. Let's see how the White House responds to a potential strike later this week.
The election's down to 10 states, I'm going to say, as an amateur. Greg Giroux at Bloomberg is expert on this. But the bottom line is those states have a tendency towards manufacturing Rust Belt and even the romance of it, the look back, the image, the heritage. And so he plays to that. And so does Mr. Trump as well.
AMH, thank you. As always, down in Washington. Coming up shortly, Megan Robson of BNP Paribas on the credit market. Plenty to discuss there. And we've had a ton of supply issuance from corporate America through September so far. Your equity market slightly negative on the S&P 500. We're down by 0.1%. Inflation data in America 1 hour and about 4 minutes away. Inflation data in America 60 minutes away. Going into it all, your equity market looks like this. Good morning to you. Futures on the S&P 500 slightly negative by 0.1%. Similar move on the Nasdaq. Softer, lower, negative by 0.12%. Look out below in the equity market if you get a big upside surprise on inflation later. Let's see if we get that. In the bond market, 2-year, 10-year, 30-year shaping up as follows. The 2-year still stubbornly around 5%. Just won't go away. 5.03% on a 2-year, up a single basis point. And for all the talks of getting bullish bonds, BMO, call it a screaming buy.
Screaming buy.
Morgan Stanley, call it a buy.
Oh.
Wells Fargo, call it a buy. JP Morgan Asset Management, Bob Michael sitting around this table yesterday, called it a buy. And here we are, through 430 again, Lisa, up 2 basis points, 430.21.
I love this. I love that you framed it that way. For all the buyers out there, yields aren't budging. And so it raises a question, who's not buying and how much is this an international withdrawal? A Japan, for example, versus something more persistent that maybe has legs.
Sets us up for the Federal Reserve a week away. The week away for the Federal Reserve, for the ECB, a day away. And it's getting harder and harder as we inch closer to that decision. The euro looks like this. The euro against the dollar, 107.37, negative 0.16%. Late yesterday, a Reuters story. A Reuters story. Bear in mind there's meant to be a quiet period, but there never is. Because whenever they want to communicate, they can just leak whatever they want to leak to various media outlets, including this one. Cynical. It's real. It's reality. It's what's happening. Reuters come out and say that according to official close to the decision, we're going to get an upgrade to the inflation outlook for 2024, north of 3%. Which reintroduces the risk that we get a rate hike tomorrow, Tom, from the ECB. And that risk is now on the table in a more profound way, more pronounced way, at the same time that we have reports that Germany is going to be downgrading their growth outlook to contraction for 2023. That's the mess that President Lagarde has to confront in 24 hours.
And the overlay with the drama of Mr. Putin meeting the gentleman from North Korea and all the imagery that we see of that meeting is completely unspoken as this war advances. Overnight, there were legitimate missile attacks on Crimea by Ukraine directly at the Russian Navy. And I'm sorry, that's an overlay to the strategy Lagarde has to impart on a herd of cats she has to herd.
It's been a story of the year, hasn't it?
Yeah.
The fragility, the energy backdrop.
I just don't think we talk about it. We do finance, but the fact is the war is going full bore.
Well, it's all connected, isn't it?
Yes.
Without a doubt. Under surveillance this morning, the latest CPI reading from the United States is less than 1 hour away. Higher gas prices expected to help push month-over-month prices to 0.6%. Core is where the good news is for this Federal Reserve, at least a 0.2%. Do we focus on core or do you focus on headline and what's happening in the commodity market?
I think it's a great question. Or do you focus on both? And when does headline start to matter more for the Fed when it comes to the potential for rate cuts next year? Can you see rate cuts with headline figures that are sticky on the heels of oil prices? I don't know the answer, and this is something that maybe we'll get a sense of today.
Need to get to this story. So earlier today, we heard from Spirit, which had to downgrade its outlook for revenue and had to do so because of higher fuel costs and ultimately maybe even lower prices. This from American Airlines just moments ago. This is the new range for EPS, 20 to 30 cents. The previous range, 85 to 95. That stock is down by 3.4%. That, Tom, is another downgrade from the airlines. And this market was in front of it. We've had a 20% move lower off the highs of July for the airlines on the S&P 500, off the back of higher costs, thank you energy, and maybe even lower ticket prices.
And what's so important to me here is capacity is actually up. There are fannies in the seat. John, I'm looking at a chart of American Airlines back to 2014. And let's be clear, this was a train wreck, no pun intended, before the pandemic. Since the pandemic, they've enjoyed going from 30 to 10. Maybe they rebounded a little bit, but they're rolling over now at a 13 level, back on their way potentially to break support and go down to pandemic worry levels at American Airlines.
Fuel prices up, Tom. They've also got to recognise, Lisa, in the third quarter, a $230 million retroactive pay expense as well. It's kind of all going in the wrong direction at the moment for these airlines. Labour unit costs up, jet fuel prices up, and maybe tickets not going up with it.
Well, they can't. They can't. And we've seen this because we do get some consumer pushback. That's what we're hearing anecdotally. And at first we said, yeah, right, prices aren't going down. And then anecdotally, when you start looking at prices to Paris, as Tom does every day, you start to get a sense maybe they are going down. The idea of this raises a question. Is this just the airline industry? And they were one of the outliers in terms of the strength. If they're fading, is this really just a specific industry issue, or is this a broader question, especially with the UAW and the labor pushback, considering that that's really going to eat into their costs, into their profits?
This conversation is coming at a perfect time for the inflation debate that we're going to have throughout this morning with CPI about an hour away, Tom. If you're looking at fuel right now, can you really pass this on? If costs are going up in corporate America, labor costs one, energy costs two, can they really pass that on to the consumer? Is that consumer price tolerance still out there in quite the same way? Arguably, relative to where we were 12 months ago, the answer to that is no. But how much has it changed, and how much weaker will it be going through year end?
Well, Mike, I don't know if the airlines are a good example because, like I said, they're flat on their back near pandemic lows, unlike the Standard & Poor's 500, unlike the 7 glory stocks and everything else out there. But I think it's a sum of the parts. Why are used car analysis different from airline analysis? And the answer is used car prices, I believe, are maybe imploding is too strong a language, but they're disinflating.
Well, but it also points to the different economies and the different rolling recessions. Cars were what people bought in the pandemic. They couldn't travel. Then it was the revenge travel, and then they pulled back from some of the cars. My issue is, are we seeing the point at which margins have to compress more than people have previously thought? We see this with American Air. We saw that with Spirit. We've seen this across the airline industry, but it's not just there.
The back this is disinflationary tendency. Perfectly timed. Megan Robson joins us, head of U.S. Credit Strategy, Senior Vice President Disinflation at BNP Paribas. And what's so important here, we had on a guest earlier who frames out there somewhere next year a sub 3% inflation. What does your credit world do if we get airline disinflation, used car disinflation, aggregate disinflation, as some are suggesting?
Well, I think we're starting to see, Tom, signs of that with inflation coming down. I think a side effect that goes underappreciated is revenue slowing. And leisure has been a main top performer among high yield over this year, but we're starting to see early signs of weakness in some of those more cyclical sectors. So gaming is an example where we're seeing softer demand in some regions. I think airlines is another great example that could be impacted further by this risk of higher energy prices. But as revenue slows and you get some of these deflationary pressures, we expect margins to compress. And at the same time, you have a maturity wall that's approaching into next year.
Are the spreads at such tights, basically price to perfection types of level, if you just take a look at the extra yield over benchmark treasuries, are we really accounting for margin compression in corporate America in the credit sphere?
We don't think so. So we do see downside for credit spreads. We're forecasting wider spreads into year end. We think that decompression should play out. To really break out of this more narrow range, though, we do think we need to see more material weakness in the consumer. So we are watching for that as a catalyst, but risks are negative. I think in addition to all these dynamics, you have investor positioning, which has gotten much longer, and then this dynamic of rates being elevated in combination with margins.
High-grade companies coming to market, tons of supply. When does high yield come to play?
So high yield, we had a large investment grade calendar, very well absorbed, spreads unchanged on the week. I think what was interesting about investment grade is despite all the supply, you didn't see much on the long end of the Treasury curve. So decision makers are still reticent to really commit to issuing long-term capital. We have seen high yield supply start to come back to market this week, which is a good sign. Most of that has been on the refinancing side and higher quality. So we've yet to see sort of that expansionary type of supply from lower quality issuers, unsecured bonds.
If they came to market, could you give us an idea of the average coupon? What would it be, like 8%, 7-8%?
So I think it depends by the rating, but we're looking at around 8.5% for the high yield market broadly.
Can they live with that?
Well, I think that the lack of real pickup in high yield tells you that high yield issuers don't want to unless they have to. So I think there is, issuers can come to market and access borrowing so far if they need to. But over time, we're going to see that higher coupon, as it's digested, will eat into interest coverage even more than it already has. So we've seen interest coverage drop by about 1 times in the high yield market to about 4 times interest expense over our EBITDA over interest expense.
Are you managing for total return or to clip the coupon?
I think it depends on, it really depends on the investor mandate. So there is this debate.
My mandate is not to lose money like I have the last 3 years in bonds. Continue.
So I think heading into year end, we like carry. So we do think there's a narrow range for credit to trade in, and spreads will go a bit wider. But given how elevated yields are, carry is an attractive prospect for returns.
Do you ladder? Do you barbell? Do you single bullet? What are you doing here?
Well,
you need to make some money.
To my point earlier about investment grade supply, I think that there's a very positive technical on the long end. So we have lower issuance from investment grade issuers in the 10 to 30 year bucket. In our rate strategists, unlike some other calls across the street, we actually have constant, relatively steady 10 and 30 year treasuries heading into the end of the year. So we're calling for a 420, which we think could support long end performance.
The reason why some people say that the bulk of some of the rate increases haven't made it into the economy is because most companies haven't borrowed at these rates, particularly the lower rated ones. When does it start to bite in a more material way, where those that don't want to borrow, if rates are at this level and they have to borrow at 8-9% coupons, their business model does not work? When does that happen?
So we think it started to happen for floating rate issuers, and you have seen the leverage loan default rate creep a little bit higher. Next year, we really think it starts to hit the fixed rate bond market in a gradual way. So for high yield, we forecast that about 13% of the market will have to refinance by the end of 2024. This will cause interest coverage to drop, and there's a lot of dispersion across sectors. So I think it really depends on the amount of lower quality issuance, a lower quality refinancing a sector is going to see, and that will really drive the impact to coverage. So some areas we see as more risky cyclical sectors, where places like tech and leisure, where you have not only the high maturity wall, but also this cyclical revenue exposure that we've talked about that could come down.
Megan Robson, thank you, of BNP Paribas, on some of the supply we've seen from high-grade companies in America, tons of it, to kick off the month of September, one of the busiest starts ever to the month of September. Tom, whether that continues is a separate question. The real test for this market, I think, is when the high-yield stuff starts to come down the pipe.
What's Luca doing in Cupertino this morning?
Luca
It's like the show's over. How many gazillion can we raise now?
Usually when Luca comes out,
calls?
it means one thing, Tom. Spreads are going wider. Yeah. That's usually the case with Luca's market timing. Fantastic market timer for whatever that's worth. Futures on the S&P 500, negative here by 0.08%. If you are just tuning in, welcome. CPI just around the corner. Equity futures down by 0.1%. Coming up, just after that CPI report, Tom Porcelli has a new seat. It's at PGIM Fixed Income. Very, very cool. His first interview with us right here on Bloomberg TV and Radio, Tom, following that inflation report.
This is the single best guy I know on wage analysis in America. He was a wonder child on it. He was brilliant. This guy understands job market and wage dynamic like no one.
And cost pressures. and inflation and all of that. We need to recap this American Airlines story. A cut from Spirit an hour ago, a cut to the outlook from American Airlines an hour later. It really does raise the question, I think, Bramo, for a lot of us this morning. Who's next? Exactly. Who are we waiting for now? United, Delta, who's next?
This isn't just oil prices going higher. There is something more, especially when you start talking about the cost of employment and you start hearing about that kind of pushback. Does this lead or signal a wave of margin compression that is not yet priced in? This is something that we've heard a lot from Michael Wilson. Do we see this continue from other sectors in particular?
To me, it's hugely behavioral. They got to put fannies in the seat. It's a fixed cost experiment. And in the headlines, capacity is still there. They're hyper managing, as Robert Crandall invented, price discrimination within the cabin. And look at the Paris trip, 7,000 whatever, 14 grand, 2 people to Paris. It's now under 7 grand.
Total revenue per available seat mile. This is the range from American Airlines, Tom. Negative 5.5% to negative 6.5. Previous range was negative 4.5 to negative 6.5. The outlook, not great. Coming up shortly, Republican Congressman French Hill of Arkansas on an impeachment inquiry in Washington, D.C. That's next. This is Bloomberg.
I am directing our House committee to open a formal impeachment inquiry into President Joe Biden. This logical next step will give our committees the full power to gather all the facts and answers for the American public. That's exactly what we want to know.
The latest in the nation's capital, Washington, D.C. That was House Speaker Kevin McCarthy. That conversation coming up shortly with Congressman French Hill, the Republican from Arkansas. Before we get there, just going into the inflation report in about 43 minutes' time in America. Inflation in America, the CPI report just around the corner. Equities look like this. We're down by 0.06% on the S&P, just a bit softer. Yields a touch higher by a couple of basis points, Tom, to 430.21.
4:30:21, and just a lot going on here. The countdown clock's helping me out today, John. 43 minutes, 4 seconds and counting here to the CPI report. It matters in New York. It matters in finance. You know what? It matters in Arkansas as well. I mean, it's that
big time.
It's just that way worldwide. There's no other way to put it. Joining us right now, the gentleman from Arkansas.